Okay, so we should be live. Good morning, everybody. It's Simon Campbell here. This is our first Round the Clock Trader Summit webinar of 2024. Good to have you here. I see a few of you joining us already from sunny Malta. Michael, very jealous about that. I sit in Spain, where it is pouring with rain this Easter. So the tables have turned, as it sounds more sunny in the UK. Not everywhere, of course. Steve's in a damp Wiltshire. But good to know where you are, wherever you are. Thanks for joining us on the webinar. As you've probably seen on the emails, we've got a lineup, 9 speakers today. We are doing slightly shorter sessions that we historically used to do, which was about 45 minutes an hour. These sessions will be about 30 minutes with about 5 minutes for Q&A afterwards. So we're going to try and keep it fast-paced. Don't let that stop you asking questions using the chat box. However, we are live, so you can see our first speaker here. Welcome to Ian Coleman, Senior Analyst at fxstreet.com. I've invited Ian to set the day in motion with a look at the live markets, some of the stocks and indices, predominantly Forex. Forex is where Ian lives, really. That's his happy place. So any questions on these markets, we'll be talking about some of the events that are coming up and just taking a look at what's happening. So Ian, can I turn over to you?
You can indeed. Thank you, Simon. Lovely to be back. And welcome to all that are viewing today. I'll give you a little bit of background about what I do or how I formulate my ideas or trade plans with regards to foreign exchange, stock indices, commodities. I specialize in 2 aspects, if you like, of technical analysis. I specialize in cipher pattern formations, which are built around Fibonacci extension and retracement levels. And I also have developed something that's known as a single currency basket. Basically, what I believe or what I look for in the market is I look for a weakening currency against a strengthening currency. I also understand that news moves markets. So normally when we're looking for reversal formations in certain currency pairs or in a single currency, for instance, the dollar, which we'll be talking about in a minute, we need a driver. We need a fundamental driver. So yen has been a focus. We'll talk about yen in a little while. We've had a lot of chatter from different members of the Bank of Japan, especially yesterday. They did an impromptu meeting where they were discussing foreign exchange. This always gets the market nervous. There's always concerns about intervention, especially with dollar yen hovering around levels not seen since the peak of 2022. So yen's in focus. Also in focus this week is the US dollar. The US dollar index is known as DXY. I'm going to be looking at that. The driver for that, everybody's crazy about inflation at the moment, or that's the buzz topic. Obviously, it has been for some time. We've had high inflation, and that has resulted in higher interest rates, and it's still debatable, and traders are still trying to get to grips with the cutting cycle. So is the Swiss National Bank has already started? Is the Bank of England ready to start? Obviously, you had a little bit of a twist or a little bit of a turnaround in their voting at the last Bank of England meeting. But tomorrow is a really important figure for the US. It's called PCE, and it's personal expenditure data. And that is the Fed's preferred indicator for inflation. Now, we've got a bank holiday Friday. FX markets will be open, but the stock indexes will not be. Gold can't be traded tomorrow. Stock indices can't be traded tomorrow. And obviously, rolling over onto Monday, the DAX, the FTSE, the European stock indices can't be traded. So if we get a bad figure or a good figure tomorrow, it's going to take some time for traders to be able to get involved in stock indices, and I think that's one of the reasons why the main focus is really going to be on FX. I want to look at stock indices as well. I'm going to look at the FTSE. I want to focus on the DAX as well. And I also want to look at the free stock indices from the US. So the US 30, US 100, and the US 500. So the S&P, Nasdaq, and Dow. So just to give you an outline of how I trade the market. So I'm obviously sharing my screen. This is a TradingView platform. Here, I always have 6 watch screens. I do take note of the larger time frames for the potential of the longer term move, but I trade swing trades. So I'm really looking at the 1 hour, the 4 hour chart to get into to trades. I'm not an intraday 40 trades a day scalper, or somebody that just looks at getting in and out of the market for 10 ticks. I'm looking for longer term trades. They go on for a week, maybe 2 weeks. I'm looking for decent R rates. If you know what an R rate is, it's your risk against reward. So most of my trade setups will offer an R rate of between 4 or 5, and that basically means that I can potentially get 4 trades wrong and 1 trade right and still break even. So patience is a key part of my game. It can also be extremely boring, but I do work in the Discord channel at FX Street Premium channel, and that keeps me focused from Monday to Friday, basically. So let's get to the charts. This bottom middle is a monthly chart, then going left and then up. We've got the weekly chart, daily chart, 8 hour chart, 4 hour chart, and the hourly chart. And basically what I'm looking for is I'm looking for chart formations, cipher patterns initially, a little bit of Elliott wave in there, which is 5 waves up, 3 waves down. Sometimes a cipher pattern will also have an Elliott wave element within it. So I'm looking for a single currency that basically turns around and says you really should be buying this. And then I want to look at correlation. I did a white paper, if you like, for the Society of Technical Analysts quite a few years ago that was entitled "Correlation is King." Okay, I want correlation. I want one currency to tell me that I should be selling it, another currency that should be telling me I should be buying it. But then I also want to look at the cross currencies to make sure that they're in line, if you see what I mean. So in other words, if I want to be selling the dollar, the US dollar, I want to be picking my best currency that I should be buying the US dollar against. That could be euro, it could be yen, it could be Canadian dollar, etc. I'm looking for the best one, but I also want most of those dollar crosses to tell me that I'm going in the right direction. In other words, I don't want one of those dollar crosses to turn around and go, what the hell are you selling dollars for? You know, this is clearly a buy dollar situation. So I'm looking at that correlation. So this matrix, if you like, needs to fit into place to produce a trade idea. So along the right hand side here, you'll see the different baskets. I have these 2 of these baskets are given out, or they're made by the market already. So DXY is a weighted basket of the dollar index. JPY, you can get that on TradingView. That's a Japanese basket. These single currency baskets I've made myself. So basically, as you can see there, or I hope you can see there, in fact, if I click on it and then go to here, it will show you how to actually make a single currency basket. So it's all, I'm looking at 8 currencies. So all the crosses are 7 crosses. So euro, dollar, euro sterling, euro Swiss, euro yen, euro CAD, euro Aussie, euro New Zealand. And if you put this asterisk in between on TradingView, that will combine the price. Okay, it's not an overlay, it's a combination. So this is combining all the different euro crosses to give me a single currency. It's an unweighted basket, which basically means that the dollar has the same weight as sterling, has the same weight as Swiss, and it works for me basically. So I've got these 8 currencies down the right hand side. If I go to DXY, which is the dollar index, and I always talk about a catalyst. So for big market moves, we normally need a catalyst, and that's news driven. Okay, so tomorrow we have PCE. So if we go to this chart here, this is the 8-hour chart. We've had an initial sell-off from this. So this is the drive higher. Then we have this retracement lower. This is a 61.8% Fibonacci level. That's located at 101.92. We then get this drive to the upside. Now, that says a stalling in price action close to 61.8%. Elliott wave enthusiasts will normally say, well, this is 5 waves up. This is 3 waves down. I've hit 61.8%. I'm going to rally higher. I'm going to break the highs. I'm going to go up in wave 3. Cipher pattern analysis says, well, that could be just the first wave. So this is your A, B leg to the downside. And then you get this CD leg to complete the 3-wave pattern. So this is a 3-wave corrective pattern. Common retracement levels for the BC leg are either, and I'm just going to click on that, 38.2% or 88.6% of the last decline. Now, why are these patterns attractive? 2 reasons. The first reason is when it completes, there's a very good possibility that the dollar will move to the upside. Okay, so you've got a completion pattern and then some decent follow through bullish momentum. Also, if you can catch the BC leg near the swing high, i.e. at 88.6%, where is your stop loss? Well, this pattern would be broken if the market moves above there, okay, above this previous swing high. So suddenly you can formulate a risk reward trade setup, okay, because you can say to yourself, okay, well, I quite like this and I believe that the dollar is going to get sold, and I've got a catalyst. I've got PCE data tomorrow. If I'm wrong, where's my risk? And that is what every single trader, whether or not they're institutional or retail, should ask themselves: what is my risk? What is my reward? Recently did another talk, and at the end of the talk, somebody said to me, what is the most important thing that you could tell somebody at the start of their journey? And I said that you've got to trade the plan, and then you've got to plan the trade, and then you've got to trade the plan. And you do not move your stop loss, you do not move your entry, and you do not move your target. Because if you do, then you completely skew your risk reward. And it's all about winners and losers, and making sure that your winners are a lot more profitable than your losers. And there's a great book, digressing a little bit here, but the great book that's just come out by an old friend of mine called Steve Goldstein, that's called Mastering the Mental Game of Trading, and he talks about this subject quite a lot. So 104.30, you've got your potential entry level, which is the 88.6% pullback of this decline. Where's your target? Well, your target is the completion of the Gartley formation, which is located at 101.21. So selling at 104.31, 104.30, targeting here with a stop loss above the swing high, because that pattern will be taken out if it breaks here, gives you an R rate of 7. So when I say that you know, my job can be boring and I have to wait for setups and etc. etc. Yes, but patience is key, because when you are patient and you do wait for these setups to fulfill, then you get good risk reward levels. And the only downside of swing trading, as far as I'm concerned, is the carrying costs. So sometimes if you've got a large position and you're the wrong side of the interest rate differential, I'm not going to start going on about that, you'll end up paying the broker every night when your trade rolls over, because you're doing spot. If you did futures trading, that'd be a completely different ball game. But because you're spot trading, you could be paying the interest rate differential. On the flip side, if you're on a certain way round, in other words, you're buying that currency cross, then you will get paid the interest rate differential. So sometimes it increases your P&L, sometimes it decreases your P&L. But so that's the 8-hour chart. Okay, this is the reason why we have multiple time frames. What I also like to look at is something that is readily available on TradingView, and that is this button here. And if I click on there, you'll see that you get these red and green areas. Okay, and that's called the smart money concept. There's really, I'm fanatical about reading books about trading and psychology, etc. And I've always got 2 or 3 books on my desk, even though I've been in the market since I was 18 years of age. I can't find anything decent on SMC, which is Smart Money Concept. I've scoured Amazon and Harriman House and all these different places for financial books, and there's just nothing decent out there. There is a fair bit of YouTube videos that you can watch, but I only use it really as an overlay, so I'm not getting too in depth with Smart Money Concept. But what we have here is a supply zone. Okay, so moving higher, you've got a supply zone, you've got an 88.6% pullback level. What else do we have? Well, this formation is called an expanding wedge pattern, and an expanding wedge pattern has a bias to break to the downside. So you're building up a picture. We're looking at the matrix and we're building up a picture, and we're saying, okay, risk reward's quite good. The daily chart is highlighting that I've got the potential, and it's only potential because, you know, the data released tomorrow could be higher than expected, and the dollar could rally and it could just take out the swing highs, and then this trade is gone. But it could also go in the other direction. We can't forecast the future. What we can do is we can get risk reward setups that are in our favor if that data release comes out in our favor. Okay, so we've got this bias on the dollar. What about the crosses? Okay, so that's when we go over to our other view. Let me just get that off the chart for a minute. I'll leave it there. Then we go over to our other view. So on the right hand side here, dollars, I've got all the different dollar pairs on a watch list. So here's all my different watch lists. My main one is FX list, but I'm looking at just dollar crosses. So I want these dollar crosses to basically turn around to me and say, yeah, okay, this is quite a good opportunity to be selling dollars. Which one's the best one out of all of these different crosses? So we go to euro dollar. What's it telling me? Well, here on this time frame, okay, I've got virtually the reverse of what I'm seeing in DXY. This is what's known as a Gartley formation. It will complete here around about 107.56. So going back to DXY and going back to single currencies, can I see a reason for the euro to go higher. Okay, so I want two currencies to be moving in the opposite direction, as I said. And if I go to this time frame here, we can see that we're coming into this supply zone. Okay, and I've also got some support just down here at 641. So I've got dollar lower, potentially lower, euro single currency basket potentially higher, and I've then got euro dollar completing a bullish Gartley formation at 107.56. Now you might turn around and say, okay, that's fair enough. I can see the potential for this trade. Where do you place your entry? Where do you place your stop? Where do you place your target? And this is where it becomes a bit more interesting. So I know my entry, because my entry is the completion of the pattern. Where's my stop loss? Well, the pattern gets broken if I move below this previous swing low here. But where's the target? And that's the real issue with this setup. Okay, and then you might sit so say the target is the previous swing high. This is only given a risk reward setup of 1.65, which is poor. Every trade setup, I believe, should have a minimum requirement of 2-to-1 risk reward. So that, to me, is not a good trade. But hold on a second. Where is my stop on DXY? So if I go back to DXY, I go back to this 8-hour time frame that we're talking about. I know where my stop is. Okay, so even though I don't have, I'm not going to put a hard stop on the euro against the US dollar. I'm going to place a hard stop in DXY. So basically what I have a tendency to do in these situations is that I'll place a line across the swing high. I'll then set an alarm on that line. And basically if that line is breached, the DXY index, pattern index, is broken. And because that's broken, there's a very good chance that this isn't going to hold. And in fact, euro dollar's just going to break to new lows. Okay, so the actual stop, if I take a long entry at 107.56, the actual stop's more likely to be around here. Okay, because of the break in the DXY. I hope that makes sense. So I'm not really trading euro dollar. I'm really trading the dollar because I want to be short of the dollar. The euro is just the best cross as far as I can see to take this long opportunity. If I go to the other crosses, sterling dollar, then again, is there a reason for me to be selling dollars? Well, yeah, this is an ending wedge pattern. We've got a 161.8% extension level down here. The measured move, which is MM, of the expanding wedge formation is 125.35. And I've got some support levels down there. So that's basically saying to me, yeah, okay, so the immediate bias is still bearish. But again, that's highlighting buying dips in DXY. So that sort of gets me set up for tomorrow. So I'm not rewriting these charts sort of on a daily basis. Not the swing chart. So this is an 8-hour chart. I'm not really fiddling around, if you like, with the weekly, the monthly, the 8-hour, the daily chart. What I'm looking at is I'm then breaking down into shorter time frames to try and get better entry levels. So that's how I foresee potentially the PCE data unfolding tomorrow. What we should also look at is stock indices, because we said we'd talk about those briefly, and then if I've got time, which I'm not going to have time, we've got 6 minutes, I wanted to talk about the Japanese yen, but that will have to wait for another day. So going back into the watch list. So there's two ways that I can formulate a trade plan. I can formulate it with using correlation, which is the overlay of the single currency baskets on top of each other, then using cipher pattern analysis, etc., 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 to highlight entry levels, completions, etc. Or there is predictive analysis. So these dashed lines are my bespoke support and resistance levels. Okay, and basically, if I can get a formation to line up with these important support or resistance levels, then it will sometimes highlight at top. What I don't like about trading this format is that it's not stagnant. These unlike a cipher pattern where I've got an exact level where it will complete, I've got an exact level where it will break. When it comes to these support and resistance levels, they move with price. So as price moves higher, these will move higher. These are a system that I developed about 12 years ago, and I got a guy to write me a program for them, and it basically highlights support and resistance levels. But if we go to the DAX, and I've just put demand, these are the demand levels with regards to SMC, smart money concept. It's highlighting that we've got limited upside. Okay, so basically the potential of a top here, wave 1, wave 2, wave 3, wave 4, and then down in wave 5. So 186.32 is a projected top. Like I said, if the market gets to 186.32, then it will probably move to 186.50. So what I have a tendency to do for this instead is I prefer to wait for a swing high to be put in place. I then trade the bounce in wave 2, and then trade the completion of the 5-wave count at basically my bespoke support levels, which is around about 17,380. The reason why I quite like the look of this at the moment is because we're talking about correlation. FTSE's looking pretty toppish, and so are the other stock indices. So if I go to FTSE, I'm going to go to this time frame. Okay, expanding wedge 7995 as a potential top, and then we come down and we basically hit these support levels. So the first support level 7834, the second support 7717, and then the third support and potential 261.8% is at 7590. If I go to US 30, okay, it's a similar picture. Expanding wedge formation 40,125 as a potential projected top, and then the first sort of support level. Notice how I'm sort of overlaying this smart money concept onto where I believe we're going to bounce. So down towards sort of the first support, which is located at 38,429. So basically trading that second wave and then trading again the completion of the full formation. And the last thing I want to talk about, and I'll just squeeze this in my last 2 minutes, is the Japanese yen. This is the single currency basket, and if we go to this time frame, and this is the daily time frame, it's a bit messy because I've been trying to work out where the support and resistance levels are. This is an ending wedge, so the long-term forecast is for higher levels. Okay, so the long-term forecast is for a breakout of this wedge and then for a rally to the upside. But I've got resistance here, I've got a supply zone, and then basically resistance to the upside. So what will normally happen on a wedge formation is you'll have 3 touches on either side, and you'll have a breakout on the 4th touch. So if we look here, we've got 1, 2, 3. So we've got 3 touches on the bottom, 1, 2. We've only got 2 touches on the top. So basically what I think we're going to do is we're going to rally up to wave 1 or resistance in this single currency basket at 6574. We'll then come down in wave 2, and that will be the opportunity to take a medium-term long trade to the upside. Now, using correlation, and I'm just going to quickly cover this one, and it's the only single currency yen cross that I'd contemplate getting on the other side of at the moment, and it's this one. So sterling yen, again, we've got this zone here, smart money concept. We will complete another cipher pattern. This is what's known as a bat formation at 188.34, and I've just put there check VP when at support. That's volume profile, and again, that's another 2-hour talk probably on its own. So I thought I'd finish on that one. So I'm expecting sterling yen to continue to the downside. This is where I'd potentially look to get long. Looking at correlation, it has to be when that yen basket hits resistance. I'm not going to take this if the yen's not at resistance, because there's no correlation, and the yen could just keep going higher. So this could just keep going lower. So I'm looking to marry these different products together. And I believe that is my 30 minutes finished.
Thank you, Ian. Yeah, we're trying to keep them shorter, and
right.
Fantastically, you've gone exactly on schedule. We do have.
I can waffle on for a lot longer.
I'm sure. No, listen, that was tremendous. We hear a lot about smart money concepts already. I was chatting to Andrew Lockwood at the City Traders. He's coming on at lunchtime today. He was talking about smart money concepts as well. So we'll learn a bit more about that.
Yeah, tell him to write a book on it, because I'd like to read it. I don't seem to be able to find any.
I think there's books. I know that Gavin Holmes did something as well on the smart money. That's been his thing for quite a few years, actually. Looking at volume spread analysis. Anyway, listen, thank you so much for that. Does anybody have questions? There were 1 or 2 questions that we've just got a few minutes to look at. If I can bring up there we are. Yeah. Adi was saying, is the Gartley, the cipher patterns, are they TradingView or your own FX Street add-on?
There are. If you go into indicators here, there are indicators within TradingView that will give you cipher patterns automatically. I don't use them because I don't find them accurate. What you need with cipher, there's a great book. It's called Trading, not Trading in the Zone, Trade What You See, and that is all about cipher pattern analysis and formations. The trouble with the automated stuff is it tries to guess where the patterns are, and most of the time they're not accurate. What you need on a pattern is you need it to be pretty close. So when these Fibonacci extension or retracement levels collide, that point structure needs to be, within, I don't know, maybe a quarter of a percent. You don't want to be guessing where the in the FX Street Discord channel, I'm constantly posting chart formations.
Is that
giving a bias and stuff?
Premium only, or there's some stuff that you get for free on there?
It's premium only, but we have a discount at the moment. It's $9.99, I think, is for the first month. To trial the service. Some of our reports do get obviously republished on the main site, but all of our stuff is in the Discord channel. And what happens is we write the main core of analysis every morning, and then it's like a request service. So if we haven't written a report on DAX and you want to look at DAX, or you want to look at Nat Gas, or you want to look at whatever product you like, then we write reports for them. As you know, Yohei, you know him quite well, Simon. He's very he's a fundamental trader or analyst. So you've got a real combination of all of everything you need, I believe, within the channel. So you've got fundamental, you've got technical guys. Gil's very fundamental. You've got Ross, who comes in in the afternoon. He trades smart money concepts, so he's far more intraday. And then Khalid is a great analyst and trader, and he has a combination of everything basically.
That sounds fantastic. There's everything you need. So if you're interested, and by the way, thanks Ian for getting us started off this morning. It's been great.
My pleasure.
Just one quick question. Anita said, do you ever add winning trades?
No, I don't filter in and I don't filter out. I used to work with a guy that used to say add in and always win, but that mantra doesn't work.
You plan your trade and then you trade your plan.
Yeah.
That's what you said at the outset.
Yeah.
Ian Coleman, fxstreet.com is where to go if you want to see more of what Ian has to offer. Thanks so much for joining us this morning.
Thanks, Sam. Appreciate it.
To our next speaker in the next thing. So we'll switch this session off and we'll pull everybody through to the next session where we have Darren Sinden. So thanks, Ian.
Thanks. Thanks very much.
Happy Easter.
Yeah, and you. Thank you.
Okay, good morning. Hopefully you can hear and see me. It's Simon Campbell here. We are just welcoming Darren Sinden to our Round the Clock Trader event. Darren, if you're there, you'll be able to see a little invite for you to accept. It should bring you up on the screen. Hopefully you can see that okay. Guys, if there's any questions, just while we've got a couple of minutes, go ahead. And there's Darren. Good morning.
Hi, morning. No, I think I'm okay. After Ian's exceptionally technical performance, I think might be a slightly slower pace. And I've just created a series of PowerPoint slides, to be honest. So wasn't intending to throw any live charts into it.
No, that's absolutely fine.
I possibly can, but I think mine will be a relatively static affair.
No,
but, hopefully informative nonetheless.
Thank you, and it's good of you to give up your time this morning to join us, Darren Sinden. Just to sort of welcome you and to say that you've had a career in the city. I don't want to underplay it, but you've worked for many of the major banks over the years.
Well, one really. The bank was Barclays, BZW, but lots of brokers certainly.
Yeah. And now you provide content and analysis for
independent market commentator is how I sort of how I bill myself. But yes, I do provide content and analysis for a number of
good content analysis. Everybody there is on LinkedIn. Just follow, just look up Darren Sinden, and because you've got stuff coming out every day, which is fabulous charts. Darren, can we try the share screen setting? If you go down to the bottom right, you should see or you should see the middle button that says share something beside the webcam.
Yeah, okay. I'll share this.
And then we'll try to get your.
Should I just do screen to begin with?
Just do the screen where your slides are.
Okay. Well, they're here. Okay, so I think. Should I do them over here? Select window or screen, okay. Can you see that now?
Yes, something's coming through. That's fantastic.
Okay, let's just get that into a viewing mode.
Wonderful. That's great. That's great. Can everybody else see that okay? I think that's fine. Yeah, I think we're all good to go. So thank you for joining us, Darren. Again, I just asked you to come on and provide us with a sort of an overview of the stocks and maybe one or two of the stocks that are catching your eye already this year, or maybe something that you are looking forward to. I mean, this year's election as well. We've got US and UK elections before the end of the year, so I wonder if that will have an impact on the markets. But let me hand over to you, if I may, and let you tell us what you're looking at.
Good morning, everybody. As I've just been saying to Simon, I think Ian will be a hard act to follow. My presentation today is going to be at a slightly gentler pace. And given that this is effectively the last day of the first quarter of 2024, end of the month as well, I've decided to give you an equities end of term report. So without further ado, let's press on. First off, let's talk about who I am and what I do. So these days, I'm an independent analyst and market commentator. As Ian says, I am a veteran of the financial markets, and I do have almost 40 years of experience under my belt. So you can probably tell by the grey hair, what was once a mousy blonde. I like to analyse the markets using what I think is quite a unique blend of technical and fundamental analysis. And I look at the markets from a macro or top-down perspective, but I like to back that up using data to try and create a rounded approach. Now, I will just say a couple of points on top of that. The older I get, the less I'm convinced that there is any kind of secret sauce or special recipe for successful trading, and the more I tend to believe that the ability to succeed resides within each of us, and it's about pricing that out. And for me, that means developing yourself rather than spending thousands of pounds on fancy systems and expensive courses. That said, each one of us is an individual, and each of us has to find the method or process that speaks to us. And once you find that, life in the markets becomes that much clearer and that much easier to manage. Now, it's interesting that we meet today because one of my great heroes unfortunately passed away yesterday. The Nobel Prize winning psychologist Daniel Kahneman. For those of you who don't know who he was, I strongly recommend that you look him up and you read his works and look at the TV programs about him. He created basically the science of behavioral economics, and that's very, very important to the psychology of overall trading. But without further ado, then let's press on to the presentation proper. So, who was top of the class in the first quarter of 2024? Now, interestingly, despite the media hype, it wasn't actually US indices that outperformed so far this year. And here's a table of what I consider to be the major equity indices around the globe, the ones I track on a daily basis. And these are ranked in their year-to-date percentage change. So weakest at the bottom, strongest at the top. What's been the best performer? Well, perhaps surprisingly, it's the Nikkei 225 index. We all know the problems that Japan is going through at the moment, but they haven't held the stock market back. And in fact, as you can see, it's far and away the best performing index out of this major group. And in fact, if we were to expand this table to include emerging markets, even the likes of Turkey, well, they wouldn't be outperforming the Nikkei 225 by too much. So quite impressive, really, for one of the world's largest equity markets. And as I say, given the state of the Japanese economy, well, not too far behind and in this group I've highlighted here with a bracket, are things like the Euro Stoxx 50 and the German DAX. Quite a lot of parallels between the German DAX and the Nikkei 225, in as much as both economies are in the mire, perhaps Germany more so now than Japan. But nonetheless, that hasn't held the DAX back, and it certainly hasn't held the Euro Stoxx back. Now, the Euro Stoxx 50 is basically made up mostly of German and French equities. I think it's 68% or so of the index is made up by those two countries. The one commonality between the top three in this list is that the stocks that the significant stocks within the indices are exporters. A weaker currency is good news for export-led countries. It is also true to say, of course, that exporters are not facing the domestic economy. So the domestic problems in Germany, Japan, and to a lesser extent France are not hindering equities from those countries. And the same is true of Italy. Look, I mean, Italy up 9.2%, another potential basket case of an economy. Nonetheless, its export-led economy is supportive of exporting companies, and 9% gain there as well. Similar story for Spain. So that's where European equities are. European equities look remarkably cheap still relative to their US counterparts. So don't be surprised if we see more of this coming through over the next 9 months of the year. Whether it will happen at quite such an expansive rate is debatable, but there is certainly scope for further gains in European indices, particularly among the leading stocks. And there's been plenty of talk this week about hedge funds moving out of US equities and into what they consider to be cheaper European names with more potential for upside. Just a quick word, of course, about the major US indices. I should also say that this table was drawn yesterday morning, so we don't see last night's rally in here as far as US equities are concerned. We can put on a percent probably on most of them, but it doesn't really change the structure of the table. The S&P, the Nasdaq, and the Dow have all lagged many of their major competitors. Obviously, that might not be so surprising given how well they've done over the last 2 years, but we're focusing this morning on just the last 3 months, and that's where we sit. For some sort of comparison, FTSE up around 2.6 to 3% on the year to date. If we looked at this table on Monday, we wouldn't have even seen gains to that extent. Maybe that's telling us that the value in some of the FTSE 100 names is now being recognised. One or two takeovers, of course, in the mix. DS Smith, the latest candidate to fall under the gaze of one or two potential bidders. And on balance, the FTSE does look relatively cheap. Again, a relatively weak currency will favour overseas buyers, and there are plenty of cash-rich US companies, as we know, and plenty of PE and venture capital names out there with their pocket stuff of cash as well. So don't be too surprised to see more bids in the FTSE and probably some further gains in the FTSE, but nothing to the extent of the names up here, I shouldn't think. A quick word on the laggards, Hong Kong and China. We all know the issues dogging those stocks, political issues, concerns about Chinese property companies, and the amount of debt that's been piled into that sector, the effect that has on local authorities in China, and just generally the sluggish failure to launch really of the Chinese economy since they abandoned their austere lockdowns in Christmas, in the run up to Christmas 2023. Okay, so let's have a little bit of a deeper look at that Asian influence, the performance of the Nikkei, and how that has played out, and how we can look at that and take advantage of it. So it's not rocket science. We touched on it just now. The Nikkei and the yen have been in lockstep. This is a market purely, in my opinion, being driven by the weak currency. The weaker yen makes Japanese exports cheap on a world stage. I think I'm right in saying that the yen's given up 26% against the dollar in this quarter. Most of the world's important commodities and goods are typically priced in dollars. So if you're a dollar buyer of Japanese goods and services, you're getting them at a huge discount. That yen weakness has continued despite the Bank of Japan making what for it was a monumental decision to move away from negative interest rates and to end its policy of yield curve control. So it's no longer going to try and peg Japanese bonds to a fixed yield or interest rate, and it's no longer going to have negative interest rates. Japanese interest rates are now at 0. That doesn't mean that the bank's going to race hell for leather and start raising yen rates. That's not how the Bank of Japan works. And I think the market can sense that, because despite, as I say, interest rates rising in Japan, the yen has continued to weaken. It traded through 152 earlier in the week. So I'm asking the question now, is this another one of those periods where the Bank of Japan appears not to be in control of the currency? And we've seen a number of those over recent years. Remember, the yen is a huge funding currency. Plenty of people will borrow yen or buy yen and then sell that or swap that into a currency such as the Turkish lira, which for a massive yield pickup, obviously there's an inflationary item to consider in Turkey, but nonetheless, that's what a carry trade. The Mexican peso would be another obvious example of a carry trade. People are doing that, selling yen to effectively get access to cheap funding. And the yen will continue to weaken, I think. I think if it goes through 152 and stays there, it can probably go to 160. That would be another buying opportunity, I believe, or potential buying opportunity for Japanese stocks, Nikkei 225 stocks. Not the easiest things in the world to trade. Not everybody does them. They're not necessarily all household names. And so some kind of pooled vehicle might be better. The index itself perhaps, or an ETF. But I just wanted to highlight some of the performing stocks within the Nikkei 225 over the last 3 months, and there you can see there are many high double-digit performers, a couple of triple-digit performers in the list. Even if we're getting down to sort of midway in the index, it's not quite midway, probably a third of the way, we're still seeing 20-30% gainers, and there are many more. So it's a very interesting market. All sorts of potential within it, and one I certainly think that we should be keeping an eye on in the coming 9 months. But the key, as I say, is what does the yen do? I watch it against the dollar, but yen weakness is positive for the Nikkei. Yen strength is negative, and I think you can trade that quite simply and straightforwardly as a process, a style in which to know the colours to the mast, as it were. All right, technical studies. So we'll look here at a few slides in a bit more depth. The first thing I'd like to ask is the S&P 500 running out of steam? Now, that might seem to be a funny question to ask after a pretty decent rally in the US last night. But my take on that rally was that it was predominantly end of quarter, end of month window dressing. And the reason I say that is quite simply, if you look at the stocks that were making significant gains, they weren't what I would call the important stocks. And if you look at where the volume was yesterday, then it certainly wasn't with the mega caps. For example, Microsoft traded just 77% of its average daily volume. And that's not really indicative, to my mind, of sort of a balls out rally, one where everybody has to get involved. Now, again, this is a slide that I drew yesterday morning. And what this particular slide shows you is the percentage of stocks and sectors constituents that are above key moving averages. So 5, 20, 50, 100, 150 and 200, you get the idea. We start with the S&P 500 and we work down through individual sectors. Now, I use this as a gauge of momentum, a gauge of short-term sentiment. Yesterday morning, things were looking pretty poor, particularly in sectors like real estate and utilities. 7 and 13% of stocks only above their 5-day moving averages, and stocks that have been leading the way. Information technology, just 27% of those stocks were above the 5-day moving average. Now, if we drew that table today, you'd see all of that red turn to blue and most of the figures in the high 70s and 80s. And so it was a complete turnaround as far as sentiment was concerned yesterday. I almost considered redrawing the slide, but I haven't done. And I'll tell you why. Because, as I say, I think it's window dressing. I think next week, when we're back in the market properly on Tuesday, we'll see a revert to type, if you will, and the market behaving as it has been or had been up until yesterday. For instance, here a downtrend in the number of stocks that were trading above their 5-day moving average, and this downturn kicked off at the beginning of December. Now, to be fair, if we were looking at this indicator now, we'd find it back up here, back up towards the highs. But I don't think it will stay there. I think we'll see it drift off again. And I'm going to explain why I think that the S&P is perhaps running out of steam in the next couple of slides. Okay, so what was my thesis? Why did I come to this conclusion on Wednesday morning? Well, partly it was driven by a table like this. Now, I find this major market sectors table really interesting. All of these charts here come from barchart.com. That's the platform that I use the most. It's a brilliant piece of kit. It takes a little bit of getting used to the way that they set it up and lay it out. But I find it invaluable. There are free services. There's a £10 or $10 a month service that you can subscribe to. I pay for the premium service, which works out about $25 a month. But as I say, I find it invaluable. With the premium service, you get the ability to create watch lists, store chart types and templates, etc. But if you want to just kick the tires of the service, by all means, have a look at the free service, because you will find it very useful, I'm sure. So what do I take away from a table like this, which shows us the performance of the S&P 500 sectors, in this instance over 5 days? Well, I like to look at this column here, which I refer to as the sliders column. What we're seeing here are the lows and highs of a particular metric, in this case the S&P 500 index, and the bar in the middle shows us where we were at the close on in this case Tuesday evening. But as you can see, very few of the sliders, if any, perhaps with the exception of healthcare, were anywhere near their highs of the day, and many of them, including utilities and real estate and information technology, were closer to the lows than they were to the highs. And so what that says to me is that sentiment was poor. There wasn't any follow through. Sellers were really in charge of the session. Bears had the upper hand, if you like. And what's interesting also to me is then to go and compare that 5-day performance with the 1-month performance and the 3-month performance in this case, or year-to-date performance in this case. Slightly different, of course, on Wednesday to the 3-month. That's I think, or I thought that was the prevailing trend, and I'm still inclined to think that is the case. Of course, if we look at the 3-month trend, then we're fine, or year-to-date trend, then we see that it's more on the bullish side. And of course, it would be, given the 9-10% gains that we've seen in the S&P overall in the last 3 months, with the 1-month view somewhere in between, though still with a number of stocks away from their high points. And that's the other point as well, isn't it? Okay, we're finishing on a bullish tack, but we haven't made new highs, and we're not about to, as far as I can see. And until we do, I'm not going to be dissuaded from my slightly bearish thesis. I'm trying to move away as well from dogma, bear, bull, etc., etc. I think it's too easy to get attached to these labels and start to believe in them too much. But what I would say is, if we think about things in the way of supply and demand in terms of sentiment, particularly in shorter time frames like this, then that's an easy way to view the markets. But don't get hung up on labels. And as I often say, try and be pragmatic about the markets, not dogmatic. Go with the flow rather than forcing yourself to try and be right every time and trying to work out why things are happening, because often as not, that won't serve you at all. Trend is your friend, and that's what you should follow, would be my overall advice. So the question that formed in my mind, having looked at tables like that, is the Magnificent Seven premium wilting. Now, we all know about the performance of the Magnificent Seven and how well they've done, and how they kicked off the year with a massive bang as AI, or the narrative around AI got a huge boost, and Nvidia led the way, and we can see that outperformance in the first chart here. And actually, what I can do is magnify this slide so it makes life a bit easier for you to see that. The red line is the cap weighted S&P, and the black line the equal weighted version of the index. And the difference between this is percentage change as well, year to date. No, it's not percentage change over 2 years. My apologies. And we can see a significant premium between the two. 6.39% for the equal weight S&P. It's the percentage change over the prior 2 years, but 16.12% for the cap weighted S&P. And of course, the reason for that simply is that the mega cap stocks had been making the running. If you weren't Microsoft, Nvidia, AMD, at some points Tesla, and Amazon, then you weren't really in the game, and that's borne out by that outperformance. However, if we look across to our second chart, I better just explain what this is. Sorry, my apologies. Let's go back. If we look across to our second chart, and this is the S&P minus the equal weight S&P. So it's effectively a line of the premier in points between the two indices. And what we can find is that since the beginning of February, that premier has been falling, and falling quite sharply. You can clearly see the downtrend here, and what I'm suggesting is, on that basis, that the Magnificent Seven are running out of steam, that their superiority is perhaps fully priced in, and that people are maybe thinking again in some circumstances. I think that's probably easiest to spot in the table here at the bottom, which shows you the Mag 7 and their performance. And if we look, for example, at the year-to-date change in Tesla, well, it's down 28.5%. In fact, pretty much all of that loss has been racked up inside the last 3 months. 30% over a 3-month measure, it's down, and 10% of nearly 11% of those losses have been racked up in the last month. And of course, above that, we can see Apple, which for a long time was the world's largest company. No longer, of course, that crown ceded over to Microsoft, but Apple is down 12% over 3 months, 11.85% over the year to date, or at least it was as of Wednesday morning. Neither of those things are particularly bullish for those of us who long of the Magnificent Seven in its entirety. Yes, Nvidia, of course, is still flying the flag. It's up 87%. But my thesis here is that there is drag on the outperformance of the Magnificent Seven, and I think it's quite likely that will continue. Just think about this, really. At one point, I wouldn't have even considered shorting Tesla, simply because it was effectively like a cult. You couldn't have a sensible conversation with people about what the potential downside for Tesla was, and you would have just got your arse handed to you on a plate, if I can say that, if you were short. But that's no longer the case, and I wonder what's changed in the mind of the Tesla acolytes to make that possible. Got to think that something like that could happen in Nvidia and in some of the other Magnificent Seven stocks as well. Now, that brings me to this slide, which encompasses my favorite piece of research on the market ever. It's not something that was published recently. It was this report, the Eye on the Market Special Edition, The Agony and the Ecstasy by JP Morgan Asset Management. The good news is that you can find this report freely available online just with a simple Google search. What the report did, it was intended to basically persuade some of JP Morgan Wealth Management's customers to diversify their portfolio where they were heavily invested in single stocks if they were business founders or owners. And they the analysts set out to look at the life cycle of American stocks over the preceding 33 years. So this research was conducted in 2013 and went back all the way to 1980. They looked at a universe of 3,000 Russell index companies, and they found some quite surprising things. That basically 40% of all those stocks had over their lifetime suffered a permanent 70% plus decline from their peak value. And what really stood out to me, and always has, was the fact that for technology, biotech, metals and mining, the numbers were considerably higher. And so, yes, technology stocks, some of them have been massive money makers, some of the biggest money makers of all time. But for those few stocks that go on to make huge amounts of money, there are plenty more, perhaps more than 70% of the stocks that will actually suffer. 40% of the stocks plus will have suffered a 70% decline from their peak value, and which they potentially will never recover from. And so, I think that's something to really be clear on. Stocks have a life cycle. Just like animals, human beings, the economies, they are cyclical. They peak, and then at some point in the future, they decline. Don't be too dogmatic. Don't get sucked into believing that markets are a one-way street. They're not. Read this piece of research. I promise you won't be disappointed. Yes, it might be coming up for 10 years old, but everything that it says, to my mind anyway, is still very relevant indeed. Okay, so one final slide as far as the US markets are concerned, and this again was drawn on Wednesday, but it's my take on what I think can happen in the US market. I've drawn this slide over 4 months rather than year to date or 3 months, just to give us a picture of where we came into the year. A solid uptrend all the way from early December. The uptrend itself has been supported by the 10-day simple moving average here, which is what this turquoise line is. I've penciled in some key levels. The first one being 52.61, which is the all-time high of the S&P. And even in yesterday's rally, we didn't actually trouble that again. I don't think we will do in the near term either. And my focus really has turned to the downside, and a potential break at any rate of the 10-day moving average. I think if we do move below that, which is now just above 5,100, I believe, then we do have downside potential to 4,900, 4,800, and 4,700. Nice and neat, a series of 100-point steps, but they are support and resistance levels as well. So I do think that we should look out for that and potentially a move to 46.50. I don't think that would be an unhealthy move for US markets, particularly to blow some froth off. It shouldn't be a one-way street. Don't forget, we've got first quarter 2024 earnings coming up on the 12th of April, just before the 12th of April, to be honest, but the major banks start reporting on the 12th of April. So that could potentially be a catalyst for a little bit of a disappointment after an amazing run in the first quarter as far as equity markets were concerned, and perhaps the catalyst for a bit of a profit taking and maybe a sell-off and a pullback, which, as I say, I think would be healthy. So, just on time, that's more luck than judgment. I just want to say thank you for your time today. If you are interested in how I approach the markets, what I have to say, and want to know a bit more about that, where can you find me? Well, you can find me on LinkedIn, as Simon said earlier. a regular poster, almost a daily poster on LinkedIn, and I share my views and my ideas there. You can find me on the Think Discord. You've got to pay to be a member of that, but it's a very interesting trading community, and one I can strongly suggest that you check out. We approach the markets in a very different manner to many other trading communities, and it's a very good thing to be a part of, is my honest appraisal. You can find me on Active Trades, the broker's website, where I write bi-weekly. Plenty of articles there about all sorts of topics, how to trade, what I'm looking at, trading indicators, a whole range of things. And you can also find me on the financial comparison site, the Good Money Guide, which looks at all kinds of personal finance issues. And I write about that, and also for the premium section, analysis on the markets and asset classes. Thanks very much for your time.
Okay, so everybody should now be in our third session, Options Masters with Yanis Kantarsis. Let's see if we can bring Yanis in. He's here in the room. So Yanis, you should now have okay. Let's see if we can get Yanis on the screen. That's him pinging me on the phone. I'm hoping that he's being able to just press the right button to accept the Enter. Okay.
Whoa. There you are.
You're here.
Too many questions. Too many questions. So I've sent you the article. If you can please populate it.
I'm not sure if I'll be able to do that right now. Yeah.
Okay.
Yeah. But anyway, listen. Welcome to Round the Clock Trader. This is Yanis Kantarsis. Coming live from not Athens, is it? It's where are you?
It's Thessaloniki, Simon.
Thessaloniki, right? The other mate. It's a big city, isn't it?
Which one?
It's like the second city of Greece. It
is. Yeah, it's more like Barcelona, but yeah, it's quite nice. Quite nice.
Good to have you here, because we met in London all these years ago, and I know you worked CMC, quite a few of the brokers, investment banks. You took part of the Traders magazine, which I think you do for the Greece and the Spanish edition. You train, mentor people in option trading, speak at various conferences. The list is long, so you're good that you're here. You are the only speaker on for us today. I'm getting a little bit of feedback. I don't know if that's the same with you or. That's better. That seems better. Let's see if we can share the screen. Do you have the same? Yes.
I think you're breaking up a little bit. I can hear you.
I'm getting feedback. Let's see if we can get your screen shared, Yanis. So remember, like we did yesterday on the test.
Let me just try. Give me a second, please. So is this the platform showing up?
You're looking at our WhatsApp chat. If you can
stop sharing. Right, you can edit it. I think I have to share a screen. Now you're seeing my platform?
Sometimes it takes a second or two to pop through.
Is it?
Nothing yet.
Nothing yet. Let me just try to share a window instead.
Okay.
Now I'll try to share a window because we tried it yesterday and it was like complicated. Perhaps this can be, So that should be okay now.
Okay, fantastic. Yeah, that's great. Right, I'm going to put our pictures up at the top so that we can get the full screen. And people watching, you can bottom right, there's one of these little sort of square images of scissors and a square. You can press that for a full screen, which will give you a sort of a better view of the platform that Yanis is on. So yeah, we're looking at the Interactive Brokers platform. Is that right, Yanis?
Yeah, that's correct. That's correct, Simon.
And we're talking about, so we've had a look at Forex this morning and the indices. Darren's given us an overview of the equity, the Magnificent Seven, and now we're punching into options. It'd be interesting to find out if anybody here trades options. They sort of went out of fashion a while ago in the UK when spread betting and CFD came in, but now I keep hearing about options more and more. You're a sort of a veteran options trader, so 100%. Maybe you can just explain how you go about using options in trading.
All right, so thanks for the introduction, Simon. So I've been running Traders Magazine, like you said, and I keep doing it for the Spanish market, not the Greek one anymore. That helps me, or I was blessed to interview actually one or quite a few traders in the world, Linda Radsky and Tom Sosnoff and Joe Rose and everyone in between for the magazine. And that was like quite an interesting start of the career of the magazine in both countries. Now, myself have been trading and investing since 1998. So I started here in Greece, and then 5-6 years later, after having worked for a couple of portfolio managers, went to London, as you know. You mentioned CMC Markets, so this is where I spent 5.5 beautiful, wonderful years spreading the word about CFDs in Latin America and the Southern Europe. And then I jumped on Citi, where I got quite a lot of insight into structured options, which we were doing, and selling to institutions. And I took that expertise, and coming back to Greece in 2014, I expanded the seminars from the institutional side and the clients of the brokers and the banks to direct clients. And some of the strategies that we used to do while at Citi, and obviously tailor-made for the retail investor, I'll be discussing today. Basically, one, which I thought it was better to showcase the platform straight away without wasting time on slides and the theory on options. And by the way, I'll be doing a free seminar on that for those who want to subscribe to that. I'll be doing specifically for people who want to be from today's seminar in my free seminar at some point next week or the one after. I'll be doing a free seminar explaining the nitty-gritty of options and the theory behind it, and the exact strategies of the tools that I use and so on and so forth. So perhaps you can send the link for that later. But for now, I brought the Interactive Brokers platform to showcase one of the strategies, both on indices and on stocks and ETFs, that I use to perhaps more often than not produce passive income, if that is possible to say, using options. And if you have any questions, Simon, I can attend, or I can go straight through to the presentation.
I think we're good to get straight on. I would just say some people are saying the screen's a bit hard to see. So just if you hover your eyes down sort of bottom right, not you, Anis, people that are watching this. Well, that's great. You're zooming in a little bit, which helps.
Right.
Or people green, which makes it a lot clearer to see.
Yeah. So I'm doing the font size larger and larger, and I hope this helps. But in general, you pop up the screen, full screen on your laptop.
Okay.
That would be enough. All right. So what I wanted to discuss, and I've written an article on this strategy, Simon. I've sent it to you if you want to populate it later, which cast on the opening. So it's a short strangle strategy. Now, for those of you not familiar with options terminology, you don't need to get into panic mode, because it's quite a jargon that puts off quite a few people when they start investing in options. Now, I'm not sure whether this is done deliberately or not, but options they are difficult in essence because they are based on statistics and mathematics, but you don't need to know anything of that. You just need to know how to use them. And the way they are structured is they populate the prices on an option chain, which is exactly what you see here, right? So I wanted to do today's presentation, especially because it's short in time, a hands-on experience so that you can see how a professional platform looks like and the way we trade it using options. Yeah. So this is Interactive Brokers. I'm sure you'll know it, and I use it to trade all sorts of instruments. Obviously, my experience lies mostly on options, and I do options on futures, which is the S&P in this case, and mainly options on ETFs and some stocks. Why? Because you can use options for whatever trades and ideas you want or like. But the way I see it is like the significant high percentage of people who are new into options or intermediate, they like to buy options. Yeah. And I think this is quite a mistake, because when you buy options, the option itself is against you, because an option is a wasting asset, right? Why? Because it loses value as time goes by. So if you buy something where inherently you know that you're going to lose money only because days go by, then why buy it? Well, people buy because option gives you leverage, which is hidden into this bid and ask spread. For now, for the ETF, XLK, the technology ETF that I have here, or other stocks, I'll showcase a little bit how it works. We don't have prices because the market's open in 2 hours. But we do have for the future of S&P, where I will do the next example. But in general, options are wasting assets. So if you have that in mind and you try to buy options, it's because you are betting towards a direction. And if you're betting towards a direction, whether up and down, and you just buy options and you don't hedge yourself, and you don't use options, you don't use the chain to trade the probabilities of the options, then you are just another guy from the street who trades directionally the markets. Up, he wins, down, he loses. And that's not the point. You don't need me to come on the presentation to tell you that this is wrong, because you're going into a binary type of decisions, again, only with leverage, which is even worse. So people buy options because they use a little bit of money and they have a lot of potential, upside or downside, it doesn't matter. And what they don't realize is 90% of the time they will lose their money. Why? Because it's like a bet. And if you're betting, you're no different than the Main Street guy trading option stocks or whatever there is. So the strategy in general, the easy way and the smart way to use options is act like the casino, not like in the terms of gambling, but act like the casino or the insurance. So what do these guys do? They bet on the large numbers, statistics, the casino on its side saying like, I don't really care if it goes up or if it goes down. So for that matter, if the player wins or loses, because I know at the end of the day, I have a statistical advantage. And that for the casino is 5.4%. That's because, for example, that example is for the US roulette. It's because you have the 0 and the 00. So the casino will always win. They don't have to predict which client or player will make or break the bank, but they will win at the end 5.4%. That's the idea you have to have. You have to be able to make or gain €1 every single day instead of trying to win the lottery one of those days. Because you will win the lottery eventually, perhaps, but it will be once in your lifetime. And there is no reason in going for that, right? The NVIDIAs or the Bitcoin or anything like that. Instead, you can own all of them, perhaps via an ETF or anything. But when you trade options, you just don't need to find the next NVIDIA. You really don't need to. What you need to do is do like the insurances. What do? They sell the fear to people who want to buy. So you insure your house, part of it because you need to, part of it because you want to. The content, etc. Right? You insure your house because you're afraid of getting stolen. You're afraid of an earthquake or whatever. And you're doing it right. You're doing great. And what the insurance does is that they know eventually they will have to pay somebody because his house burned down. But 999 out of 1,000, they will keep the premium of all the rest. That's what you need to do. That's what we do when we sell options. So we collect premiums that other people are willing to pay because they belong to the 95% that they trade markets directionally. And we are the 5% where we trade the markets by reading the option chain here, the statistics and the ads that it gives us, like the casino, the 5.4%. And we're trying to make money, a little bit of money every day, so to speak, by selling the fear to other people. Now that, obviously, you can't have the cake and eat it all, but there are calculators, and one of platforms like this, they will show you the percentages and all the risks that you have. So once you read my article, and I've written it for the largest MTF in Europe, the Spectrum, and I've written it in English, so you have a PDF there that Simon can send you. That details my strategy very nicely. And what it would be, well, you need, obviously, I read the chart, but I don't make decisions based solely off the chart. Because if that was the case, then I would be a technical analyst, which is great, but I'm not. And I do believe the charts are really super interesting. Yeah, so if I go, for example, to the XLK, and I wanted to trade the XLK, and talking to people and various students of mine, you would get. Yes.
Sorry, we've lost the screen share for some reason.
You lost the screen share.
Could you just
the window? It's back again.
Yes. There we are.
So if I wanted to trade the XLK, I wouldn't necessarily go and see, listen, this is a double top or a tendency or a pattern or whatever. No? I'm not saying technical analysis is bad. It's actually fantastic. But the truth here is like we trade on a statistical pace. So if I can see the chart, the only reason for me is to see whether that instrument is going into exuberance. So if it does like the plus 20s, 30s in a couple of days, or the minus 20s, 30s. And if it doesn't do that, then this is a candidate for me to trade an option in it. And what I do is I would sell the fear. So I would sell two extremes. So in that case, for example, I would say, listen, statistically, about 68%, which is one standard deviation. So for those not really versed to statistics, the simple Gauss distribution, now the bell-shaped distribution, the Gaussian, it has a mean and it has a standard deviation. So the percentage of the times that it deviates from the mean, right? And you can obviously apply that to any sample, so the height of students in a given university, the dispersion of the stocks around the mean, etc. And that's how we use to choose the strikes. So when you trade options, you have to choose the right strikes that it will mean, in my case, that I don't want the XLK to go beyond one strike or below the other strike. Yeah, because you sell the two extremes. And by selling, you are selling the premium to someone else who actually wants to take directional bets, either up and down. I want to trade an instrument that actually I can make money if it goes up a little bit, if it goes down a little bit, if it stays where it is, if volatility falls, and I can make money even if that instrument goes beyond my strike prices. But because of another inherent ability or statistical ability of any financial instrument is that of the mean reversion. So you can see that financial assets are mean reverting. They go up, they go down, and then at the end, they follow a certain mean over a time. So you can see here, for example, it followed for like a couple of weeks, then it fell a little bit, go up, down, and in the end, it stayed at the same price. And that helps our strategy. Why? Because options are wasting assets. The more time goes by, the more money, or the higher the probabilities that I keep this money into my pocket. So when I go and say, listen, can I trade the XLK? I wouldn't necessarily think, well, is NVIDIA going up? Is Microsoft going up? Is Apple going up? I really don't care. What I do care is like to find the two levels here. So that level, and I'll show you why it is this level, would normally be that level here and that level here. So I would say that it won't breach either within a certain period of time. What is this certain period of time? Well, options have expiration, otherwise you wouldn't be able to price them. And what do I do? So how do I choose my strikes? One standard deviation away from the current price. Now, Interactive Brokers makes life easier, although there is a formula and a very easy one to calculate the standard deviation. But you can see if I hover my mouse, it will give me, well, this is 208, and in between here, you can see there's a standard deviation. So one standard deviation will be around here, around 10%, okay, away from the current price. And in standard deviation, that is 195. So I don't want the stock or the ETF to drop below 195 by the end of the contract. And there is a premium here that will tell me, well, this is how much money you can make if you prove right. And then I don't want the stock to spike above another level. Which level? Well, one standard deviation, that would be another around here to 22.25. And then I see another price here. So on this platform, I click on the strategy builder because here it tells you the strategies. But before I go into this, I mean, you will need to take a proper seminar on options. That's what I do in general. But for now, we'll skip that because on Interactive Brokers, you can do it straight away. So what I do is like I click on the bid. So if it is 220 or 225, I click on the bid because I sell. And then I go to 195 and I click on the bid again. That's the call option and that's the put option. So essentially, the idea is that I want this instrument to remain between that. And 68+% of the times it will. Why? Because stocks are mean reversion and because I chose the strikes to be quite far away. And unless I see something interesting happen in the tech sector, then that will make me money 9 out of 10 times. Why? Because even if it breaches one of those levels, because of the mean reversion, it will most probably go back within these 50 days that I chose as expiration. Why 50 days? Well, normally we choose expiration between 40 or 50 days for a simple reason, because we want time to be on our side. If I go 85 days or September expiration, it doesn't really make a difference because I don't want to use options for like 4 or 5 months away. It's not like the statistical edge that they will give me. Whereas below the 30 days, options, they do continue to lose value because time goes by, but they tend to get directionality after that because there are other aspects of the option chain that make them more riskier than we would like. These things here, the Vega and the Delta and the Gamma, these are actually the sensitivity factors that affect an options price. How far does it move? How quickly does it move? And where is the implied volatility? Where is the volatility that traders themselves actually project? Now, one more thing when you sell volatility, because that's essentially what we're doing by selling options, their first and foremost volatility trades, is that you have to bear in mind that 75% of the time, the implied volatility is overstated against the actual volatility. In other words, people think that assets are riskier than they really are. So what does it mean? That at the end, as time goes by, as we approach the 17th of May, that will actually bring the asset more to its normal situation. More often than not, the volatility will actually compress to match the levels of the actual volatility, 75% of the time. Now, Interactive Brokers tells you here, okay, so you've chosen your days to expiration because you take advantage mostly of the days passing by. Obviously, you make money out of it, right? Without doing anything, you make money only because the days pass by, because you are a seller. Then you don't want to go by or beyond the 20th day or 18th or 22. Why? Because then all the other factors will come in and it will make it a more volatile trade. We don't want that when we sell options. So we know how to choose our strikes as well, because we choose them for a 70% chance that we make money because it's one standard deviation away from the mean. And we have a high probability because the mean reversion is there to guarantee, in obviously nothing guaranteed, but to say that you will probably make money within that range. Now, I don't trade the Nvidias, the Netflixes of this life, or perhaps the Metas. Why? Because at some point they might do 500% up and down, right? But I can trade the ETF, and in fact, this is my most popular traded ETF because it most certainly makes money. Obviously, of course, because for a year and a half, we are in a bull market for the tech as well. Now, in 2022, that was also bad, but because of the mean reversion, it still made money. Now, the platform here will also show you a profile, and I'll quickly jump on an index because it's open and tradable, and we can see that. Now, here it will give you a graph showing you the short struggle, but what you will need to take a look at is the profitability, 77%, where I can make a maximum of $188. That's the mid price that it took from yesterday's close, because you can see no prices here, right? So, okay, you've got your position. And what do you do if things go bad? You need to have a risk adjustment strategy for when things go bad before I go into the option on the future. So if everything goes well, we will make money and we will go out once, like in 2 or 3 weeks, we can go out of the position because it would have given us about 40% of the maximum gains, which is what we want. We want to go out at 40% because if we wait until the end, there is directionality. We don't want that. So if things go bad, then it depends. Did they go bad straight away, or did they go bad towards the end of the life of the option where we're going out? It makes a difference because then we roll out in next month, because of the time value of money, you will have a higher premium to collect. You will be rolling for a credit, as we say, and then because of mean reversion again, magic, then you will be making about 50% of your losses back in just a few days. That's normally what the case is showing. And then you will not be able to make money from a losing trade, but you are mitigating the risk of losing a lot. And you will be losing half of the percentage that you were losing in the initial trade. And then you should be asking me, so how many times are we losing? Well, the hit rate with that is about 91%. Why is it 91%? Because most often than not, the wings are not challenged because assets are mean reverting and because the one standard deviation gives us a 70% chance to make money. Now, when the bad thing comes, obviously I can lose a lot of money, and this is where the risk management comes into place. And I will explain that in my free seminar if you wanted to subscribe. So basically, we're offered a credit, we roll for the next month, and then it depends if you roll the call side or the put side. Yeah, it depends on the time that you're in. But essentially, something that started to move adversely will not move adversely forever. Now, if we do make that on the S&P, now the S&P has 3 things or 3 ways to trade it. So you can trade the SPX, which is the big contract for the S&P. You can trade the SPY, which is the ETF. You can trade it, not buy it. And you can trade the ES, which is what I will trade. So if I type ES here, and I choose the future is the E-mini S&P. What is the difference? So the SPX is the big contract of future. And so $1 means $100 for you up and down, right? So the contract size is $100 $1 movement, $100. For this one, $1 movement is $50, right? And for the SPY is 10, so we don't want to trade that too much. That's the idea. So you choose the June expiration, and within that expiration, because the S&P is the most liquid index in the world, then you can choose expiration every single day or every 2 days. So if you go to more here, you can choose more and more expirations. Normally, then we would go to 40, 50 days and say we are choosing the expiration of May 31. That would be a little bit further, or I can choose here, 50 days, 43 days. So what do I do? Well, I sell one extreme of the S&P and I sell another extreme on the S&P. Only that here, you will see on the profile that the profit probability is close to 97, 98%. Why? Because how possible is for an index to breach 300 points towards the upside or 700 points towards the downside within 43 days? I guess very little probability. You can lose in between, because markets are going up and down, volatility spikes, etc. But if you hold on to the end, then it's very difficult for you to lose. So let's take a look. If I go and trade, for example, and obviously here there is an art, options is a financial engineering. So for me, it's both a science and an art. But the way you choose the strikes here is a little bit more complicated. You got loads of strikes. The good thing about the S&P is that even if you go the far out of the money options that we call them, so the ones that have a very little probability of making money, on the S&P, you would get loads of premium where you wouldn't get it on stocks or ETFs. So you would get, for example, say on the call option, we sell the 215 call option, the 5675, which gives me 2.15 premium. What is that? That's 215 from the call, and then if I go on the put, I will have to take 2/3 of that. Why? Because we have a bullish bias in general for the markets. As you know, markets go up 75% of the times long term, and because of the mean reversion, still you can get juicy premiums for the put options. Why? Because people will always buy the put options to hedge themselves. A put option is a contract that actually protects you from the downside, right? So people, especially the naive traders who go on the internet and try to find out what option is, will always be keen on buying out of the money put options to protect themselves. Why out of the money put options? Because they don't care about nothing else other than the price. But the price is not important here. What is important is the delta, which shows you, okay, how much money will I make if market moves X percentage? Now, they don't care about that. They just care, okay, well, this is 530 is expensive. Let's go for the 455. What makes that happy is that, what makes us happy about is that we can buy these options. Well, they buy these options and they push premiums higher than they would normally be. So you're pushing premiums of the put options higher, and I come and I sell those premiums. So effectively, inherently, I sell something more expensive relevant to its peers. And that happens with the call options as well, because people will tend to buy out of the money call options. Why? Because they are cheap. And it's like a lottery for them. So if they are pushing the out of the money or the far out of the money call options, then I still sell an option premium that is more expensive than it should be. So I get all the odds on my side, because time will go by, and these are wasting assets, because naive retail investors will buy single-handedly out of money options, pushing the prices up. So I'm effectively selling higher. And because implied volatility, the number you see here, 11.2, is inherently 75% of the time overstated relative to the actual volatility. Well, there you are. I'm trading a statistical edge like the casino and the insurances. I don't trade. I haven't even mentioned a directional bias throughout my 19 minutes of speech, and I'm getting towards the end of it. So I sell, for example, a 505 here. So what does it mean? I pull up, and then that shows me, okay, listen, I can get a premium of about 730. Interactive Brokers will give you the mid price here. So 730, that will be 730 in the mid for one contract. That takes up $9,950 of my buying power. Yeah. So it is an expensive contract to trade, but on the upside, you have, take a look from the profile. You have a 96% profit probability of making how much? $360. So this is how a short straddle shows, because we've sold the two legs of the index. So a 96% profit probability is quite astonishing, isn't it? Why? Well, there you are. People actually focus only on the maximum loss. Yanis, what is this? Can I lose on the, infinity? Yes, you could in theory, but this is the risk that I'm selling to you. You as a naive trader, not obviously you guys, because you're here. But the naive trader will say, oh, wow, that's like terrifying. I can lose all my money. Yes, in theory. In theory, you can take your car and crash against a plane, for example, outside of your house. But how often does it happen? Or you can take a flight and then crash or being crashed from a missile. How often does it happen? Now, I do have interesting statistics of how often black swans happen, obviously on the university as well of Daniel Kahneman, and that was really bad. He hasn't written that book. Nicholas Nassim Taleb wrote that, but Daniel Kahneman was actually very keen on exploring these relationships in our behavioral finance trades. So the statistics that I can pull up in my seminar show you exactly how typical standard deviations and how possible it is to have another black swan, another war, another inflation related or other things. But more to that on my free seminar. For now, you have a 96% profit probability of making money, of making $358. Why? Because 740 is the total you can get. You multiply by 100 because one option is equal to 100 shares. And here is equivalent to making $740, but you will be making half because $1 is equal to $50. Okay, so why can I make that much money with that certainty? Well, take a look at that. The S&P would have to rise above 5,675 points, at the moment trading 5,304. All right, so you've got 375 points leeway for you to make money before S&P challenges you. All right. Now, in between, you can lose. You can lose, like if you don't close your trade, obviously you don't lose, right? You will lose by watching here the P&L. Okay. So, for example, in my portfolio here, I've got in my show account. This is a $72,000 account, and I've got an English bond here. So the majority of that is an English gilt bond. And I've got this here, so this is the same. I opened it 2 days ago, and you can see different strikes, but this is the same idea, right? So it will show up here your P&L, but that doesn't mean that you're losing or making money unless you close the contract, okay? So you've got 375 points before it challenges you, and in between, you could lose, and my bad, I lost the contract, but I will put it up again. So you could lose only if S&P breaches and stays there until the end of the contract, okay? So 43 days again, and the strikes, so it was 5,675, so that one, and it was about the $5 one, the downside. So I thought, all right, and on the downside, 4,660 is the level to which the S&P 500 would have to drop within 43 days to make you lose money. Yeah, so it will have to drop more than 700 points for you to lose money. So 700 points to the downside, 375 points to the upside. That's the bracket, that's the range within which you can make money. And that's why 96% you will make the money. Now, do you wait until that happens? Well, really not. Why? Because we have something that is called opportunity cost of capital. You can't really have $10,000, perhaps 20 until, or by the time the markets go crazy and the broker asks you for more money, and not just sitting there like a sitting duck waiting for 2 or 3 months to make all of your money, which is $380 at a show. No, normally you would get that within a week or two to make 40% of that. So that would mean 40% of the 50%. So from the $380, which is the total, you will be making $200. So $200 every couple of weeks per one contract. You can do the math. You can sit on an easy 30% per year, including the hit rate problems that you will have, and make this a passive strategy. So I think I'm overdue. If there aren't any questions, the strategy is there. And Simon.
Thank you, Yanis. Thanks very much. Yeah, I posted the link if you want to go for the hour seminar, and we will get them the article as well, the PDF article on options. Use that link there to drop your name and address in. Mark, he's asking, what platform are you using? The Interactive Brokers platform?
Yes, that's the Interactive Brokers platform. Obviously, I live in Greece, so I have the, it's the same platform. I just deal with the Irish entity, because Greeks, we cannot deal with the Greek, with the English entity. But yeah, this is Interactive Brokers. And
you Mark, the session will be, is being recorded. So you just come back to here. This is exactly the same address. And you'll be able to watch the whole recording. And we'll have it on YouTube and things as well later. So fantastic! Thank you, Yanis. We're going to go swap over to our next speaker, Adam Harris. So
thank you very much, Simon.
Forex, but session Forex Focus. Welcome. If you're just joining us, my name is Simon Campbell, and we're doing a round-the-clock trader summit. We're looking at all different types of trading, flavors of Forex and stocks, options, even we've just had with Yanis, and we're going back to Forex with Adam Harris, our next speaker up. So Adam, if you can hear me, you should have an invite to join the stage. I will, if you can confirm that invite, we can bring you into the webinar and share screens. It's just a little nerve-wracking few seconds while we switch speakers. I hope everybody's enjoying the day today. We are doing this live, although we do record all these sessions, so if you're not able to stay with us the whole day, that's fine. We can catch up on either this platform or on the YouTube channel, which is IX Investor, YouTube/IX Investor. Okay, I'm just going to try again to bring Adam in. I'll just mute myself.
Hi.
Hi. Thanks for joining. How are you?
I'm good. Thank you very much. I'm good. Just back from Bali, as you know, I think, for a trading conference there, which was absolutely incredible. I think we should do those kinds of things more often. We just get a whole lot of traders in the room, and you just scan the markets, and you just look for trade setup. So I'm good, thank you. I just want to make sure the tech is working here.
Yeah, thanks for joining. Everybody, this is Adam Harris. Adam and I have worked together for many years now, doing webinars for lots of different companies, and Adam talks at my conferences as well, and at Lisa's conferences as well, the London Trader Show and the IX Trader Show. Great to have you here. We're going to be looking at Forex today, Adam. I know you're you manage funds. You're a professional money manager, mentor, and of course you trade your own your own account daily as well. I forget where you are with your trading. I think you've stepped away from day trading, more swing in terms of time frames, or are you?
So my routine. So I have a routine. I think routine is really crucial to getting you in the zone, to sort of conditioning your mind in the zone. So usually what happens is I will be here for the UK Open, which is sort of 8 a.m. until about 9:30, where there's a boost in volume because there's an overlap of the UK versus Asia sessions. I'll be looking for setups on the 15-minute, 5 minutes, usually on currencies with really tight spread. So that'll be day trading stuff. If I miss that, so if I have other stuff, other commitments, I might look at the US Open. So then I'll be back at my desk about 12:31, kind of looking for the same kind of thing. You're looking for a boost in activity and volume. And normally you'll get your setups within the first 90 minutes, and then you just leave them to play out for the rest of that session. And then what I will do, so that's probably 90 minutes, maybe 2 hours of the day. And then what I'll do is at the end of the day, which is anyway from about 6:30 to 7:30, I'll look at the daily chart to see if there's any kind of setups. So the reason I do that is because sometimes the days run away with me and I don't get to day trade, or just or I don't get the setups, and then
life gets in the way, doesn't it? Yeah. Let's go and see if we can share the screen, Adam. It's that bottom right. Share something.
Okay, there we go. Thank you. Now, okay, so I'm going to move you over to the right-hand side. Just move you over here to my right, and then I'm going to share my screen. So just to kind of give you a sense of sort of how the kind of performance lately has been, I had a really good month in January, but November, December were kind of iffy, and part of that is actually because your stops are closer, obviously, than your profit targets. So your stops tend to get hit first, which means that actually what happened was November, December, I had my losing trades kind of close out first, and my winning trades collectively all closed out in January. So January is a bit misleading because it was January trades plus December, November trades that closed out. February was a good month as well. March is a little bit quiet, not really, kind of the markets aren't really moving too much. So you can it can be very inconsistent with regards to kind of being able to just, what you want to do is to obviously just be able to rest assured that you're going to hit your kind of targets. Majority of my income comes from trading. So although right now, like I'm a major contributor to investing.com, I'm doing less and less of the kind of speaking events, just because I don't know if the market's changing, but so the majority of my kind of income comes from trading the markets. So I'm going to do this. Is that right, Simon? I just want to double check. I'm going to do this for about 30 minutes.
About 30 minutes. We've got a little bit longer if you want some Q&A afterwards, but yeah, a little less time.
Okay.
We
so
can
guys,
see
if you have any questions, hi Michael. If you have any questions, just ask away into the question box, and I'll do my best to answer the questions as we go. So the first thing that isn't said often enough, but you really need to know this, is that the US dollar makes up something like 70 to 80% of all the currency transactions on the planet. So the dollar isn't just another currency that's traded, it is like the major domo. And so you really do need to get a sense of what's going on with the dollar. Now, and so the best way to do that is really to have a look at the majors. So for example, you'd have a look at euro dollar. So if you look at euro dollar here, I've got the daily on the left-hand side, the weekly top right, and monthly on the bottom right. And if you kind of just have a very quick look between, say, Euro USD and GBP USD, and then maybe Aussie USD, one of the things you'll see is that if we look at the daily, kind of for the last couple of weeks, it's all trending lower. And they all look very correlated, visually correlated. So that kind of immediately tells me that the dollar is strengthening. Now, as it happens, I also have the dollar index here, which is a big help here. So the other reason you need to know what's going on with the dollar is because the dollar isn't just used in currency transactions, it's traded against commodities. So all of the major commodities in the world are priced against gold, crude oil, gold, silver, metals, so on. And then of course you have the global indices. So you've got some of your largest kind of the largest cap stocks in the world are also again priced against US dollar. And the US economy is the biggest in the world. And I think probably it's worthwhile very quickly kind of talking about there's a lot of, man, there's just so much misinformation out there. One of the kind of rumors that goes around is that kind of the dollar is devaluing. Now, the first thing you need to know is that every single currency loses value. Every single currency loses value because inflation. That's just what happens. So if you have a look here at the dollar index, this goes back to the late 1990s. You can see that here the dollar is roughly where it has been for, it's been there in the past. But the difference is that the dollar buys you less now. And when I say dollar now, in the context of this, I just mean whatever we earn our money in. So the pound buys you less now than it did 50 years ago. So that's just standard sort of deflation, or that's just kind of devaluing of a currency. So that's normal for every single currency. The next thing we need to understand is that the dollar is obviously the world's reserve currency. So when you're the world's reserve currency, you take on the world's debt. You've got to take on all the debt in the world. And there just really is nobody else who would really be willing to take on the world's debt. So that's the number one reason why there's just nothing is going to replace the dollar as a reserve currency in our lifetime. I don't really, you kind of, the rumors you hear is that this is kind of imminent and there's collapse and all kinds of stuff. Most of that is garbage. There's very little change. The dollar itself is unlikely to change as the global reserve currency anytime soon. And the primary reason being that whoever takes it over has to be much stronger than the dollar, and their economy is stronger, and they have to take on the world's debt. And nobody wants to do that. Plus, the US has the world's largest military. So the thing is that as soon as you become the backbone of the planet's things, you better be able to defend yourself from a military perspective. So nobody else has that either. So there's just no reason why that's going to happen. So I think if you're kind of under the impression that that's going to happen, it's almost certainly not going to happen in our lifetime. So in the next 20, 30 years. The next thing is the BRICS. So let's just very quickly talk about the BRICS before I run through the markets. The BRICS, again, are offering an alternative. Think of them as a secondary layer of kind of market investments. They're not going to replace anything. They're tiny in comparison, and it's not a very serious venture. So at some point, what it will do is just provide a variety of alternative kind of, if some countries want to do business with each other. So again, that's just to kind of put it into perspective. Even now, China's economy has now shrunk to 60% of the US's. Let me just do this quickly. So my point is this, is that, I remember when there was, over the last 10, 15 years, there's been talk about kind of trade wars and all kinds of different things. China's economy is struggling at the moment. And right now, the US economy is pretty much on fire in a good way. The only thing that they really have to sort out is debt. I've got a huge amount of debt that has to be resolved. Now, believe it or not, the best way to fix that debt, because I think this is all topical, and I think most people want to know a little bit about this. The best way to fix that debt, actually, one of the best ways is tax collection. So taxing the ultra rich, which doesn't impact us. It's like the 0.5%, 0.1%. Would solve a lot of those issues. So it impacts all of us, because obviously if the US economy struggles, then so do we. Okay, so I've spoken enough about that. Let's have a look at what's going on with the currencies. Now, this is where the monthly can provide us with some incredible perspective. The monthly here gives me a very clear sign that euro dollar, which is the second largest currency traded against the US dollar, is range bound. Okay, it's ping-ponging, it's range bound. What does that mean from a swing trading perspective? So when I say swing trading, I mean end of day, higher time frames, so the daily. It means that trends are very short-lived. It means the market might move a very short distance and then change direction. So here you can see we were in a downtrend, then uptrend, now we're in a downtrend. You cannot depend on trends to be sustainable, which means that your profit taking aggressive. What does it mean? You're trading, your is appropriate to the market. So sterling here is also kind of stuck within a range. So if you're kind of wondering what's going on with the markets, the monthly can give you some really fantastic kind of perspectives on it. If we then have a look at, we've got a architect not architect, like a builder's come around, and the dogs have just gone crazy. And he brought a dog with him, so fantastic. So again, we need to be Sorry about that. So sorry about that. So here, when we look at this, actually what I like about this is Kiwi dollar has the strongest trend in play compared to some of the previous ones. It's not so much stuck in a range. It's a lot weaker. So what does it mean? To me, that means that if I was going to short, if I was going to look for trading opportunities, I would look at Kiwi dollar. And that looks particularly good. The next one, and this is amazing, guys. So I want you to put this on your watch list. The Swissy pairs are incredibly strong at the moment. And I'm going to take you through it. So basically, the Swissy pairs have been kind of trending lower for a very long period of time. Obviously, prior to that, we had, for those of you who are relatively new, we had the SNB, the Swiss National Bank, intervened a couple of times, which actually kind of broke the currency market. They did it very badly. I think we always assume that, well, we want to assume that government bodies and central banks and stuff know what they're doing. And often they do. But in this particular case, the Swiss National Bank just, for want of a better expression, just kind of cocked it all up. And they really damaged the kind of currency markets, and they destroyed like brokerages around the world who just kind of went broke doing this. So the point is that the flow has been generally to the downside. But right now, and there's something in the price action you can see here, we kind of broke below this low a little bit. Then we pulled back, and then we went down again, and immediately we've come back up. So what's actually happening is the market, this is something that isn't obvious if you're a newer trader, but you're reading the price action as you kind of get more experience. The market has effectively tried again, done a slightly lower low, and is actually pushing back harder now. So in other words, there's less, the bears are less in control now, the bulls are starting to push back. So we're technically still in a downtrend, but there's a bullishness here that is relatively, it's worth paying attention to. When you go to the weekly, we've now come above the 50-period moving average. So loosely speaking, just very loosely, when we're above the 50-period moving average, we're bullish on the weekly. When we're below the 50-period moving average, we're bearish. That's very, very loosely defined. But we've moved above it here. We've also got this bullish divergence. So the MACD started to trend higher. It's now starting to peak above zero. So those are not, I use those as additional confirmation of what the market is doing. That's not my primary stuff. So the MACD, when it's bullish and price action is bullish and it goes above zero, those are all just additional boxes being ticked that tell you it's definitely bullish. And so my expectation is that we are going to see dollar Swissy almost certainly shift into an uptrend over the year, over the remainder of this year, which is a very bold statement to make because as an analyst, you can't, it's very difficult to analyze, to predict where we think things will be over the year. In fact, I don't buy anyone. And I've met some of the absolute most, just the best technical analysts in the world. And it's just really tricky unless you have fundamentals to back it up, like with sheer certainty, to be able to predict that the market, what it's going to do over the next year. So that's a very bold statement. It's very easy to predict what it's likely to do over the next 2 or 3 months. And then it gets very, very hard. So you can always predict where price is most likely, what price is most likely going to do next on the shorter term, distance-wise. But the reason I say that, so the reason let me kind of make my case to you, is just that it has been going down for a very long time. And it's now doing stuff that it hasn't done in years. Plus, it's on the weekly chart, which means that it's going to take a very long time to play out. So that's why I think 3 to 6 months, I think, it still has to go up and then come down, produce a higher low, then go and produce a higher high, then go into an uptrend. And so that's why I say I think that all of that could take 3-4 months for that to unfold. And therefore, might as well just see how the rest of the year goes. So what I'm going to do now is I'm going to take you across to the Swissy pairs. So we'll go look at Euro Swissy. So in other words, the Swissy pairs could very well be the ones that make a big chunk of the money. So again, if we go and have a look at Euro Swissy, excuse me, for a very long period of time, it's been under that 50-period moving average. It's now started to break back up above it. We've got that bullish divergence. Okay, so it's turning bullish. The really first kind of trading opportunities, money-making opportunities are going to be somewhere around about these highs over here. Likely that price will pull back at some point into this area and provide a buy opportunity to the upside. So you don't have to trade it on the weekly, but you can use the weekly to give you a sense of how much distance you've got and how strong it is and how much room there is to do this kind of thing. So it's had a really, really good run at the moment, and the quality of the trend is very good, guys. The quality of the trend here means higher probability, lower risk trading opportunities. Then we'll go to pound Swissy. So I'm just showing you how you can see all of this happening across the board. Pound Swissy also just broke through this level. Now it's pushing back up. On the monthly, if we go to the weekly, you can see again, here it's starting to break up above. Again, it's above that 50-period moving average. It's a very, very subtle shift, but there's a move to the upside there. And the quality of the trend there on pound Swissy. Let's go to Aussie Swissy. Aussie Swissy from a monthly perspective is everything I'm kind of saying making sense here, guys? Is this interesting? Is this kind of adding value? So here you've got a very clear level of support. Now, to be fair, it's early days. We're still on a downtrend. We could still have another move down and find support again and go. So that could still happen. But there's a lot here that kind of looks slightly different. We've got a triple bottom over here. We started to break above these highs. Again, we're above that 50-period moving average. That MACD is just trending straight up and it's starting to break above zero. So all these little things just show more and more bullishness. Everybody's gone super quiet. Are you guys there, or am I just not getting the questions? Just going to drop a message in there to see if anyone gets it. Then we've got Kiwi Swissy. Oh, there you are. Okay. You are there. Okay. So now we've got these slightly higher lows. So this one is not as bullish as the rest, but it's very subtle. CAD Swissy definitely starting to look very, very bullish. Now breaking above that, MACD trending high, breaking above zero, starting to look really good. Okay, so those are all. So I think the Swissy pairs are going to provide. We've had some really strong trends on the yen pairs for a while. So if we go and have a look on the weekly here, you can see, for example, that the yen pairs have provided for a very long period of time, have been providing, has had a strong trend. Now, the only other thing is that excuse me for a second. The only other thing is that even if we have a trend, that doesn't mean we can't lose money. Sometimes we get triggered in and stopped out, and it can be very frustrating. That can kind of happen. I mean, here, for example, there was price kind of hit it higher, pulled back, hit it up, pull back again, hit it up, pull back again, and then kind of took off. So in each of those situations, you might have been looking to buy, you might have got stopped out, you might have got some profits, not all. So that can happen. Just to be aware of it. And also, I just wanted to confirm something here as well. I want to just use the correct language here. Okay, so the Bank of Japan moved toward phasing out yield curve control. So one of the things they want to do, they really do want to kind of halt the kind of the continual weakening of the yen. And part of the reason for that is actually kind of relatively practical. Their biggest trading partner is the US. So they primarily focus on making sure that the exchange rate is built around the US, so that kind of keeps stability, because it's clever. It makes the economy very stable. And so one of the things, but at the same time, they kind of have an issue with the yen continues to weaken. And so they really have been trying to kind of turn that around. And one of the things that they've done is they used a yield curve as a guide, and they've kind of decided to disconnect from that, which is the first time they've done that in ages. And so I'm curious to see if we're going to see a shift in the yen pairs. And it's very early days. It's very early days. The overall trend is still very much to the upside. But if you have a look, we're starting to see some price pushing back a little bit. We've got price struggling a bit with resistance. And so again, this is one of those things that's going to take time before we really know for sure, because we're going to have to see that weekly chart start to break through some of these lows. We're going to have to see it get under the 50-period moving average and start to trend lower before we would really, really know for sure that there's a change in the overall trend. Otherwise, for now, the trend is still intact, still very much intact, and still quite bullish. But What's slightly different now is that the weekly, you can see here that we've gone into a downtrend and the selling off is quite heavy. And we're not that overextended. So this is the important part. We're in the moving averages here. So in other words, this is an area where it would usually find a base if this overall trend is going to stay intact, and it would go back up. But instead, what it's doing now is starting to push lower. And so that's why I say that I think that there's a fair chance here. It's not overextended, but at the same time, it still looks like it's heading lower. So in other words, it's not due for a correction, but it looks like it is actually starting to correct, which would imply that maybe that policy change has done something. So, and again here, you could see the Swissy yen is kind of over here. You can see it's starting to top out. Just cannot get through that level. And we're starting to potentially see it starting to shift over. There's bearish divergence. So that divergence is bearish. Price is just definitely battling to go higher. Here's nice and bullish, less bullish, less bullish. Now it's going more and more sideways. So it's frustrating because that's a weekly chart, which means that it's going to take ages before we really start to see a difference in that one. So my point is that although the trend in many ways is the kind of flow of prices still to the upside, I'm going to start looking more for shorter term shorts to the downside. You can see the monthly here starting to do a retracement down to the moving averages. So in other words, on the yen pairs, I would be looking for shorter term moves to the downside. Okay, so we've had a look at the Swissy pairs. We've had a look at the yen pairs. And what I'll do as well in a moment is I'll go down to the lower time frames so we can see what's going on there. Euro GBP, there's not really a lot to be gained from this. So part of the issue with Euro GBP, it's the same with Aussie Kiwi. You've got two countries that are geographically very close to each other. They have similar trading partners. They tend to have generalization, but it generally applies. You tend not to get any really big trends differences between the two for now. And then now what I'm going to do is I'm now going to look at all the euro pairs. So in the same way that we looked at the majors against the US dollar, we're now going to look at all the euro pairs to get a sense of, are the euro pairs collectively heading lower? Is the euro strong? Is the euro weak? So this is a good analytical approach. So euro Swissy, we can see that the euro is strengthening against the Swissy. Euro CAD, we can see right now it's kind of trending a little bit lower. And overall, guys, there's not much here. So again, there's a lot of, this is pretty standard. You can get currency charts that just aren't doing a lot as well. Euro Aussie is looking good. It's trying to break out through this level of resistance. So that's, we can see that happening. So Euro there starting to look a little bit stronger against the Aussie dollar. Euro Kiwi is definitely nice and bullish at the moment, and that's because the Kiwi is weak. So we've got a bit of something there. And so we don't really have there's no real clear standout there. The euro is stronger than some currencies, weaker than a few others. Let's do the same thing with the pound. So now we're going to look at pound Swissy, which is obviously strong. And again, we know why, because it's the Swissy that's weak. We've got pound CAD, which is kind of trending higher in an area where it might start to pick up. And it also, by the way, is testing resistance. The pound CAD and euro CAD are really testing resistance right now, which means that's the Canadian dollar. Then we have pound Aussie starting to look a little bit more bullish. But look at this, ladies and gentlemen, this is sheer garbage. There's just nothing really here. When you look at this, there's just it's impossible to really kind of trade that sort of thing. And that's even from a day trading perspective. So from a day trading perspective, what you really want to do, is as a day trader, you are looking for somewhere like ideally a less than 12 pip entry to stop loss. So let's just say hypothetically we go to Kiwi dollar and we go down to the 15 minutes. Okay, so there we go. So in this particular case, there's a nice pullback. Then I would be looking for this as an entry, one of these kinds of things, stop loss above the high, and then the distance of that would ideally be from my entry to my stop loss would be actually 10 pips or less, really, if you can. Even better if you can get it at like 7 pips or something like that. And so that's where the spread of the platform is really important. You kind of want to go through your 27 major currency pairs and you want to get about 12 charts with spreads that are ideally consistently under 1 pip, ideally. Wherever you can. That might end up only being about 6 or 7 charts. It might end up being euro yen and some of the majors. We'll see. And then what you're looking to do is ideally your entry to stop loss is going to be, hypothetically speaking, sort of less than 10 pips, which means that your target is 3 to 1, which means your target is 30 pips. So why is this important? It's important because it's important because, ladies and gentlemen, the currency markets or your average chart will only do a certain number of moves per day. So you might, 150 pips in a day is a lot. You might only get 75 or 80 pips in the day. And if it is going to happen, it's usually going to happen during those overlap sessions I spoke about, when the UK opens or when the US opens. And so when your target is 30 pips or less, maybe you're lucky it's like 21 pips, 22 pips, you have a very higher probability of hitting your target. So what you're doing is you're targeting 3 to 1. It's not scalping, it's still trend based, but you have a relatively tight entry to stop loss, and you're targeting ideally something like 30 pips maximum, which means that your potential to hit your target within that session, or just to be able to hit your target within the daily range, is very, very high, especially if the market hasn't been overextended. So that's where what you're doing again is your strategy and your approach is practical and appropriate to trading the markets. It's realistic. You understand that the market is not going to do 200-300 pips in the day. You're making sure that your target is achievable, and you make sure that you take your profits and run. Okay, so day trading is different in the sense that you can't, I don't believe, it's a very subjective opinion, but it's also based on experience. I don't believe you can be consistently profitable if you're trying to just use a trailing stop and trying to ride out the move. I think that people make more money and are more consistently profitable and therefore happier, and their trading is more stable when they just have a fixed rule. I take 2 to 1 or 3 to 1, take partial profits, or you have a rule where you take half the profits and then you trail your stop. But you can't do it if your approach is this idea of, I kind of want to just ride out the move, because the moves, sometimes you just get your 3 to 1 move and then it's done for the day. So you kind of want to be more practical in that sense. Okay, so that's having a look at kind of what's going on there and explaining why you would have your entry to stop loss would be very, very tight, and why you would target kind of 3 to 1 so that you try to be realistic there. Let's have a look at the Aussie Kiwi pairs. Okay, so again, range bound, which is something that isn't necessarily obvious until you look at it on the monthly. So I tend to box out the ranges, and I do that because I want to know when we're out of the range. And often it's possible to kind of forget that you're in that range until you get out of it. Aussie CAD, you can see this is a really strong momentum breakout. So this was in an uptrend. We've now broken that. So this is now in a downtrend and looking relatively weak. But again, look at the wicks over here. The wicks over here, that's a double bottom. There's bullish divergence. So there's definitely buying pressure. So I suspect that we'll probably have another bounce or a higher low here, potentially. So very interesting to see kind of what's going on over there. Aussie CAD. CAD is the issue here. CAD's just not going anywhere. Aussie Swissy, as I said, looking a little bit more bullish. Kiwi CAD. Aside from the Swissy pairs, I think the Kiwi pairs are offering the strongest trends right now. Look at this, just really, really, really big moves. Bit overextended now, but solid selling over there. Okay, Kiwi Swissy we've had a look at. So Kiwi Swissy is part of the reason Kiwi Swissy is battling compared to some of the other charts or the other Swissy pairs is because the Kiwi's weak. Okay, so even though the Swissy is weak, the Kiwi is also weak. And therefore it's just not picking up on that trend. And CAD Swissy, as I said, these are looking particularly good. So that kind of wraps up sort of where we are. Simon, did you have anything else that you wanted to add to that?
Yeah, can you hear me?
Yes.
Oh, great. I'm glad to be. We just suffered a power cut, so I've just been desperately trying to log back in, and luckily it didn't interrupt the webinar because it's on the cloud, the internet. So that's good. Thank you for that. I did miss the last 5-10 minutes of that waiting for the
Well,
power.
to sum up, I think the Kiwi pairs they look really nice and weak. So there's some good trending opportunities there. The Swissy pairs, for the most part, to the upside, are going to be offering some higher probability, safer trading opportunities. And the yen pairs, I'm cautiously bearish on them because they are in a weird place right now. So they're not looking super bullish anymore, but they haven't quite broken the longer term kind of weekly bull trend. So that's pretty much it. And then we have a lot of ranges on the other charts where we're waiting for it to kind of decide what it wants to do.
Oh, fantastic. Adam, I've posted the link there. I know you have this MACD ebook that you published, I think, last year.
Oh, yeah. I forgot about that.
Yeah, I just thought it's there, and people might want to download that. Where else can they contact you?
The best thing is probably where the most value is to kind of track me would be my channel, which you can kind of find here. So I would just YouTube London City Traders is probably the best place to kind of do that. Plus, there's a weekly analysis which I put out every week, which is a general like multi-asset overview. So I'll look at cryptos, I'll look at the indices, I'll look at equities, and it's usually 30 minutes, but it gives a really good overview of kind of how the market's doing.
I see that. It's normally a Sunday evening, isn't it?
Yeah, it's usually Sunday.
That's great to sort of overcap all the things you do. Well, fantastic. Thank you so much for joining us. I'm glad the dogs settled down a little bit. I heard them all making new friends.
Yeah, I don't know if you can hear them, but they're still firing off in the kitchen. So
no, oh well, it's like
ridiculous.
and sort out the scrum there. Okay, listen, thank you for joining us, Adam. Adam Harris. As I said, the links there, guys, in the chat box to download Adam's. If you talked about the MACD and the moving average divergence,
have a look at it.
It's all explained in there, and then Adam can get in touch with you. You can get in touch with them later. Thank you very much.
Thanks for inviting me, as usual. Thank you.
Okay, we're going to take a little break. Now we have about 30 minutes break until we come back with Andrew Lockwood from the City Traders. Andrew's going to be talking about prop trading, amongst other things. So we look forward to that. So a little break for 30 minutes, and then we'll reconvene at 1 o'clock. Okay, many thanks indeed. Okay, great, folks. We're just taking a short break for a sandwich, coffee, walk around the block. We will be meeting back here in around about 25 minutes and beginning our next session with Andrew Lockwood, CEO of the City Traders, talking about funded trading, prop trading, and the markets in general. So we look forward to that starting at 1 o'clock. We'll see you back here very shortly. Thank you. Okay, so we're just a few minutes away from getting started again for the afternoon sessions of the Round the Clock Trader. We've got some great sessions still to go today. Andrew Lockwood from the City Traders will be coming any moment now into the room. I think I've sent an invite, and there he is, right on cue.
Oh, I know. I just realised. I never realised until I get on camera that I haven't shaved. Oh my word!
Great, I know, we're all.
No, you're looking all smart and all dapper. I mean, I come in looking like a hippie.
I'm trying to keep the standards, but I don't have a trading jacket from the floors like you do.
Well, I got 3 trading jackets from the floor, as you can see there.
And boxing gloves. Did you need them in life? Did you?
Well, you could have done. Actually, those I do sometimes. It's called the trading battle, which is like a battling off against another trader,
Yeah.
sponsored by one of the brokers, and so they sent me some merch. I put them up there, but I could have done with them in the trading pits. I can tell you.
I bet you could. I bet you could. Wilson, we're just everybody. Sorry, I can see some people coming back in just now, which is great. It's not a huge live audience today. I think Easter's too very close to us. People are maybe on the roads, perhaps heading off for Easter. I don't know, but we're very pleased that you're here, Andrew. And this is me starting the Round the Clock Trader sessions again for this year, and it's a great pleasure to have you here. Obviously, we're sort of referencing your long history in the city. You've been on various trading floors over the years. Just remembered I hadn't checked the record button, so forgive me. So Andrew Lockwood again, just to welcome you to the Round the Clock Trader Summit today.
Excellent. It was great to be back again. I'm just saying to the pre-recording, I'm just saying I've come in like a hippie, and you're all dressed up, all dapper, and looking like a.
You can only see the top half. My Bermuda shorts are on. No, they're not. I promise. Or in fact, we've got a very.
I don't think about that, to be honest. That's I don't want to. Can't picture that at the moment.
No, now you can't unsee it, I'm afraid. But so good you here. The City Traders is all about funding traders to get on in the markets. We've known each other a few years now. You know, I run the conferences and the webinars, and I've been involved in education for 20 years, training investors. This is the first time really that I think it's opened up this ability for people that can trade. They know how to, analyze a chart. They know how to manage the risk. All these tools and skills that you can learn. But the essential ingredient, I think, sometimes is not having enough capital to start with, and that can mean that traders are forced to try and take bigger risks, look for bigger returns that are unrealistic, and more often than not will trip up and sort of blow up their account, is the phrase. So funded trading is sort of creating quite a lot of noise. There's a lot going on in the market. There's a lot of players in the market. So this is why I'm pleased that you're here to try to distill some of that. Tell us what's been going on and how it's working, and maybe some of the signals that people should look for when they're choosing a partner to partner with for funded trading. So.
Well, that's basically exactly what I've got in store for everyone today. Obviously with my background, which you alluded to there, I've been trading since I left school, so it's many years ago, and I've been in the education space for maybe 8 or 9 years now, and I've seen so many traders fail for this very reason, other reasons as well, but a lot of it is to do with the funding. So what we try and do here, and a lot of people will know me anyway, but what we try and do here anyway is to educate people really to start thinking like a trader. I am an old city trader, emphasis on the old. I try to get people to think like traders, and and educate them in trading, the mindset of trading, obviously strategy as well, but the mindset of trading, and of course now providing capital as well. So I think out of all the pop sort of business out there, we set ourselves apart, but I'll cover that in my little presentation as we go through. It's not a sales pitch. It's going to get a bit of an insight really into the industry, where it all started, what's happened in the last the last year or so, and what I think about the future going forward. So that's basically what it is. It's not going to be a
fantastic. Well, thank you so much. If I can ask you to, let's do the screen share, and if you have a slide or a platform or something, if you.
So how do I share the screen then? I've got it here. Share something here. Share screen.
That's right.
Entire screen. That's the one I think we want.
Now you might lose the questions. If you have a different screen, you can drag one of the platforms across, so you still see the questions on the chat box.
Yeah, I've got way too many. Of all the screens, Simon, that you could possibly want.
It's not that one.
No.
Don't worry about it, because if there's any questions posted and things, I'll.
No, you can see my screen, can't you?
I can see your screen.
Yeah, and I can see the chat on this screen.
You can see the chat. Oh, great! Even better then.
Well, the last chat was was Mark C. What happened with the Meet the Broker? Did it get cancelled? That's what Mark said. Is that the last chat?
Yeah, we didn't have a broker to meet today, unfortunately. So I skipped over that one, and we had a short break, which is very welcome. You should be looking at the chat. Should be saying starting soon at 1 p.m. Thank you, Adam. I'll just make sure I'll call everybody into this new session.
So I've just put hi all into the chat. Is that looks as though I can see the chat?
I think you're on an old chat.
Okay, Mark C said hi, so that's good. I can see the chat.
Okay, great. Let's just carry on from here. So Andrew, I'll hand over to you. Let's find out what's going on with prop trading.
Okay, brilliant. Well, thanks very much, Simon. Of course, thanks very much for inviting me on the revitalized Round the Clock Trade. It's great. I watched it all last year, and it's good to see it's back in full swing. So I'm delighted to be invited back on. We were talking there about the chat. I know there's been quite a lot going on in the prop space over the last year or so. Some of you may have questions for me, and that's absolutely understandable. In fact, it's encouraged. I am a prop CEO. So I think I will have quite a good insight to what's been going on. If you've got any questions, nothing, don't be shy about anything. Ask me anything you want about the prop business, and I'm here to answer with my honest opinions on that. But I will say I'll get through the little chat first, presentation first. Might take about 35-40 minutes, depending on how fast we go. And I'll sort of address the questions at the end. Otherwise, I could get derailed. You take me down a rabbit hole, and I might not come out, and we'll end up missing up on all the content. So thanks all for tuning in. Thanks all to the previous speakers. Been watching a few of those this morning. Some really good stuff going on. And I'm delighted now to be joining you over the lunchtime session. Okay, so what I want to do is, first of all, because everyone believes that the prop industry has basically just sort of like evolved over the last couple of years or so. You wouldn't be I wouldn't be blaming you for thinking that, but the reality is the prop industry has been going on forever. Certainly for me anyway. Now, for those that know me, you'll know that I started my trading career many years ago in the trading pits in the City of London. You'll see those jackets there behind me. That was when I used to work for a company called Swiss Bank, and I used to stand in this trading pit. Okay, so this is, in fact, this is the UK government pit. The back one there is the sterling pit, interest rates, basically, short sterling interest rates. You will see me sitting down over here. That is me there many years ago with the old side parting. I'm basically throwing orders into this poor guy here. Actually, he passed away a couple of years ago with a awful tumor. But so I'm basically working with him. I'm trading with him, and he's trading my orders into the trading pits. So this is the trading pit. Now I'm working for a company at this stage. In fact, the jacket I'm wearing is this sort of grey jacket here, which is the one hanging up behind me. But these guys down here, see it says here, these guys, Kite, K-Y-T-E. Okay, Kite, he was a very wealthy trader individual, and he used to sponsor other traders, young guns. coming into the markets for the first time, didn't have any money, or they were trading from banks, he would be able to spot certain traders, certain attributes of a trader, and he would basically sponsor them. These guys are prop traders in the trading pits many, many years ago, before most of you, I think some of you were even born. You know, the guys in the red jackets. I've got a red jacket over there. You can see it there, the red jacket. Okay, behind there. I was a trader for a while. I did actually put my own money up, but a lot of these red traders are being sponsored, funded by other wealthy traders. These are prop traders. Most of these are prop traders. This David Kite chap used to be, you know, all over in all the trading pits. So David Kite was able to basically have a look into almost every trading asset on the trading floor. He had an interest because he had good traders working for him, and basically they got a commission of what they made. Prop trading's been around for a long time. Okay, now these trading floors, they all went electronic at around the turn of the century, around I think it was around, well, I know exactly when it was around 2000. I went to Singapore and started trading on the Singapore Stock Exchange for the remainder of Open Outcry. But all these traders basically, you know, that were working for banks and what have you, they didn't have anywhere to go. They could maybe drive a taxi or something, or they didn't have Ubers in those days, but you know, they had nowhere to go. So what happened was, all around the cities and the suburbs, you had all these trading floors basically starting up. These are prop trading floors. These are guys here sitting here on the screen. You know, you see them here on the screen. These guys are basically, chances are, and I don't know these individuals, I screen grab this, but these are paying to sit on this trading floor. They have access to all the different screens, the Bloombergs and the trading, what have you, and chances are they're going to be funded. They're paying to sit there, but chances are they're going to be funded by a bigger institution. Okay, and the risk manager would typically be sitting in the corner there, maybe behind this mirrored screen. It looks like a mirrored screen. They'd be sitting there, risk managing them, making sure they don't blow up the big money. These are prop traders, basically the way it all used to begin. You know, that way it all started. You know, sort of at the turn of the century, when everyone started to, you know, carry on trading. These are decent traders trading other people's money, and they're taking a cut. That's basically exactly what the prop industry is all about. Now, a lot of you would have seen over the last whatever we got, last 5 years, but most people maybe didn't notice it 5 years. Certainly over the last 2 years, massively over the last 18 months, all this prop stuff has gone online. Yeah, we've all seen it. We all get the ads. We all get the marketing. It's all gone basically online, and you've seen the emergence of all these companies. So you've got the FTMOs, you've got MyForex Funds, the Funded Trader, 5%ers. You've got us there in the corner there. I don't know if you can see my mouse moving around. I don't know if you can see my mouse moving around. Actually, can you see my mouse moving around if I move that? Because I might be doing things out. I don't know if it's just on my screen. But
you can see Andrew, yeah.
Yeah, you can. Great, thanks. So so these sort of prop firms have all sort of established. This is just a handful. I know what some of you are thinking when you're looking up at the top right there. I'll come to that in a second. But these prop firms have basically been propping up all over the place. Every time you look around somewhere, there's a prop firm opening up somewhere around, which is good, and it's also bad as well. So these prop firms operate on certain different types of business models. It's normally a case where you have like a demo account. So you pay a certain fee, for those that don't know, and I'm sure some of you do, and maybe some don't. But you pay a certain fee to have a simulated account, a dummy account, a demo account. You've got to make a certain percentage profit. And if you make a certain percentage profit whilst keeping within those trading rules that they set out, they will then fund you with a live account or give you a simulated account, which is akin to a funded account, and you get to keep percentage of those profits. A lot of them call them challenges. So they make them into a bit of a game. You know, prop phrase are challenges. This is the first challenge. I don't know, I'm a bit of an old timer. I don't call them challenges. I'd like to take this a bit more seriously. I always call them assessments. These are assessments. We're assessing you before we give you access to capital. and that's basically what we do. Now, all the different rules are out there. Some rules are out there. I'm going to cover this in a moment about when you think about whether you should be taking part or not in these. Some rules are there to catch you out. Some of them are there to basically never get you into a live phase. You've got different phases, 1 phase, 2 phase. Again, I'm going to talk about that later. But you've got to be watching the trading rules. And what's happened over the last couple of 18 months or so with the emergence of all these prop firms, they're all competing for your business. Yeah. They're all competing for your business because they know ultimately most people that are coming into the markets don't have education. They don't have any sort of understanding of what trading is really all about. That basically means most traders are ultimately going to fail, and they're just basically keeping in all your assessment fees. Yeah, they're keeping in everything you take. So they know that most will fail because they haven't got the trader mindset, the trader mentality, and they reset. So this is what's been going on over the last 18 months or so, and over the last 18 months or so, there has been massive shakeups in the industry. Okay, so I'm sure you've seen it all over the news. If you follow this business at all, it's all over YouTube. There's been a big industry shakeup, and it was basically caused. Well, I don't say cause is the right word, but it was basically initiated, I think, by something that happened in September 2023, so not long ago, right? So about 6 months ago, the biggest prop firm out there, or one of the big, actually, when I say the biggest, these are mostly the biggest out there at the moment, FTMO. Okay, so they're the biggest out there, and then MFF. They were the two ones that were controlling the industry. But in September of 2023, MyForex funds basically were shut down, if you like, by the CFTC and the equivalent in Canada. And allegedly they were shut down. Well, I say they were shut down allegedly for malpractices. Now I say allegedly because it's still going through the courts and so forth. But basically all the traders that were trading with them had their money frozen. I think a lot of them have been released now and the money's been funded back. At one point, I think the CFT, I think they sort of freezed about $100 million of MyForex funds money, and they've subsequently given it most of it all back or released it all now. I think they're just keeping back 12 million or something like that. But that got everyone thinking, hang on, what's going on here? So this sort of like put the spotlight on the prop industry, and all the prop companies now were making sure that they weren't falling practice. They were allegedly, one of the quotes was like, slip them to hell. They wanted traders to fail so that they can just keep all the failed accounts and so forth. So it's just really shady business, allegedly, really shady business. But it put the spotlight on the industry. And then from there, we had FTMO recently in January of this year. FTMO, the other leading prop firm in the business, basically they stopped taking US customers. They realized, or they believed, that the US regulators are going to be looking now at all the prop firms operating in the highly regulated US market. So they stopped offering US customers the ability to trade CFDs, contract for difference, that stands for props. Okay. And when the market leader like FTMO announced such a thing, then of course a lot of the other prop firms followed as well. Incidentally, at this juncture, I know there's not many listening in at this time from the US, but CFDs have always been outlawed in the US, right? CFDs, some of us trade Forex. You might understand Forex. I saw a couple of speakers earlier today talking about Forex. Most of the Forex that we do is on CFDs, yeah? CFDs has never been allowed in the US with such tight regulation. But the prop firm industry allowed a backdoor into trading CFDs, allowing the US citizens to trade CFDs through a prop firm. And of course, regulators most probably don't like that because they want to keep everything on their regulated exchanges like the CME and the like. So basically, FTMO shut down, and that was really the catalyst, I'd say, of many. And then about February this year, one of the other big companies, True Forex Funds, offering MetaQuotes. You may be familiar with MT4, MT5. This is what most people are using for their trading. True Forex Funds, MetaQuotes, their access to MetaQuotes was terminated, and now there's real big shock horrors going around. So basically, a lot of the prop companies are out there, a lot of the white label props as well, were no longer able to offer MT4 inside the US and indeed outside of the US. So that basically, again, put more sort of spotlight on the industry. MetaQuotes in February 24 was pulled totally from the US. So you can't trade MetaQuotes in the US via these prop firms. Absolutely outlawed. And that was basically in February as well. And with that, all the prop firms were struggling to get their accounts, to continue. So they all sort of moved away looking for other trading platforms to offer as an alternative to MetaQuotes. And you may have been familiar with DXTrade. I put down here the birth of DXTrade, but DXTrade have been around for quite a while. They are growing, but it's fair to say they haven't been around as long as MetaQuotes. But all the prop firms started moving towards MetaQuotes, and basically we've seen a lot of the US customers now trading via DXTrade. So and it's got its teething problems. It's had a few problems. I've seen we offer DXTrade as well. I know the back end with a few teething problems with certain accounts. Hopefully it's going to be rectified, but they're on it. They're getting it sorted out, and and you know what it's like when people change platforms. Everyone starts, it's not the same. I want MetaQuotes. Bearing in mind, everyone complained about MetaQuotes for about 5-10 years. They always, MetaQuotes is outdated. Now they're forced to change, and everyone's saying, no, I want MetaQuotes back. Anyway, you get the idea. There's birth of MetaQuotes. So prop industry in the US has been migrating to that if you're trading CFDs. There are some prop firms that have relationships with MetaQuotes, such as us, for example, that do still offer MetaQuotes. We offer MT4 to the trading community outside of the US. If you're in the US, you have to use DX because of MetaQuotes not allowing it. But outside of the US, most of the prop firms have stopped using MetaQuotes because they haven't got the relationship with the MetaQuotes. They don't have licenses and so forth. So they are putting their customers into DX. Okay, we do have the relationship with our broker, and MT4 is still available, but more about that later. So question is, what is the future of the prop industry? There's been lots of changes. What's happening to it? Well, I think it's here to stay. And I'm going to go through some of the reasons why people should be trading prop, or whether they should consider trading prop in a moment. But it's here to stay. The prop industry offers an invaluable sort of entry into the markets for people that can make really good traders. But as Simon said there in the intro, they just haven't got the capital. And because they haven't got the capital, all the other problems will sort of surface. Prop trading's been around way before some of you were even thinking about trading. David Kite was trading props many years ago. The Japanese rice traders were trading prop many years ago in one form or another. People funding others to trade for them. That's what prop industry is about. And just because the business has had a bit of a shake-up in terms of weeding out some allegedly scrupulous companies, weeding out some props that are basically no better than just Ponzi schemes, people that basically run away with your money. Once those have been weeded out, and it looks as though it's happening at the moment, the business for funding other traders to trade will always be there. And I believe that is the case. Now, what you're seeing in the US, and I know we haven't got many US people in at the moment, but I think Simon said it's been recorded. So there will be sort of people following on in the next few hours and over the weekend, maybe, from the US. There's been a big sort of move in the US at the moment to move prop trading into the futures market. Okay, the futures market, which is traded on the CME. That stands for the Chicago Mercantile Exchange. So there's a lots of, you see it all over YouTube, lots of influencers all trying to get traders to go into the futures prop. Okay, and it's different. It's not trading CFDs, what we trade, the contracts for difference. And it's great. I mean, I've been looking at it. I did a YouTube video about 3 or 4 weeks ago. I haven't got it here now, but you can find it on, if you follow me on YouTube, you can find it, talking about the difference between CFDs and US prop. I didn't want to bore everyone today on this short 35-minute sort of session about that. So I'm not going to go into it now, but there is different. There's different terminology, pips and ticks, and you've got different type of assessments as well. Generally, the futures prop is generally a monthly subscription where you pay every month, whereas the CFD props that we offer and the other prop firms up there generally sort of like a one-time assessment fee, challenge fee, one-time assessment fee that you pay, and you get the account and you try to make the targets and so forth. But that's the main difference. Well, it's not the main difference, but the main difference for me, I understand why they're trying to do it in the US, but the main difference for me is the availability of asset classes. The futures CME's prop is quite limited. There's no forex basically. You can trade the euro against the dollar, but maybe a couple of the other majors. But really, the volume is very low in terms of other asset classes. It's pretty okay in indices. You can trade the S&P 500. You can trade the Nasdaq, and you can trade the DAX as well. I think the German market. So there are indices there, and that's good. But if you want to trade forex, then really no point looking at the futures on the CME. But you can always get a list if you go to any of the futures props that are offering it. You can always see the asset classes, what they're offering, if that suits your trading. If you're here in UK, Europe, with the CFDs and the forex and all the indices, I don't see any reason why you'd want to go into the futures. If you're in the US, yeah, I get it. Maybe have a look at the futures market. I think it's fair to say that most people that are moving into the futures props at the moment are doing so because they have to, really, and rather through a decision of choice. It's because it's been imposed upon them. But the future of prop is here to stay. It's just going to be, it's just going to be a little bit different. Now, some of you are here and you might be thinking, well, what's all this prop stuff about? I'm going to just briefly talk about the advantages and the disadvantages of trading prop. Because if you're not trading prop money, it means you're trading your own money. So you're self-funded, or you're trading your family's money. And there's advantages and disadvantages of both. I'm not just here to sell prop. There are advantages and disadvantages of both. And I just want to go through those now. As we've alluded to a couple of times, the increase in capital means you have to you can take less risk if you're trading a prop for the monthly income, to make a monthly income. So I've got a screen somewhere. I'll maybe show it if I have time at the end. But if you're making like a 5% gain on your self-funded account, $500 or something like that, or $1,000, well, 5%, let's call it $1,000 so I can work it out in my head. 5% on a self-funded $1,000 account, it's $50. So that's not enough to pay the internet bill. And because of that, and you're sitting up there in your man cave or your lady cave, and you're telling your partner, I'm a trader, and you come back after the month's work and say, yeah, I had a really good month, made 5%. Ooh, I'm up $50. She's going to say, get a proper job. It's not going to work. And because of that, you're going to take, not because of your nagging wife or a nagging husband, but you're going to take on more risk. You're going to make it more worthwhile. And normally when you take on more risk, it normally results in failure. Trading is all about calculated, controlled risk. I know that. I was a trader in the city for many years as an individual on the red jacket, and also on banks. You've got to control risk. More risk generally leads to bigger downfalls, bigger casualties. The small gains can lead to huge profits. Yeah, that's basically a bit linked to the one above. If you are making 1% on a trade, and you've got $1,000, well, you're making $10. If you are trading prop and you're making 1% or 1% on a $100,000 account, well, you're making $1,000. So it makes much bigger to get much bigger profits. If you're trading, we are at the City Traders, we offer up to 250,000 on the assessments. I see some offer more than that, but we think 250 is a good level where people don't lose focus. You don't want to be giving people 10 million accounts because the numbers are just too big and what have you. And all sorts of emotions come into it. We sort of leave it at 250,000. Can have 2 or 3 accounts, but 2 or 3% gain on a big account. It's a meaningful amount of money. You get what I'm saying? And also rules. Right, a lot of traders sit at their desks trading and they end up, breaking all their rules. They've got nothing to focus on. They're just trading their own account. So they don't keep focused. I know personally, when I left the City and I came onto the screens 2005, I lost a shed load of money trading the screens. I had no real sort of control. When you're in the trading pit and you start losing it and you start behaving like an idiot, everyone sees you're trading like an idiot. It's in front of everyone's eyes and they look at, he's lost the plot, he's had too much, and they know when you're having a bad time. When you're on a mouse, on a screen, you've got nothing to keep you focused. So trading advantages with a prop, you've got a journal, you've paid for your assessment, you're being, you're being monitored as well, but you've got goals, you've got targets, and there's something to aim for at the end of it. Decent money. And what we say, and scalability for decent traders. Yeah, scalability. So basically, you can start off with, well, we start at 10,000, but you can scale that up once you get profits on that. You can use profits to buy the next challenge up. You can have up to 3 challenges with us. But you can, for decent traders, starting with a 50 grand account, if you can trade in a year's time and you've scaled up and you've used controlled risk management, you can trade some serious money at some point. So the scalability, as opposed to trading your own money when really you're just relying on your profits. Hopefully you're compounding, but you get the idea. So what's the disadvantage? Well, you've got to pay for these assessments. Okay. You've got to pay for these assessments. And if you can't trade and you blow up, then you're losing. You're losing a whole, you haven't traded real money in the first place. You've had a go and you've lost 100% of your assessment fee. So basically, you traded a demo account. You pay for you pay for the demo account, and you basically, done it up the wall. So that's money, and people, we have them up with ourselves. Some people that don't take it that seriously, and they just keep doing re-challenges and what have you. But it's not advisable for that, because it's just wasting assessment fees. Some rules, some prop firms are stacked against you. Okay, some rules are stacked against you. They're there designed to make you fail. You may have seen some of the assessments out there. Now, I'm not going to go into too much of the different types of assessments, but they're all changing. But you've got really sort of like a 1-phase or a 2-phase assessment. Some of the 1-phase assessments, you get attracted into that. You've got to make 10%, and they give you maybe a 10% drawdown. But once you pass that, then you go into another account. So they reset you again, and then they give you a profit target of say 5% and maybe the 10% drawdown. But I know, basically, it's the resetting. That's not necessarily a rule that's stacked against you, but you need to be aware of that rule or that assessment. But some rules are stacked against you. Some rules will tell you you've got to make it within 30 days or something like that. I think it's whatever. So you need to be careful of the rules, and you can always, even if you're not using one of our assessments, you can always find me somewhere, reach out to me, and I'll give my honest opinion on any of the rules. So keep an eye on the rules. And this is another one. This is a very important one, and I do want to spend a bit of time talking about this one. These are the drawdown rules. Now, the drawdown rules, and I'm seeing it also in our own accounts. We've got some really, drawdown is what we do. Trading with drawdown, it's part of the business. Anyone that says they don't have drawdown is misleading you. Everyone has drawdown, but some of the prop firms have drawdown rules that are stacked against you, so that when you do have that inevitable drawdown, you get blown out of the account and you have to reset the assessment. So you need to be aware of that. And also the drawdown, you have to think about when you get into the funding stage, and you take a payment, take a payout, and that moves the account closer to your trading drawdown. Okay, I'm going to talk about trading drawdown in a bit more detail in a minute if I've got time. I've got another 15 minutes, so hopefully we'll get into that. So you need to be aware of the trading drawdown rules or the static drawdowns, and of course if it's one stage or two phase. I've just mentioned it there, but you have to be aware of time limits. Time limits in trading, it's just wrong, right? You should not be forced into making trades because you have the assessment time coming to a close. Now I know a lot of them have changed recently. I think in fact we were one of the pioneers in changing drawdown, changing time limits, but you shouldn't be faced with time limits because it puts unnecessary pressure on you. Yeah, an equity curve should be going like that, steady growth, not steady growth with a target there, and you then have to go, whatever, boom or bust on the last couple of days just to either make it the time limits. So some do have the time limits as well. So do be aware of that. The other disadvantages I put in here is that I've seen obviously in the past, some prop firms like MFF trading away, but they weren't there the next day. Okay, it sounds allegedly that they were doing things that they shouldn't have been doing. Allegedly, got to say that. But you've got to make sure that your hard work isn't going to go up the wall because if the prop firm gets shut down or the like, and that has happened when you're trading your own money. Of course, your money's with the broker, and if you've gone with a regulated broker, then you should be governed by the sort of the regulators' protection funds and so forth. Your money hopefully will be protected, not your losses, but the company going up the wall is protected. So you've got less sort of third-party risk trading your own money than you have trading a prop firm. But of course, it's up to you to choose a prop firm that you think is reliable and honest and is there on your side. As I say, I wanted to mention to you so this is another one. Not my money mentality. This is a disadvantage. Okay, and I've seen this happen before because it's only $400 or some of the lower fees are lower, $100 or whatever for an assessment fee, or $500, whatever it is. Because it's not your money, you can have the not my money mentality. I'll just go for it, and that normally ends up in losing. You've got to treat it seriously. If you're doing these assessments, you've got to treat it seriously. You've got to treat it with the end goal in mind. You don't want to be just happy to blow up the assessment fees, because that is just death by 1,000 cuts, isn't it? You're going to end up just blowing every time you do it. It's not my money, and all you end up, you think at the end of the year, I've done 10 assessments. It's cost me $300 or $400 a go. Well, I'm getting into serious money now that I've just blown up the wall. So that mentality does happen sometimes. I've seen it before, and in fact, some of my students have said, "Well, that's their idea. They just want to take out assessments, and it's not my money. I'll blow." And it's sort of like the gambling mentality. Well, that's fine. Some gamblers get lucky. Some gamblers get a payout. But if you want to be in this game this time next year, this time in 5 years' time, 10 years' time, if you want to be teaching this to your kids, if you've got kids or your grandkids or what have you, if you want to be teaching an industry where they can too forge out a career for themselves, you don't want to have the gambling mentality. Okay, you want to be doing it seriously. But that is a disadvantage that I think some fall by. Okay, so now I want to talk about so what do you need to consider if you're doing a prop assessment? I'm running out of time here, Simon, so I'm just going to motor on through. One phase versus two phase, I've covered that already, so I'm not going to go down that route. Drawdown, static and relative, I am going to come to that in a second. Time limits, that's what you need to consider, and the trading platforms. This slide is basically, I've gone ahead of this slide. That's good, it saves me a bit of time. Trading platforms as well, you need to consider. If you're thinking about the futures, you've got to find a whole new platform. Do you want to trade MT4? Do you want to trade DX? C-Trade, another good platform. Can't trade C-Trade in the US, that's not allowed either. But you need to consider the trading platform that the prop firm offers. So a lot of the UK prop firms now aren't able to offer MT4 because of the MetaQuotes regulations. So if you're looking at a prop firm you don't want to go into and you want MT4, well then obviously you've got to choose a prop firm that offers that. as I say, we do offer MT4 and we do offer DX. But again, that is the consideration. Time limits, you don't want to be doing time limits, and drawdown rules, static versus relative. Now, this is a really important topic, and I'm going to spend, if I can, 5 minutes on this, because this is one of the biggest rules that catches out prop traders. Okay, let me explain how this works. You've got a starting balance of 100 grand. Okay, now let's assume you've got a 6% drawdown on the assessment phase. Challenges, yeah, assessment. You've got a 6% drawdown on the assessment phase. 6%, 100 grand, it's 94 grand. Okay, so you trade away, you've got no time limits, you're trading nicely, and you take that account up to, say, a 5% profit. Your balance is now, you're on the way to your profit target, which is, say, $10,000. Yep. You got your profit in play at the moment. You're up to 105,000. But look what happens to the drawdown. It's trailing. You're trailing now just below where you started. Yeah, you can have a bad run. Let's see if I can. I've got my drawing tool here. Have I got? Is this a drawing tool here? Maybe, yeah. So you can have a bad run. You know, hit a drawdown. You take the account down to just 1K out of pocket, and you've lost the account. Drawdowns happen. We appreciate drawdowns happen. Yeah. Static drawdown is different. Okay, so that's the relative drawdown. Okay, static drawdown is different. Same example. You've got a 100 grand account. Your drawdown is 94 grand. That's the 6%. Same example. You take this into profit. You've got 105 grand, but your drawdown is still there at 94. That basically means you've got 5 is 11% to play with. Yeah, it doesn't trail up with your profits. You take it up to 108 grand. This really gets me, right? You take it up to 108 grand. You've got a 10% profit target. You're up 108 grand, up 8%. And then you hit that drawdown. Well, with a static drawdown that hasn't moved, you've basically got, use my drawing here, you've basically got 8 and 6 is 14% to play with. Do you see what I'm saying? This is going to keep you in the assessment for longer. Now, 14% drawdown, I think you need to be thinking about 14% drawdown. Not a good thing, but it gives you time to assess what's going on. Yeah. 6% drawdown, you know, it's tight. Yeah. But if you move into profits, you come back, you know, you're not trading it up. Get up 2%, 3%, okay, and then you hit the drawdown and think, hang on, what's going on? It gives you time to assess what's going on with your trading. Could be you, could be the markets, but it gives you time to assess. Whereas the relative drawdown doesn't give you any time to assess what's going on with your trading. So you need to consider static or relative drawdown. So coming to the end, so I won't keep you much longer now, but that's basically one of the biggest things I think you need to consider. You don't want to do time limits. You don't want time limits. You want to make sure that you're going to be around tomorrow. You want to make sure that you can talk to someone in the prop to help you, guide you, and as we do, educate you in your assessment. But prop trading is here to stay. Now, so what do we do here at the City Traders? Very briefly, I know I said at the beginning it's not a sales pitch, but I'm going to just tell you what we do here. Now you make your own decisions. We are one phase, so no two phases. It's one phase, and we have no time limits. We have static drawdown. Okay, but we want serious traders. We want people that we can take with us going forward into the years ahead. We're not looking for the get rich quick gambler. There's plenty of places out there you can do that. The casino is one of them. You also have more fun in a casino on a Friday night than maybe sit in front of your screens for 8 hours a day during the day pretending to be a trader. And we obviously offer the Discord community as well, where we train, where we educate, where people can discuss strategies and talk to me each and every day. So that's what we do here at City Traders. Simon has kindly allowed me to come on to the around the clock event today. So what I said to Simon is, if anyone of his lovely community that wants to get involved, I've made a discount code available. I think I gave you that, Simon, which they can access via your. I think you're going to put something in the chat.
We've just put it in the chat, but I'm not sure if we're looking at the same chat, Andrea. Can everybody see that? Or
Well, I can see 2 messages from Chris Coyle.
right. Why am I not seeing the same chat?
Chris Coyle has asked me, how does a prop fund itself and what percentage access rate?
Okay. I think you guys are in the right chat. For some reason, I'm looking at an old chat. I don't understand how this has happened. I'll try and.
You gave me the code a minute ago, so you gave me the room a minute ago. So let me pop it in there for you.
You can pop it in there again. Yeah, I just seem to be on the chat from Adam Harris's session, which was 4. I don't. Could be something. We had a power cut here during Adam's session, and so everything went down. It's because it's quite stormy in here, and then the power cut out. Luckily, I came back in, but I think it's maybe affected.
Okay, well, I've got the landing page that you sent me on Skype a couple of hours ago.
That's great.
So anyone wants to get that, I've given a 20% discount code to Simon. So if anyone's interested in that, then obviously you can fill in that. And with that, with Simon's offer today, I'm doing I have this prop trader roadmap where we discuss strategies and so forth. You'll get that as well if you want to avail the thing via that via Simon's landing page. I think that landing page is working, isn't it? Let's have a look. It should work. Just putting up. Yeah, it does. Yeah. So that basically comes up. You come to this landing page, you fill it all up, and there you go. And it is there for you. Yeah. You still with us, Simon?
I just thinking it was interesting the comparison between the static drawdown and the relative drawdown.
It's a big one. I mean, we thought long and hard about it because obviously I don't want really people having 14% drawdowns. But I also think that I just on my example there. But it does give people. It doesn't when you're hitting towards drawdown, having been in profit, Simon, as a trader. I'm trying to take away some of the emotions that a lot of people fall foul of.
Right.
So that's why we did it. And as I said there, if you are having drawdown, you're not getting close because of this, because it's static. It gives you time to do something about it. That's the thing. It gives you time. And that's what we want to do. We want to take a little bit of pressure off the traders that's why we did that in the end.
I mean, in terms of in a real trading environment, I can see when you're doing the assessment, it does allow some it's a little bit more forgiving, perhaps. But in real trading scenarios where you run with a trailing stop loss, would that be a similar comparison?
Well, trading stop losses. That is a different. It's a different to a certain extent. Because I get asked that all the time about trading stop losses. Yeah. Normally, when I personally when I trail a stop loss, you think, "Oh, great, I'm in a risk-free trade. I'll go with it." But more often than not, you end up giving back on the trail, and you end up excuse all your win-loss ratios and something like that. So yeah, I mean, trailing. There's most people that are trailing, most people that hit drawdown. Yeah, as I said, most people that hit drawdown should be doing something about it if it goes over 6 or 7%. Yeah, as opposed to just being locked out. I would hate to think that someone ever gets, up to 8% and then hits 6% drawdown. There's something going on with the trading there, really. But at least it gives people the time. But when it actually comes to trading a position, trading drawdown, for me at least. I did my own analysis a few years ago now when I was at my old place, and I looked at over a 3-month period, the trail actually cost me money in the end of it. But it is different. It all depends on the strategy. But yeah,
Yes.
they're similar in the.
Yeah, I mean the difference between one trade with a stop loss and the drawdown on the whole account. In your experience, how many trades do people normally open at the same time for these assessments? Is it normally just a single trade at a time, or are people getting a bit more adventurous, putting 2-3 positions on at the same time?
Well, it depends if they listen to me. If they listen to me, I would encourage people not to have a whole bunch of trades going on at one point. Certainly in the Forex market where there's so much correlation, I talk about it all the time. You know, the dollar is 88% of all transactions, right? So if the dollar, like today, is flying up and the Japanese yen intervention, everything's correlated to what's going on with the dollar yen today. So I don't want to have people too many positions open at one point, because if the dollar turns, you're going to get stopped out on most of the trades because they're all so much correlated. But ordinarily, we say, I mean, I've got some people that have got, you know, they're making some really good progress at the moment. That will have maybe 4 or 5 positions open, or they'll scale into a position. They're managing risk, you know, 0.25%. You know, scaling in. There's nothing wrong with that into trades. But having a whole bunch of trades open, 10 trades open at a time, you're in the hands of the gods, quite frankly. I think personally, but everyone's got their own trading style. I monitor what people are doing. We had a guy pass the assessment recently, and I'm trying to get him on a live webinar with me. You know, because I looked at his account, he's just trading. He's only a small account as well. It's only a 15 grand account, but he's doing really well. Over the course of took him a while. It took him 3 months. No problem with that. He did 72 trades. He had like a 69% win-loss ratio. Did really well. He had about 2 or 3 trades open at any one time. Really did well, and I'm looking forward to seeing him scale up personally, because I've just, you know, some people pass and they're, you know, not so, you know, worthy of an outcry, but this guy certainly is, because the way he really controlled his trading.
Yeah,
really liked it.
One of the questions we get asked a lot on this thing is how much do you need to start to trade to earn an income, you know, £4,000 or £5,000 income a month?
Okay.
Based on the sort of an average person, they're maybe not doing it full time. Or what kind of size of fund would you need? Well, here we go. So this kind of answers the question.
Yeah, I just, if I can, from the beginning, how do I? Well, okay, this is just a PowerPoint thing, but here it is. Okay, so most people aren't starting with the $5,000. Most people are chancing with $1,000. But let's assume you're starting with $1,000 or $500. You know, $500 at 5% gives you a 25% return. $25. Now that doesn't keep you focused. Okay, and if you annualize that, if you compound that up, it will give you $397 at the end of the year. Yeah. Now, for a $500 account, $500 in an assessment account that you want to take seriously, we pay out 80% profit split. That would give you, with your discount and a bit more and a bit of change, $100 grand account. Well, the same 5% gives you a $4,000 a month return. So for $500, learn how to trade properly, do this right, control your risk, don't ever go to gamble, go down to the casino, or do it on one of the prop firms that want you to gamble because they know you'll most probably fail. But if you want to take it seriously and you want to invest in an assessment, $4 grand a month, well, 5% of 100 grand compounded up is 179,000. That's 79,000 profit. Just 80% would give you, so it gives you an annual income of 63 grand for once you can do it. Now, obviously, no one can do that from day one, right? No one makes, and 5% is a really healthy return, Simon. I mean, you've been around long enough to know that anyone that promises 5% every month.
You're stretching my O-grade maths, but yeah, when you're talking about compounding here, you're talking about taking these monthly profits and just reinvesting into the trading account and actually.
Absolutely, yes. So you've got, if you start with if you have a 100 grand account and you make 10%, then you've got 110 grand. Well, then if you make 10% of 110, well, that's 11 grand. So then it goes up to 121 and goes up. That's basically compound.
But you must still be putting these slightly bigger trades on every month.
But your position sizing, you're still risking the same percentage, but the dollar value is increasing. The thing is with compounding, Simon, is when you're growing, when you're having the winning streak, your trades are getting bigger. and when you're having a losing streak, your trades are getting smaller, and we all have losing streaks. I mean, so that's why compounding. But to get a £5,000 a month income using your own funding, I mean, I don't know what £5,000 is quite a good income, I think, for people these days. But let's just do it because the numbers are easy. But £5,000 a month income using your own money. Well, as I say, there's the numbers. You need 110, 20 grand in the account. And most people haven't got that.
And will you, I mean, and you provide some sort of ongoing training why people go through
this? Yeah. So yeah, absolutely. So we've got our what is it? We've got our trading community there, which is basically So yeah, we've got a Discord community as well, where people can join our Discord, but they can get more information by Googling, by filling in that form for you. But yeah, we've got ongoing. I stream every day, and we're in there looking at all the different trading entities and so forth. And so yeah, it's ongoing. We try to do things differently than the big boys. I can't compete with the big boys in their in their approach, but I can compete with them in terms of education.
It must be quite nice in the group because everybody else is going through the assessments at the same time.
Yeah, we've got a whole bunch of. You can see that in the Discord, the people that are in the assessment phase. If they choose to let us know, they can keep themselves private if they want, of course.
Right.
Yeah, absolutely. So they can chat amongst others. Trading is can be quite lonely, I mean, so it's been nice to be in the community. If people want to join in and chat with others. And I trade two basic strategies that I teach as well that are, one's a trend, one's a counter trend. I mean, so it's good to see the community chatting about, I call it a certain name. I mean, people can find out if they want to fill in your form and all that. But I mean, it's like the boomerang strategy and, people are discussing, is this a boomerang long? Is this a boomerang reversal? Is this a boomerang trend continuation? So there's just a community going around looking for the strategies that we sort of teach, really. Yeah.
Listen, Andrew, thank you so much for joining us today. You've put together all the slides and the information, the updates. Great to get a whole snapshot of the industry. It's certainly evolving, but I agree with you. It's here to stay. It does offer a great opportunity for traders, I think, to be able to get a fair chance to make a fair income without risking the
Yeah, sorry, Simon. Chris Coyle is reiterating. He's asked me this question before, actually, Chris. How does a prop trading fund itself? Oh, there's two ways of funding. You have funding with obviously the assessments pays for all the back office staff, and obviously not everyone passes, so that helps with that. And of course, we fund traders after 2 months of successful trading. We put them into a live funded account on margin, my margin. If you can prove you trade, I put the margin up, and I take 20% of the profits on that. Success rate of the props in your prop firm. We've only been going on this new one for about 4 weeks, starting on the 21st of February. So it's too early to say on that at the moment. I will say now we've only had one person, two traders now, because one blew up overnight, that have lost their assessments, because I think we're attracting the right type of traders. So success rate, I'll answer that in a hopefully in a month, 2 months time, Chris. But thanks for the question. Sorry, Simon.
Chris, I'll have your email as well. I know the button. You've got a problem just submitting the form, so I've got your details. I'll forward them straight on to Andrew. Thanks for that. Terrific. Many thanks, Andrew Lockwood, Syndicate. Hopefully we can have you back again in the future. It's always interesting to listen to what you've got to say, and I appreciate the time. So have a nice Easter. And
thanks, Simon. Thanks for inviting me. I'm looking forward to the rest of the contributors later today as well. So thanks again. Gives me something to do this afternoon.
We're moving right along. Thanks very much.
Thanks now. Bye-bye.
The last couple of years, really, done some events. You've been at the conferences. I know you do some work with Active Trades in the UK and overseas, and you're building up a community of traders, offering them mentoring and live trading. So fantastic. It's all in front of us, actually. As I'm doing this, I'm realizing you want to work through this. So you can do a better job of it, Ross. I'll hand over to you. I know we're going to look at some live charts. I know the US markets are almost open, if not opening up as we're speaking. So it'll be quite interesting to see what's happening in the live market. So I'll hand over to you, Brad.
Lovely. Thank you very much, Simon. Always a pleasure being here as well. So thank you very much. Right, guys. So yeah, just a bit of a background information on me, and then we'll jump into some live charts. Look at the US markets. Look at the US session. Obviously, at the moment, the US markets are opening a little bit earlier with the daylight saving. Next week they go back to the 2:30 open, but there's just been some news out as well, so we can look at the markets. And what I'll do is I'll look at the time at sort of like the 1 hour and 4 hour time frames, show you the way that I sort of set up my charts. And then look at some of the levels that I'll be looking at over the sort of coming week or so that you can go away with a bit of an idea of that as well. So for those of you may have seen me before, like as Simon said, I've been doing these round the clock. I've been speaking on behalf of Active Trades at some of Simon's conferences and events here in London. So you may already know me, but just for those of you that may not, I'm obviously Ross Maxwell. I am a full-time professional day trader, and I've founded an online trading education company, which is called Keyzone Traders. I've been trading the financial markets for more than 20 years. I started off when I left school. I worked in London and Hong Kong before quitting, and I became a full-time independent day trader in 2014. And then from 2017 until now, I've been coaching and mentoring other traders who aspire to be independent traders as well. And that led me to be the founder of Keyzone Traders in 2021. So I've been Keyzone Traders now for about 2.5. It was the end of 2021, so about 2.5 years now. So with that said, let's go jump into the charts. I try and keep the charts very simple. I think we overcomplicate trading quite often. So I look at the charts in a very simple way, very much a price action based trader. I look at the markets in terms of zones of support and resistance, and I try to identify where the institutional order flow is using footprints that they've left before. So one thing that I often get, so there's no coincidence that the name of my company is Keyzone Traders. As I say, I look to the markets in terms of where key zones are, and they give me my trade locations. So I just want to show you a very simple way that I set up my charts going forward. So blank chart to start with. We'll look at the S&P, we'll look at the Dow Jones, we'll look at the NASDAQ, and then if we've got some time at the end, we can look at sort of euro, dollar, and crude oil as well, just to give a view of the variety of different charts and stuff. So I plot my zones of support and resistance on the chart. Now, there's a very simple way of doing this. It's not an exact science. People always ask me, like, how do you work out how big your zone should be, etc. I use, when I'm teaching this, I don't necessarily use it this way because it can be a little bit subjective, but a good guideline as to how wide your zones of support and resistance should be is if you go to the average true range on your chart. So it's an indicator that you can plot on the average true range, which tells you like the most recent volatility in the market. And this is represented by this red line here. So you can see that generally speaking, if you run the cursor over the top there, it's about 20 points on the S&P on the hourly chart. So therefore my zones want to be about half of that. So about 10 points. And we'll hopefully why that is will become clear as we move through. So what I would do then is I draw a zone on the chart. You can use MT4, TradingView, any trading platform will have the functionality to draw like a rectangular box on the chart. I then go to the settings of that box and I just make sure that they are 10 points wide. Okay. And I will spread that across the screen, so I've got it got the full functionality across the whole thing. And now simply all I'm doing is I'm looking for areas in the market to drag this zone around where there has been repetitive price action, both as support and resistance. And you can actually see one right here anyway, as we here we've got it touched as resistance here, and then it's been turning support here. It's turned support again here, excuse me, sorry, here, and it's turned support again here. So now that tells me that this is an area in the market that the institutions have had their order flow, because it's the institutional order flow that moves the markets. it's used it as resistance and then acted as support clean. So that tells me next time we move down into that area, I will be looking to buy there and potentially look for a trade. So that's one area that I have. And now I'm going to be looking for other areas on the chart that have similar patterns. So I can just replicate that zone. So now, and again, this is a very simple way of being able to just drag the zone around to try and find those areas in the price action. Now, there's a couple of things that we should really be looking for. We want to be looking for these really clear swing points in the market. And we want to be looking for the places that haven't been traded for a while. So again, down here, this area here hasn't been touched for nearly 3 weeks. So that's going to be an area of interest. We've got a nice swing high here. And this actually coincides with a couple more touches of resistance here. We show you here. And then we've got it here. And then we've got it here as well. Okay, and then we've broken through and we're looking for a retest. You've heard of breakout retests. So again, this will be an area of interest. We've broken through and we still need to retest this area. So that will be another area that I'm looking to trade. Excuse me. If we get another look at the zone, these are your all-time highs. Now, I wouldn't necessarily always look to trade these because there isn't repetitive nature, repetitive price action. We need to exercise patience to let price develop when we're at all-time highs, because we haven't had that historical footprint yet from the institutional order flow. We've just got one touch of order flow historically. So we can't always trade those, but certainly these other areas in the market we can look to trade. This area here, you can see it's all quite choppy. You may actually find some areas in this zone that has some form of repetitive price action. So somewhere like this, where you've got resistance and you've got support, but notice the rest of this price action here is all very choppy. It's like it doesn't respect the zone very well. It doesn't respect the zone very well, like this zone here, where it's acted as resistance, then support, support, support. And again here, this zone has been acted as respected as resistance quite well. So for something like that, you can do one of two things. You can either delete the zone, or you can change it to another color. So I use blue and I use green zone. The reason that I do that is because now I have the clear areas in the market that are well respected, and these are the areas that I actually want to be trading from. These are going to be where my trade locations are. These are going to be where I'm entering my trades. These minor zones that I call them, because they are zones that do have reactions, but they're not as well respected. These are zones that I can target, or at least look to manage my risk in those areas, because there is the potential that the market is going to react from those. So I want to at least be managing my risk, if not using it as a target. And if we can just use this as an example, this green zone here, if we can get a buy trade in this blue zone here, and we can just go for we'll have a stop below the zone, and we target that zone there. You can see here, you still got a good 3.5 to 1 risk to reward trade. So by using these zones as targets, you can still get really good risk to reward trades. So that's sort of it in a nutshell. If you've got any questions in regards to how I plot this, hopefully you can see it's a fairly simple way of looking at the markets. We're just identifying that order flow. But other than that, we can go through these charts now and have a look at some more of the levels, and then we can go and have a look at some other charts as well. So other levels that I'd be looking at on the S&P, you can see here, this area here, we've got it acted as resistance, then as support, acting as resistance, a little bit of chop here, but then it's acted as resistance here. So I would think that's just about okay to be a zone of reference that we could potentially look to trade from. And then I can just see one other one just down here, whereby you've got resistance, turn support, turn support. So again, that's another area of interest there. And then one final one that I can see is down here. Now, you don't want to go back too far on your time frame. If you're having to go back too far, you may as well just switch. There's no point looking at a chart like this trying to identify all the support and resistance zones. You may as well just stay within that time frame there. And if you want to go further back, then just move up a time frame, move up to a 4-hour time frame, just to double check to see where the historical price action is, and to plot your zones of support and resistance on there. Because otherwise, you're just looking at the same data, but in a really condensed, more difficult to view fashion. So that's the areas that I'm looking to trade on the S&P. So obviously, the way that the markets are at the moment, you know, these equity markets are just pushing higher and higher. You can see this ever since, October last year, we've just been on this really strong push on the equity markets, making all-time highs after all-time highs. So when we are in those trending markets, we want to be looking for those areas of, that we can pull back to, that the buyers are going to see value, and that's where we're going to look to trade. I will try and look at crude oil and euro dollar soon as well, because they'll be more range-bound markets than these trending ones that we're on in the equities at the moment, and hopefully that will show a slight difference in terms of the way that we need to look at support and resistance and identify them. But at the moment, in these equity markets, these are going to be the areas. So we've got one there around about 51.80 to 90, and then the next one there below it around 50.50 to 50.60. They're going to be the areas of the market that we're looking to trade on the S&P at the moment. So if you do have any questions, please do let me know. Other than that, we will move on to a couple of other markets. And like I said, we'll try and get euro dollar and crude oil in as well, because they're just a little bit more range-bound markets. Again, moving on to the Dow Jones, the ATR on this is around 80 to 90 points, so we can use sort of 40 to 50 point wide zone. So again, we draw a zone in there. We just adjust the zones to be that wide. Let me just change the color on them. We'll just look at the main zones now, because I appreciate we've only got about another 15-20 minutes to go. And like I said, I'd really like to get into those euro dollar and crude oil charts. So this area here, you can see, and this is where sometimes you may need to show a bit of be a bit more dynamic. You can see here that this is the key swing support zone. This is where that's been held twice, but it doesn't quite take in these two tops here. So you may sometimes just wish to adjust that to take that in. So that would be 39,230 to 39,300. So we're just a little bit wider. So we're about 70 points wide. So it's quite a wide zone, but you can see that that actually does take in that price action there. So just something to be a little bit more dynamic on. Other than that, on the Dow Jones, you notice this price action is all quite choppy. There's not the clarity that we saw on some of the S&P zones. Let's just adjust this back to a 50-point wide zone. We're going to have this sort of like key swing point up here, which is your all-time highs. And then let's just clone that again, and we'll drop this down to look for some of these other another clear point, which there really isn't until you get down to this support down here. Now, just looking at this, I can tell there's a few more of those green zones that we spoke about before, where there have been some reactions, but it's not completely clean. So for example, you've got this sort of area here, and you can see that we've acted as support here. This here is acted as support, but it's not very clean. It's acted as support here, and again here, broke through, resistance, unclean resistance twice here, so it's not respected that zone very well there. Acted as resistance there, again, choppiness, not acting as very clean support there, and not acting as very clean resistance there. So just notice how around those green zones that we can see there are reactions, but just it's just not as clean to be able to really look for a high probability trade location. And then finally, another one that I spotted was just up here. We have got another one around that zone there where you've got, look, resistance here, resistance, 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 unclean, and then it's a bit unclean here as well. And then finally, I've got this zone up here. This potentially actually could be a blue zone because it's actually acted relatively cleanly. We've got push through, but then it's acts as support here, then turns resistance here, and then also acts as resistance here. So the only thing that I would sit there and say is the pushbacks are not very strong from there. So it's still relatively new price action that the price is developing. So I would keep that as a green zone at the moment. So any questions on the Dow on there? So really on the Dow, I wouldn't be looking to look for a trade until we get back to 39,230 to 39,300 on this time frame. Okay, let's quickly go through the NASDAQ and then we can start looking at a couple of the other trades as well. So again, if we look at this, these are 75 to 80 points wide, so we're going to be wanting 40-point wide zones. Okay. And as you can see, this one really is extremely choppy. You can see this is just very, very choppy. So there's not going to be too much in here. You can see here we've got this area here of support. And when we go out to the higher time frame, you can actually see it is a little bit choppy here, but support, 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 and it was acted as resistance here. So at the moment, that would be your key swing point on the bottom of this range. And actually, this is quite a nice one to show you because this is a much more range-bound, choppy price action than the S&P, and certainly the S&P and more so than the Dow as well. So when we see this sort of chart, we really want to try and identify the real clean edges, and that's where we want to trade from. When you start getting involved in this, you'll just get chopped out. And if we look at this from a probability point of view as well, hopefully it will just explain it and show as to the reason why. So I think that area there is sort of a minor zone. You can see it was acted as resistance, 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 resistance here, bit of choppiness, and then resistance again here. So if we take this area as an example, maybe just move that up a bit there, something like that. So this is actually acted as support here. If we look at this, we've had one touch here, which has had a reaction. Then we went straight away through it. Then we moved through it again. So that's three potential trades, 2 losses. 2 times it didn't respect it, once it did. Does respect it here, so that's 2-2. Respects it here, so that's 3-2 in terms of respecting it. Doesn't respect it here. Doesn't respect it here. So that's now 4 times out of 7 times. That's 4 times it did not respect the level. It retouches it again in here. So that's 50% at the moment. 4 times it does respect it, 4 times it doesn't. This time doesn't respect it. This time doesn't respect it. This time it does. This time it does. So again, now we're 6 times it respects it, 6 times it doesn't. 7 times it respects it, 7 times it doesn't. 8 times it respects it. So that's of the last 15 times prices entered that zone, only 8 of those times has price actually respected that zone. Whereas when we look at something like this, the last 3 times, 3 of the last 4, if we say that, 3 of the last 4 times that prices entered that area in the market, prices respected that zone. So just from a probability point of view, this is about 50%, this is 75%. So you by placing yourself in those areas that are clean, that are well respected, just from a statistical point of view, you are giving yourself a higher chance of entering an area of the market that is more likely to react. So that's really, and that's why sometimes if you look at this, so that first trade there was the 15th of March. The next trade up here was 21st of March. So you've got a whole week there on the hourly chart, which just doesn't have a potential trade here. So you actually, to be fair, this is an all-time high, so you wouldn't have traded this anyway. But if we just look at these support areas, okay, the first trade here, 29th of February. The next trade that you would have got was the 15th of March. So you've got 2 weeks there where you potentially wouldn't have had a trade on the market. And that's why in these range-bound markets, you need to exercise the discipline to wait for those cleaner edges. Because what happens is a lot of traders get chopped in and out and have a lot of losing trades in these middle sections, and that's where they actually lose their money. Whereas if we wait for these cleaner outer edges, then we're giving ourselves a higher probability trade location. So much more important to wait for those areas and exercise discipline, which means that you're going to have to wait for a while. In the trending markets, like we've got on the S&P at the moment, you still have to exercise discipline and patience, because you've got to wait for the market to come back and pull back into these areas here and retest these areas of breakouts to get your trading opportunities. So we're still looking at support and resistance. Just the way that you approach the markets is going to be approach to support and resistance areas is going to be slightly different. So is that quite clear for everyone? We've just got 5 more minutes, so I will look at one more market. If we look at the euro dollar, because that's one of the most traded instruments out there. And again, same process. That is an easy one to follow. Just use your ATR as a guideline. So that's sort of 12 to sort of 14 points wide. So we can use 7-point wide zones on this. Change those to blue, and the FX markets are a different beast to the indices as well. So as I say, we look for the clear areas in the market. So I would sit there and say that this one looks like a false break. And again, if you want to get more context from the level, rather than sort of like trying to scroll about looking at it like that, again, what we can do is we can just go to a 4-hour time frame and look at it there. So again, you look at this on a 4-hour time frame, actually that area there looks like it's the stronger level, because we've got the touch here, but it's also the things here. So just by moving out in it, moving out, you can actually just see that actually that's probably the zone, rather than it's probably actually more around that area. So that's why it's important also to just get that bigger picture and use the alternative time frames. Down here, we've got an area here which has been respected quite well. We're just looking like we're potentially getting a false break pattern here. So it'd be interesting to see whether this area holds on a retest of that area. And then finally, some other couple of areas in the market that we're potentially looking at. This one again here. So it's respected here. Moves through support, 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 support. Breaks through, acts as resistance, breaks through, breaks back down, acts as resistance there. So that's quite a key area in the market as well. That area there is probably, I'd say, a green zone, because we've had, quite a bit of two-way action. Like these are all probably just your mind. Actually, that one there may just, no, even that's probably just a minor zone. because of this two-way action here. You can get this a lot more on the FX markets as well, because you're pitching one currency against another. Sometimes the price action isn't as clean, especially because it's more, it can be dominated by news a little bit more as well. So yeah, something like that. So this one might be a blue zone actually. You've got respected as resistance there, support, resistance, resistance. There's a bit of support here, so that might be something you consider as a blue zone there. Right, guys, so that's some levels to look out for. These levels should, generally speaking, be there and give you an idea of some levels that you can trade over the coming sessions in the coming week or so. But if you do have any other questions, please do let me know. Otherwise, Simon, I think my half an hour is up.
Thanks, Ross. Yeah, we've got 5 minutes or so for any questions. These are the key zones. This is why you're the key zone trader, yeah?
Yeah, exactly. So Indy says, what's my lower time frame trigger to enter at these hourly levels? So that's really, Indy, that's really up to you and your trade plan. And I think it's really important to stress this as well. So, you know, candlestick pattern. Say we've got a pin bar, for example. Say you trade pin bar reversals. It's not a pin bar that causes the market to reverse. It's the area in the market that causes the institutional order flow in the area of the market that will cause the market to reverse. So if you trade pin bar reversals, then your trigger will be for the market to move into this area and then set up a pin bar reversal. I actually, generally speaking, just use limit orders because I have confidence in my ability to pick the zones and just use limit orders with stops behind the zones, and I target the next one. But if you have a strategy in place, then you can look for the market to move into these areas. And like I say you trade, I don't know, 5 minute Bolly reversal, for example. I don't know if that's just a pattern that I used to trade, so where we have Bollinger Bands on there and we look for price to like move into these areas and then reverse. That could be your trigger candle. These don't actually happen here, but okay, something like that. You know, you could look for the market to move up into that area, move outside the Bollinger Band, back inside, and then you would enter a short there with your stop above the reversal. And I mean, you've got quite a big trade there, especially if you're going down to that sort of that blue zone there. I don't know where. So that's what over here you've got like a 5-to-1 trade, something like that. So you can use your own trade plan around those zones. Basically, there's no right or wrong or anything like that. I personally, as I say, use limit orders. But if you have, it's basically use these zones to identify the highest probability areas in the market, and then once price enters the zones, you switch to your trade plan to work out the patterns that make up your trade plan to get into the trade. It depends on your strategy, Guy. I generally have a sort of 65-70% hit rate with these, and I think, you know, that's because, again, if you look at the zones that I'm looking to trade, they are respected sort of 75% of the time. I'm not looking to trade these minor zones that have a lot of chop. If you want to trade these minor zones, you know, your hit rate's probably going to be 40-50%. Now, the risk to reward on that may still make them profitable, but you're going to get a lot of choppiness. You're going to, you know, have bigger drawdowns and those sorts of things. You may need to use wider stops because the clean action isn't or price action isn't as clean. If you stick to these clean areas, these ones where the price action respects the areas when it moves into them, you know, you should be hitting 60-70% hit rate on these quite comfortably. Cool. No, I don't use any indicators. I mean, look, in my courses, I teach using some moving averages like the 20 and the 8, and for some strategies, the Bollinger Band. Those are the indicators that I have used in the past in my trading, but as my trading's evolved, I don't use any indicators. I just literally use price action, support, and resistance. I think it's really important not to use too many indicators because it clutters up and adds extra layers of thinking. And actually, you know, all an indicator is doing is giving an indication of the price action that's already happened on the chart. So once your experience grows, you should be able to read that in the chart anyway. So, I mean, the ATR is, again, I don't use it because I've got the experience in the markets, but that's an indicator that people can use to try and work out how wide their zone should be as a guideline. And as I say, moving averages and Bollinger Bands are two of the other indicators that I teach. But me personally, I don't really use them. I still have my moving averages plotted on my chart, but that would be it. I mean, I don't really use them for my trade and my actual trading now. Okay, so your hit rate is 54% on 63% of traded days. Okay, now again, 54. You know, I know successful traders who only have a hit rate of like 25-30%. But because their risk to reward is really good, they still have a profitable edge. Now, if you have an 80% hit rate, but you know you're only making half an R, like 0.5%, and you're losing 1% on all of your other trades, you know that's not a very good strategy. So it's really important to understand the edge as an overall in terms of your risk to reward and your profitability as well.
Great, Ross. I've put the link there to the landing page that we're using with you.
Yeah.
I've just it gives people access to the live trading room, and is that a week?
Yeah. Exactly. So I run a live trading room every single week. I usually run it on a Monday. Next week, because of Easter Monday and the fact that I'm away for the weekend for my birthday, funnily enough, it's going to be on the Wednesday. Generally speaking, it's every Monday. Other than that, where I run a session a bit like this, where I look at a load of charts that my clients want to look at. You know, I'll analyze them and really look at all the levels that we're looking at for the week ahead across a variety of different markets. So that I run that once a week, so you get a couple of weeks access to that if you sign up. And also I run a free Discord community which gives out market analysis, you know, free education in terms of videos, tips, blogs, and trade alerts and that sort of thing, as well as access to other sort of webinars and events and stuff that I'm holding. If you're going 3-to-1 guy, then you know, if you've got a strategy that is minimum 3-to-1 and you got a 54% hit rate, you have a very good strategy there. You have a very good strategy. Do I charge a sub? So I do for some of my courses. I have a beginner's course, which is a one-off fee. I have an academy course, which is a quarterly subscription. But the access to the Discord channel is completely free of charge. If you can use the link that Simon's posted in the chat, you'll see that there. But yeah, as part of my quarterly subscription, you get daily analysis on the FTSE, the DAX, the S&P, and the Dow Jones, as well as other markets as well, and trade alerts and things of trades that I'm looking at. And the subscription's on a quarterly basis.
Fantastic, great, Ross. Thank you so much.
Thank you. It's a pleasure.
Finished right on time, which is great as well. So we appreciate that. We'll chat again, but in the meantime, have a good Easter. Have fun with the kids, and we'll connect when you get back to the desk. And hopefully we can have you back in the future.
I'd love to. Always a pleasure, Simon. Thank you very much. You have a great Easter as well, and thanks everyone for taking the time to join today.
Many thanks indeed. Okay, we'll head straight on to our next session with Alex Spiriglou.
Cheers. Take care, everyone.
He's going to be talking about Bitcoin and the gold and oil. So stay tuned. We're going to pull you through. We're just going to go straight along without any breaks. And investors talking about the markets. And I'm pleased to say that we have Alex Spiriglou from You're Alex Spiroglu now. There was Smart Trader Systems.
It is. Well, it is Smart Trader Systems, the company. Alex Spiroglu is the personal branding website.
Yeah, personal brand. Everybody's a personal brand nowadays. It's great to have you here. I know we've known each other actually quite a few years, really, since we've been doing various webinars.
Absolutely.
And we're talking at the conferences in London and the shows, and building up quite a good reputation for your community. So it's great that you're here. I was looking for someone to talk about Bitcoin, because obviously it's come on the radar again this past year. After the big highs and lows, there's a halving coming up. You can maybe tell people exactly what that means, but it's interesting to see it. You know, a lot of people are comparing it to Nvidia, the tech stocks, and also with crude and gold. So I'll hand over to you. We've got about sort of 30 minutes and a little bit extra for Q&A, so I don't want to take up too much of that time. Over to you.
Perfect. Well, thank you very much. As my dear friend Simon said, my name is Alex Spiroglu. I'm a proprietary trader trading futures since late 1998. I'm a semi-systematic trader. You can roughly translate as a rules-based discretionary trader. My time frames are short-term in the sense that I hold positions 1 to 5 days. I also have a portfolio for intermediate-term futures trading, which this is what I call anything from 2 to 3 weeks, position trading. And then I also have a portfolio strategy basic for long-term trading, but for that I use ETFs. Now, today's presentation will focus on Bitcoin and crude. And at the last moment, I wish I had included gold as well, because actually I got a long signal yesterday. I've been long gold since yesterday. And but I haven't included that. Instead, perhaps we can do a special with Simon later on. So what I'll be doing is presenting the Bitcoin and crude oil. And I think the most important thing is not so much the analysis here, but the methodology behind the analysis, because I'm not here to give you a recommendation by all means. But what I'm here to show you is a way how to combine technicals and fundamentals, and how to see what I do from a multiple time frame, multiple factor approach, and a semi-systematic rules-based approach. Okay, so without further ado, Bitcoin and crude oil. Simon, can you see my slides switching, going from the first to the second one?
Yep, all good.
Perfect. All right. So I have some attendance bonuses for those that manage to stay awake, because I have a bad habit of putting people to sleep. So the first attendance bonus will be I'll give them an awarded paper. In 2022, I wrote a paper study called MACD, Volatility Normalized Momentum. It was a breakthrough, if you will, because it managed to solve the 5 problems of the MACD indicator, and also bounded indicators such as the RSI, the stochastics. And that paper was awarded by the National Association of Active Investment Managers, the Founders Award, and the Chartered Market Technicians Associations with the Charles Dow Award. So that will be your first bonus for those who attend the presentation to the end. Also, the indicator has been embraced by the professional community. It's already been programmed in stock charts. People have done it in AMI Broker. Soon it will be very soon it's in Metastock, MT4, Optima, and TradingView as well. And last, I will also be doing some MACD momentum model webinars, a bit more advanced than the awarded paper. So all you have to do is stay awake and email me at alex@alexspiroglu.com. So without further ado, let's go on with the presentation. I'll try to keep it concise. So the first thing is the risk warning. Unfortunately, a lot of some people at their presentations offer you guarantees or speak about performance guarantees. This is not one of these presentations. Actually, what I'm saying is there's a very high degree in risk involved in trading. And if I was to make one guarantee, that guarantee would be that you will have losses in trading. So with a risk warning out of the way, let's go. Bitcoin and crude oil, where to from here? So this is my multiple time frame multiple factor approach framework. You can use it both as a chart checklist and also as a learning path for someone who is looking to learn this methodology or is new to trading. So my core belief is that different timeframes have different return drivers, different factors affecting them. So my operating timeframes is the monthly, the weekly, and the daily chart. Although I do short-term futures trading, I always try to see what's going in the higher timeframes and also the fundamentals as well. So I try to have both technicals and fundamentals. But for each time frame, I think that there are different factors affecting it. So for example, the monthly chart, I primarily look at the business cycle. Then I switch to the weekly chart and look at the commitment of traders report, sentiment, and seasonality. And then when I switch, after I've got my my setups on that for a buy signal or a sell signal, then I switch to the daily chart and using my technical methodology to look for a buy or sell signal. And when I've got that, I construct strategies. So the strategy, I try to combine this to have a strategy, is what I call the Forest framework: setups, signals, stops, and size. Which basically setups is the reasons if I want to go long or short. The signal is where I actually get in. The stop is, either the 4 types of stops that I use. One is obviously the stop loss, and then I've got some hybrid and take profit techniques. All of them are rules based, and the size. Now, the setup is semi-systematic, which means I see what is going on the weekly and the daily time frame, and with this I construct a rules-based approach on, for example, the setups to decide on, of course, rules-based, but there is a discretionary element whether the market is set up for a buy or sell. So that is the that's why I call it a semi-systematic method. So the setup is rules-based discretionary. The signal is fully systematic, which means once I have a methodology to, or once I have a decision to go long or short, then the signal is fully systematic. The stop is fully systematic, and the size also is semi-systematic. And then because I have a range of portfolio exposure that I will allocate to a particular trade. And that is based on the convictions that I have. It takes a bit of time to explain all of it in detail, but basically I want to show you this framework so you can help you visualize and understand how you can do semi-systematic and be a rules-based discretionary trader, and also how to combine multiple timeframes and also multiple factors. So I won't go into the business cycle for Bitcoin. What I will do is go into, first of all, to the commitment of traders report. So for each factor will be highlighted and then explained a bit. So top chart is the Bitcoin. Bottom chart is the commitment of traders report, the net commercial positions. And I'm not sure where you are for the commitment of traders report. I'll briefly explain that commitment of traders report is basically for the futures markets. The CFTC records the large traders, basically traders who have over a reporting threshold. Basically, they have a huge position in futures, so they call it overnight, not day traders. And these are subclassified into large traders like hedge funds and also commercial traders. These are basically big firms who operate in futures markets because they have a legitimate business in it. For example, now that everyone's watching Cocoa being in such a rally, Cadbury's would be trading sugar futures and cocoa futures as part of its business, not to speculate. So a hedge fund would be participating just to for speculation purposes. So the CFTC provides these positions in aggregate, not for each firm. So in aggregate positions for hedge funds, for large firms, for example, all the cocoa in the cocoa market or on the energy market, and based on these, we can create macro signals. I do a webinar for the COT report. It usually takes an hour and a half. I'm just doing the brief version of it, trying to explain what we see. So what we see, the bottom panel is the in the position of the commercials in thousands of contracts, so we can see if they're long or short. And I have created an alert system, a COT signal system, that gives me alert, buy and sell. Well, I wouldn't call it exactly sell signals, but more like alerts on when the big traders are coming into the market. So based on that, we had a buy signal 6 weeks ago. Of course, I do not buy on these signals because these are on the weekly chart. So what I do, once I've got a market set up from a commitment of trader point of view, then I switch to the daily chart to start looking for entries. So going back to Bitcoin, this is a bullish factor. Next part is sentiment. This is a very important factor because sentiment is inversely correlated to liquidity. If a lot of people are bullish, excessively bullish, then there is not enough money to go into the market because everyone's committed to the long side. And when the sentiment is excessively negative, then there is no one else to get out or short the market. So inherently it will go up. So there are many ways to quantify market sentiment. And this is the sentiment, one of the sentiment indicators I use for Bitcoin. As you can see, it's a bit excessive. And I've noted previous occurrences where market sentiment was bullish or bearish. And of course, the other arrows are from the COT signal system. So using this step-by-step roadmap, I can, as I mentioned before, we can combine technicals, fundamentals, and everything in a rules-based fashion. Then I go into seasonality. And with seasonals, this is the seasonal chart of Bitcoin at the bottom part. And as we can see from the bottom left part of the chart, from Tuesday, the 2nd of January, up until the 2nd of February, there was a bearish bias from a seasonal point of view on Bitcoin, and Bitcoin followed that pattern. Then from the 2nd of February up until the 16th of February, there was a very bullish pattern from a seasonal point of view, and Bitcoin followed that pattern. Then from that 16th of February to 26th, there was a bearish seasonal bias, and Bitcoin stalled during this period. Then from that point onwards, from the beginning of March until the middle of March, there was a bearish bias for Bitcoin, but Bitcoin rose. And going forward, we see that it's a seasonally bullish period for Bitcoin up until the 2nd of May. There are many ways to calculate seasonals. Practically, from a look-back period point of view, you either do it on you can use the whole of the data, 5, 10, or 15 years. Each methodology has its pros and cons. Again, this is a different seminar on its own. For this chart, I use a 15-year look back. Sorry, 10-year look back. Then after so at this part, I studied the macro factors, sentiment, seasonality, also intermarkets, which I forgot to put on the chart. And using this methodology, I get a gauge if I want to be long or short the market from a fundamental point of view. If I had two factors which line up in the same direction, then I think that my market is set up, and then I go into the signal generation. So I need two fundamental factors to give me a green light or a red light for a short position. So the trend roadmap, I haven't included in this chart because I'm actually programming this right now in TradingView. But I think it's safe to say, looking at this chart of the Bitcoin, in this case, the trend is obviously up. Then I go into the MACD, the momentum model, because if trend is direction, momentum is speed, the speed of that trend. So the bottom chart is the MACD momentum model. The MACD is the twice awarded indicator we talked about. So as we can see, whenever the indicator was above the risk range, above 150, the market stalled, and now it is at the risk range above 150. It's kind of like overbought, as you see. Now there was a bit of divergence from the 7th of December of 23rd. And one of the reasons I like using this indicator over bounded indicators like the RSI or the stochastics is that because these are bounded, they don't form divergence quite correctly. So going on to the histogram, as we can see, in late March, the MACD histogram was at the oversold area, and that's why we got up the bounce of also noted on this chart previous occurrences. And then I go to the volatility valuation. Volatility valuation is an indicator which tries to attempt to see if volatility is excessively high or excessively low. And as we can see now, it is excessively high for Bitcoin futures. I've also noted previous occurrences. And then also have relative ranker. Relative ranker basically is a way for me to have the markets and see go from strongest to weakest. It's a very important step in my methodology, because if you want to be long a market, relatively speaking, all things being equal, it's better to be going long stronger markets and to be shorting weaker markets. So as you can see, Bitcoin is quite strong. It's actually the second strongest market right after cocoa. So let's go into the setups. So in this part, what I do is I go to what I call the chart checklist, basically all the factors together. And using this methodology in just a few minutes, in a very rules-based approach, I can check, I have a chart checklist and then decide if I want to be long or short. Then I go to the daily chart and start seeing the signals. So in a very, using this methodology, I get to have a lot of, develop a lot of confidence and discipline, because everything is, it's very rules-based. So the chart checklist, this is a recap of what we saw. COT close to bearish, sentiment is bearish, signals are quite bullish. The trend is of course bullish. Momentum is long-term bearish. Volatility is bearish. The relative ranker is very, very strong. So for this market right now, for Bitcoin, because of the fundamental factors, although the trend is up, but the by and large, because of momentum, sentiment, commitment of traders depart, I will be choosing to go, normally will be choosing to go short the market. But because the relative ranker shows that it's excessively strong, I will not be taking any short signals. So my current position for Bitcoin would be flat. I will not be taking any positions for Bitcoin. So if someone wants to be shorting Bitcoin, going into the signal part of my methodology, as I mentioned, it is completely automated, and this is how it would look like. Obviously, I will not be taking both buy and sell signals, because I want to have a bias. So if I have a bias, I will be taking just the buy signals. If I want to be short, I will be taking just the short signals. So this is how it would look like. So having had a bias, for example, a bullish bias on this, I would go into the chart and wait for my methodology to signal a bullish chart, buy signal. So for Bitcoin, I'm flat. I have a position in using this methodology for gold. So let's go into into crude oil. We'll be following exactly the same procedure for crude oil. Again, commitment of traders report. At the bottom, we see commercial traders being short 323,000 contracts. And what we see here is actual positions of large traders, 323,000 contracts. And the COT signals I've got on the chart, we had a buy signal, that's 1, 2, 3, 4, 5, 6, 7 weeks ago, and it's still valid. So let's look at market sentiment. Market sentiment, again, is not excessive, so it's not prohibitive although the market has responded to that COT signal, it hasn't become excessively bullish. So from that point of view, market sentiment looks good. It doesn't negate the bullish signal from the commitment of traders support. Then I look at seasonals. Seasonals from the 28th of March up until the 7th of May look fantastic for crude oil. This is the usually very, very bullish period for crude oil and for energy as well, the summer season. So from that point of view, that's very bullish. Again, we're looking at both fundamental macro and technicals. Then I go look at the trend roadmap. Again, I haven't, like I mentioned, I haven't programmed this, so I've just for this chart, I just plotted the 50 and the 200-day moving average. So what we can see here, that crude oil is both above the 200 and the 50 is above the 200. So the trend is up. It's an emerging uptrend, but still it is an uptrend. The signals for that are not, buy signals actually. It's just an overlay of the COT signals. Then I look at after trend. I go, like I mentioned, the MACD momentum model. The MACD momentum model shows that the market so far was in a trading range. There is a technique for us to identify on a real-time basis the trading ranges on any type of market, and that's extremely useful because it will show us when to do breakouts. That's when the MACD is between 50 minus 50 and stays there for 20 qualified bars. Again, rules-based approach. So from this point of view, it seems the market is kind of ranged. It hasn't picked up enough momentum. That's on the weekly chart. That's weekly momentum. But let's go to the daily chart. We can see that on the daily chart, that's the part where on the weekly it was hadn't picked up enough steam. But as of the 18th of March, the MACD has gone above 50, indicating a rallying market. So what I like about this, both technicals and fundamentals align in the sense that MACD is showing that a market that's picking up momentum, also with bullish fundamentals, the commitment of traders report, and also in a seasonally favorable market. Volatility valuation, again, I've noted the parts when volatility was excessive, and right now we see that the volatility is very, very low. And as my friend John Bollinger said, when volatility is high, that's when trends go to die, and when it's low, that's when they are born. So what we're seeing that, based from a volatility point of view, we can see the trend going forward at a faster pace. And of course, the relative ranker, this is where the markets that I trade, all of them are ranked. So crude oil is probably right in the middle. There's another list because I look at 75 markets. Again, everything is rules-based. So I go to my screener, I see my setups. Then, of course, I won't be trading them fully systematic. Just have a few intraday systems which are fully systematic. So I am, rules-based discretionary, multiple time frames, multiple factors. So this is where crude oil is. And of course, the setups, again, this is the evaluation, a recap, commitment of trader floor bullish, sentiment is neutral, seasonals are very bullish, trend is bullish, momentum is bullish, volatility at the bullish range, and relative ranker is low. That's the only kind of iffy part. But then again, when you're using a multiple time frame, multiple factor approach, you can never have everything lining up. So it's basically a weight of the evidence approach. So that's why the setups are semi-systematic, like discretionary rules-based, and then the rest of it is fully systematic. Each of these factors that I look at is literally one workshop on its own. So I'm just trying to give you more of like an inspiration on how to enrich your methodology, both with technicals and fundamentals and correlated factors, not just, things that, usually don't work, at least not where I come from in the institutional world. Like trend lines, Fibonacci stuff and or candlesticks and things. I mean they do have time and place, but by and large you should be we should be looking at macro factors. The signals, and this is how the signals obviously have a bullish bias on crude oil. So this is my signal generation mechanism. This is my system. Again, as I mentioned, I'm just showing every signal, but obviously I will not be taking each and every one of them. There are qualifiers how to do it, and the qualifiers are technical and fundamental. So literally, so I'm just showing you just for reasons of clarity, because I don't want to say just the buy signals or the sell signals. So what I would be doing literally, now that I have a bullish bias on crude oil, I will be just taking buy signals. Okay, so that's why I had a buy signal on gold. Again, I would like to thank you all for your attention very much, and offer you the attendance bonuses. And if there are any if there are any questions, I would be more than happy to take this. Let me switch back to the right to the presentation. Hello, Simon. Can you hear me?
Yes, Alex, that was great. Thank you. I'm here. Sorry, I had my microphone turned off.
No worries.
There we are. It's great. So, anybody have any comments or questions for Alex on trading Bitcoin or gold or oil? It was quite a lot of activity for Forex earlier on, but just wanted, I don't see any questions coming through for.
Oh, yeah, try to keep the presentation to the. I haven't seen any recent newsletters. Yes, because yeah, that's a good comment. Right? Yeah, I'm trying to. I think I posted a newsletter. What was that? A couple of days ago. So send me an email and I can send you the. Are you talking the LinkedIn newsletters or the ones from my email? Because right now I'm juggling between launching the indicators of trading and also my website, but I will be having this. So, Guy, I'm not sure which newsletter email. Right, yeah. So my main newsletters are on LinkedIn. I have LinkedIn newsletters. So send me your, if you can connect up with LinkedIn, I will be sending you this, but I will be trying to sending them through email as well. I prefer the email LinkedIn platform. Yeah, okay, sure, thanks. Right, so yeah, this will be organized more regularly now that the website will be launched. But thank you for your interest. And of course, I'm very open to the format. What do you think of volume? VW is like volume weighted. This is an intraday indices and the versions, right? Well, MACD, I've tried volume weighting indicators, momentum. I'm not sure that is a purely good idea because I want to be keeping it purely for momentum. I haven't found much use for volume. In theory, it's a good idea that the more volume you have, and basically I've back tested all the setups that I've read in the books, and the markets doesn't seem to be agreeing with the books. So I don't use volume weight. I did volatility normalization for my ATR. Steve, so send me an email and I will show you exactly why it's a better idea. I use it to give a possible reverse start, never ending. Fine. I mean, if it works for you, I have no problem with it. I haven't found much use for volume weighted. I do volatility weighted, and I found that's a lot more useful. But that said, if you can find good use to it, no, that's no problem. That's very good.
Okay, fantastic. I think we'll just unless anybody's got any more questions, we'll wrap it up there. Alex, what's the next moves for you? Do you have any courses or conferences coming up for the next couple of months?
Well, I will be organizing some webinars. For me, I used to give it a possible reverse. Right, I will be appreciate the feedback. Alex, look forward to reading your paper. Thank you so much, Steve. Yeah, I will be organizing a lot of webinars because my course, my website will be launched, and I will be having a trader training course, or even a summer party. Yeah, sure, why not? So I will be having a trader training program to show the methodologies I just mentioned. But I will make it a bit unique in the sense that I will be giving the course away for free. And what I will be charging is implementation, not information. So I think that will probably make be a very unique feature in the industry. So people will can have the course for free, but they can come back to me for implementation, because this is what I want to really focus on. And this is what makes the difference between being a trader, someone who does this professionally, and really someone who is good at lecturing. So everything will be for free. But if people want to have the my work and see how I do it on a real-time basis, and more importantly, not just see me how I do it, but more importantly, show them how they can do it, then we can further work together. Sounds like a positive move. Yeah. Thank you, Guy. Yeah, I think to tell you the truth, I mean, the world is enough of information, especially now the age of artificial intelligence. We're certainly not lacking information. Both, you know, if you go to Google, you can pretty much find everything there, or YouTube. But the difference is not so much the information; it's the implementation. That's the difficult bit. Because trading is simple, but it's hard. That's what, you know. That's why it's hard and it's simple. It's a matter of implementation, not so much information. And I hope you liked the presentation. It gave you some food for thought in the sense of how to see an alternative approach, how to use an institutional approach of combining technicals and fundamentals. And with that, I would like to thank you all so much. It's a pleasure and an honor to be at this esteemed event organized by my good friend Simon, who's always very good at keeping the community and educating the community and organizing these events. I know there is a lot of work going behind these events. And a big thank you to Simon.
Fantastic. Thank you. Likewise, Alex. It's great to see you. Have a good Easter weekend. We'll be in touch shortly and keep going.
Absolutely. Bye-bye.
Right. Bye for now. Everybody can see and hear. The chat is live, which is great. And yeah, sorry, we're just connected in with Charlie Burton here from Charlie Burton Trading, our Trader of the Month. So this is going to be a slightly different session. We're not doing any slides or charts. We're delving a bit more into the story of how Charlie came into being a trader and seeing what we can learn from that conversation. Funnily enough, I may have got the idea from Jerry Seinfeld for this because I've been watching
Cars and comedians in cars and having coffee.
Just loved it. Absolutely loved it. Boris says it's got no sound. Now it might be to try and refresh, because that sometimes if there's a bug in this platform, a simple refresh is the best first thing to do. So hopefully that'll work. So yes, comedians in cars with coffee, traders. Well, I've got a coffee. I hope you don't know if you have or not.
Late in the day for me now, so no.
Charlie, let's just rewind a bit. You and I have known each other since, I guess, 2002, 3.
Probably, yeah.
Probably that long.
Yeah, it's been a while. There's a couple more grey hairs since then. On both. Yeah. Mine too.
Tell me about it. Tell me about it. The silver foxes that we are.
Yeah.
So I know that you didn't go straight into trading. You had a career previous to trading in the market. I think friends, Scottish Provident, or you?
Yeah, Scottish, and then Old Mutual fund managers as well. Yeah, so straight out of university into those, and yeah, I mean, so my journey into trading wasn't traditional. It was probably traditional from a retail side of things, from a retail trader perspective, in that, you know, I effectively learned to trade for myself. I didn't come from the city per se, from a trading floor or anything like that.
Yeah.
And then going on my own. Yes, I worked for financial institutions, advising financial advisors on our mutual funds. But that's very different, you know, so to trading. It's not, you know, the worlds apart. So although I came from an industry, financial industry background, it was nothing to do with trading. So
was there one event that happened? Was there a course or what, somebody that you inspired you to think about picking up and becoming a self-funded trader?
Well, yeah, it was interesting. It was actually an IFA, a financial advisor that I used to deal with. I used to deal with a number of IFAs all up and down the Thames corridor here in the UK. And he picked up the phone to me one day, said, Charlie, you know, I've got 2 tickets to go on a trading course, learning how to trade options in the US stock markets. And I thought that sounded interesting, because really in the late 90s, I was, like many people, dabbling in penny shares and here in the UK, because I was always getting tips from my colleagues who were in the city, and they would be getting tips off, you know, IFAs and various others. So so that's what got me interested, and so I learned to trade options first of all, and went on this course with him. But it was more just out of interest. It wasn't. It was just purely the fact that came along. That's how marginal it was of how I got into trading. It was like, oh yeah, that sounds interesting. Went on that, and then just cut my teeth from then onwards. Self-learning, really. I remember paying a trader to come and sit with me to show me the various different order types. So I paid him 250 quid just to sit down and show me the order types. People don't have to do that sort of thing anymore because they have this thing called YouTube and TikTok or whatever, you know. So yeah, and I had no intention of becoming a full-time trader. No intention at all. I loved my career.
How long did it take then? Because you must have started trading, or you didn't give up the job immediately. You must have.
No, 4.5 years before I took that the leap. So it was late 2001, about November of 2001. I handed my notice in, or the October, I think it was. But yeah, so late 2001 was when I went full time. So I've been doing it for like 4.5 years, but it wasn't my intention. I have to stress that, and I think that for most people, they shouldn't become full-time traders. Some people do, but it was just it naturally evolved. I basically was burning the candle at both ends, working in the financial services industry. There's a lot of corporate entertaining and all that. Now I know that all sounds, oh, that's a real hardship there, going out for meals and everything else. But as you know, Simon, at that point, I was still competing in martial arts to quite a high level. And so fitness was important to me, my fitness and health. And I just felt that, God, I'm eating out, number of times a week. And obviously, when you're entertaining, they want you to have a glass of wine or two with them as well. And it just felt like, my life was not in balance. And so that's when I looked across to trading to say, could I do what I've been doing on the side and see if I can make the transition from doing what I've been doing on the side into a full-time endeavor? And that's how I went. It wasn't like I hated my career or anything like that. It was more to do with just the type of, the career that it was. And it was becoming more and more about, corporate entertaining, and as great fun as it is, I was just going to end up, getting way out of shape and very unhealthy at the rate I was going.
Well, I mean, you're in pretty good shape now, so it must have been the right decision to make. Well, I mean, going back to the early days of trading, what were you tempted to do in terms of? We didn't have all the technology we've got now, certainly, but in terms of what was it? Was it Forex or was it individual stocks? I'm just trying to see if we can see, because the journey of 20 plus years, how has it evolved? How have you changed your?
I think it does evolve, and so I was trading stocks. That's how I got into trading stocks, and then writing some cover calls on stocks that I owned. And it did evolve. I was trading stocks really through till about 2005, 2006, still quite actively. But I did start to trade ETFs as well. I remember the QQQ, the NASDAQ ETF coming out, and starting to trade that. And so everything seemed to evolve, really. So yeah, stocks, and then I realized, I can trade these ETFs, the SPY and the QQQ as well, and then a bit of FX, and it just sort of evolved over time, like everything does in trading. It's just a constant journey, but certainly early on it was like that, and so I just took what I was already doing and then and trading with that. But of course, I did start to day trade. I'd already done some dabbling with intraday trading, but really simple stuff, like trading the opening gap on the NASDAQ or the S&P every day. And so simple concepts. I wasn't sitting there in that early period doing lots of day trading. But back then, the opening gap was a pretty profitable strategy. I'm not so sure if it is as much now, but in the same way. But simple stuff back then, trading strategies weren't being shared. You know, there wasn't the same. The internet was, of course, here, but stuff wasn't as easily readily available, and so concepts and trading strategies weren't shared as easily, I don't think, 20 odd years ago as they are now. So but gradually I found that something as simple as that strategy started to deteriorate over time. But it helped me, because I always say I was lucky. You know, I got into trading in the late 90s. I was still working on the side. Then even when I went full-time trading, I sort of stumbled across, noticed the gaps that you got every day, and noticed that so often they would fill, and that really helped me certainly over the first year, you know, of going full-time, which was a really hard transition from having a very busy career to giving all that up and not having the phone ringing all the time and just being on your own, which was really quite lonely. So it was a hard transition, but at least I had some things to get my teeth into there. But then gradually, yes, I met other traders, and certainly one trader really got me interested in FX. And so I used to chat with him long into the night. I used to be sat at my desk until 1 o'clock, 2 o'clock in the morning, just chatting, and we keeping an eye on the FX markets overnight there, and it just became an evolving thing. So by 2005 or 6, I pretty much moved away from trading stocks because I just wanted to trade. In that time I discovered spread betting and thought, blimey, spread betting, tax free, and I might as well trade stock indices. So I started trading the S&P a lot more at that time, and FX, but I still think that the bulk of my trading was S&P right away through into the financial crisis. Although I was trading currencies, it was still a large part of my trading was the S&P. And then really by the end of the financial crisis, talking of evolving how you evolve as a trader, I started to really go into FX a lot more because of the charges, the spreads were really starting to come down over time. I mean, back in the early 2000s, the spread on cable was 3 pips. People nowadays be like, 3 pips. But yeah, that was, from what I can recall, 2001 time, so big wide spreads back then. But by the end of the financial crisis, spreads and the brokers were getting so much more competitive. So I started trading FX a lot more, and then gradually just become a habit of trading FX. So I swung from 70 to 80% of my trading being on the S&P contract to really it revolving all the way around to then 70, 80% of my trading being FX.
It's interesting because, I mean, becoming a trader some would say it's easier than it's ever been before. You can start with a lot less money. You can open accounts up in seconds almost online on your phone. But do you think it's actually easier to start now or more difficult? Because given that 20 years ago you had certain hurdles to cross over, you had to be fairly committed to get started. You were bombarded as well with social media influencers and YouTube videos, so many different strategies and choices. It's harder for people to get started to navigate and say, well, what should I be doing? It's almost like too much choice. Do you think that's something that troubles people? Or because I know that you do training as well, when they come to you, do you have to sort of unpick people and say, look, you're trying to do too much, you're trying to trade too big? Or what would be the lessons if you were to, the 30-year-old Charlie Burton?
Well, you're right in many regards. It was a lot more simplistic back then. You put a chart up, and you'd have a an RSI indicator, a stochastic indicator, and an MACD. Now you open any charting package and there's hundreds and hundreds, if not thousands, of various indicators that you can have and use. So in some regards, it was a lot more simplistic. But as you quite rightly say, in other regards, access to information was more difficult. There's so much more information widely available, but could that be an issue? Yeah, it could be. But I think we still have the same issues today as we had years ago. People have so much choice, and more choice now than ever before. But you're right that they can end up getting clogged up with so much information that that they end up with analysis paralysis, or becoming strategy hoppers from one to another all of the time. And so, yeah, it's. I don't know if it is easier or if it is at all. Although
maybe
it's
people are not. Maybe people are not as patient as they used to be.
Yeah. And so, although it's cheaper, the barriers to entry are a lot lower now. But I'm not 100% sure whether it's easier. But the same principles are still there. The market is still difficult to judge. The market is still going to punish you at times, even when it feels like you're doing all the right things. The market's still going to beat you down, just like it did then. So there's a lot of things psychologically, and the market still behaves the way the market behaves. It still has runs, it still has consolidations, and it still has reversals at its core. So it's just that look, you're right, people have so much more choice now, so it's difficult, and to not be distracted and not think, oh, okay, quite what you just said, oh, actually I don't like what I've just done there, I'm going to move on to something else because this isn't working for me after a month. So it's that sort of thing. Yeah.
Interesting. I can see Guy commenting on the chat box, just echoing what we're seeing as well. Just lots of noise and lots of characters online. It seems to be everybody's an expert these days. But fundamentally, the market has stayed the same in your opinion.
Fundamentally, I think the markets have. I know that there's been so much chatter over, certainly over the last decade about high frequency traders and the hedge funds who had HFT systems and the likes. But for most of us, that doesn't really affect us. It might affect you as an institution when you're having your orders front run and all of that. But so the market is different, but it's also very much the same. And so it's just a case of you finding the style of trading that appeals to you as an individual. And so we are all individuals. As you get the sense there, I've always focused. I've never traded a lot of multiple different markets at the same time. Like I said, during the financial crisis, where was most of my trading? 70 to 80% in the S&P. Since then, 70, 80% in FX. I've always just focused in whatever I do. But that suits me and my personality. I'd rather than me casting my net too thin and trying to trade a bit of everything. I'm not bothered about that. I'd rather focus on a few markets and have a much more intense relationship with them.
Yeah, well, that's wise words. Because I know that you surround yourself, you build a community at Charlie Burton Trading. A lot of traders that I've met, talked to over the years, find it's important to teach. And the usual question, why, if you're trading, teaching? And I know for you, as well as many other people, the answer will be because it helps you sort of stay sharp. And I imagine that this, not putting words in your mouth, but it's one of these things that when you're imparting teaching, it's sort of double referencing what you're doing. And do you find that helps you as well? Is that
yeah, it's I think having to articulate yourself day in, day out helps as an education tool to me. It keeps me on top of what I'm doing by literally talking through it out loud to other people. So so I'm always very brutally honest about, you know, being an educator. There's something in this for me as well, and it's serving a purpose both ways, to the member, to the person who might be in my community, who's learning from my 27 years worth of experience now. But also I'm getting stuff back. I'm getting it back from the types of questions, and also from having to constantly repeat the messages and articulate what I am actually doing. So yeah, absolutely, it does work both ways. Plus also it serves another purpose, a purpose of, for me, you know, I get significance from doing what I do. You know, like I said, back in 2001 to end of 2002, 3, it was really hard being on my own. We're social animals, we're social creatures, and for me, I found it very difficult just being in an office on my own. So it served a purpose for me to have a community, because I'm getting that something back as well. I'm getting that significance from having the attachment to, you know, my members as I'm talking to them, you know, most days of the week. And so yeah, it's really, and that hence why, you know, as we talk, you know, we're talking within a community here this afternoon, but that's why it's important for me as well to have that sense of community in life, really.
You mentioned just before we came on air that there's more funds. You're trading for funds as well, part of several things that you do.
Yeah.
Does that, when you're trading other people's big pots, as it were, do you find it easier, or is it more challenging, given that they might have certain criteria, and it's other people's money? How does that affect your sort of decision making, and do you see a difference in the way that you trade that compared to your own?
Yeah, I think so. I always say it's a big responsibility. I manage 5 different funds now of different.
Yeah.
They're all effectively, the trading across them is the same trading, just to different degrees of aggression or conservative levels, depending on the nature of each one. So yeah, it is a big responsibility to do that. But yeah, I like doing that, because again, it's one of those other things to say, well, look, you know, I'm regulated, I'm authorized here in the UK under a fully regulated company, and so I do like to back up what I'm saying I'm doing, what I'm doing in the community as well, with managing that money. But yeah, some of the decisions you make, what I find is I'll be that little bit more conservative with their money than on some decisions that I might make on my own capital. I might just wait for that little bit more confirmation at times with theirs, because, you know, I want to, which sometimes means that I'm just getting into a trade just a little bit later with their funds, but I want them to feel, as investors, as I want them to feel safe, and if anything, a bit bored by the trading activity. I don't want it to be, it's not supposed to be exciting. It's just, it should be that way. And if they're a bit bored, it means that they feel that they're in a safe pair of hands. And that's what's more important to me than anything.
Guys just said, are those your mental rules in the background there?
No, not really. I only picked this up just to fill a space, that space there. I just saw it. I think it came up on a feed. I thought, well, that's quite nice. The main thing that I quite liked on there was no excuses, never give up, stay humble. Actually, there's a few of them I like. Stay humble, especially in front of the market, and follow the process, I think, is down there somewhere as well. And so, which is something I talk about a lot in trading. Just keep following your process, whatever your process is. Most people deviate away from their plan. So yeah, there was a few things in there, but funny enough, I don't actually look at that often, unless I'm doing a webinar and someone sees it and says, "Oh, I see this." So I'm not really paying much attention to it. But I liked it when I bought it and put it there just below the dog.
Yeah, it was good in the background. That's good. I mean, deviating from the plan, we had Andrew Lockwood at lunchtime talking about the prop trading world. Do you have any comments, any views on that? I mean, it's growing. There's another one stopped today. The trading, the funded trader or something that's gone. Well, they stopped business today anyway for a month.
Oh, okay.
The funded trader, I think they were called.
I haven't heard of them. It's a highly competitive market now, isn't it? So I think that for those models, they need a constant influx of, because basically it's a Ponzi scheme. Sorry, but for some of them they are. And so if you're effectively a legal Ponzi scheme, I'll correct myself there. So in order for them to pay out to the profitable traders, because most of them, as we know, are demo accounts. Most of those prop firms, not all, but a lot of them are. The clients are on demo accounts. So they're having to pay you out of the profitable traders out of the challenge account application fees that are coming in. It's big business for some of them, and I won't mention names. But of course, you've got to have a lot of new customers coming in to pay for the ones who are making some money, which is only very, very few percentage-wise. So yeah, I'm not surprised to hear of that. It's a very competitive, and you've got to keep having the customers rolling in. And so, but yeah, I've not. Look, I'll be honest. I've not been a fan of that model ever since hearing about some of the earlier big companies. I'm sure there's better ones now. I'm just not in that space. I understand why people want it. If people haven't got a lot of capital themselves, why wouldn't you want to think, oh, I'm going to get X amount? But most of those prop funding firms, it's not real money, and so it's demo accounts. So I don't know. It's a bit of a grey area for me. I think it needs regulation.
Still evolving, I think. Yeah,
that is happening. So to clean it up a little bit more.
Yeah, wise word. In terms of the future, for you sort of personally, and for trading in general, where do you think we're heading? We've seen AI. Everybody seems to just say AI instead of technology now, or computers, but it's had a big impact on the trading industry. Do you think it's positive, or do you think people should be less reliant on the algorithms?
I think ever since I started in the late 90s, Simon, and you will have been hearing about this then as well, we were all talking about automated trading systems back in the 90s, and they're going to take over, and they're responsible for so much of the percentage of the trading that's done, in the stock markets and the likes. And there was talk about that in the original Market Wizards books, how automated trading is going to change everything, and here we are 30 plus years on from the original Markets Wizard book. And yes, automation is everywhere, but is it changing the fundamentals of the market? The bottom line is that the market is, it's buying and selling going on all the time. Systems are originally devised by human beings who are going to have their own biases. Maybe artificial intelligence can supersede those biases, but you're still going to have different systems competing and trading against each other. There was an experiment not that long ago, I think it was within the last 6 months ago, whereby an AI system predicted a stock market crash. Yeah, it was in the autumn when the stock markets were having a bit of a pullback for 2 or 3 months from sort of the late summer into the autumn. And funnily enough, it didn't happen because for all their brilliance, if every AI system with all of they all have universal knowledge, if they all thought the stock market was going to crash and hit sell, well, who's going to buy from them? Because they would run out. You wouldn't be able to all sell together, like we can't all buy together. There has to be a seller in order for you to buy, and vice versa. So the stock market would just grind to a halt. Trading would grind to a halt, because if AI is that good, which it is, but if they were all trying to therefore do the same thing, then the markets would grind to a halt. So I don't know what the future is there, but it won't probably be quite what we think it will evolve.
Well, they can't predict the fundamentals, really, the shocks that we have, the storms, the earthquakes, the volcanoes, the wars, even that upset supply chains and so forth.
I think the biggest threat to retail traders, especially us here in Europe and other mature markets, is regulation over the next 10 years. I think that's going to be the biggest threat to retail traders, not AI.
And when you say it's a threat, just be more specific.
If you look at, let's take gambling, online gambling. We're in this nanny state now, so people are being restricted on how much they can gamble with when it comes to online betting on sports and stuff like that. And if you look at the ESMA ruling that came in a few years ago, which reduced the amount of leverage that people could trade with, so that was something, and that's a good thing, reducing the amount of leverage that people could trade with. But
has it just pushed this? Maybe that is what's given birth to the prop trading industry. I mean, maybe something that's because people are getting that sort of leverage in a different.
Oh, I see. Yeah, maybe, but I think that regulation is going to come on those anyway. I've already spoken to some. Yeah, I think that's coming. But in the main, it's not just regulation on that. It's about appropriateness as well. You try and open a brokerage account nowadays. If you're a beginner, then it's likely you won't even make it through the account opening process here in Europe, because some of the questions now, and I think that type of thing is going to become even more prevalent. So, for example, you've got someone who wants to learn to trade. They may only have, let's say, £1,000 to pop into a trading account. When they open an account, I think what's going to happen more and more, this is just an example, their entire credit history will be checked, in an instant. And I think the regulators will change this. It sounds a bit pessimistic. We're already starting to see these sorts of things coming through, and I think that further down the line, it will be very, very difficult for an average retail trader potentially to get into trading. And that's just the way that I'm seeing things. In 10 years' time, how difficult is it going to be for someone trying to get into trading in 10 years' time? It may not even be available. I don't know. I'm just speculating, but I just think that that's the nanny state that we live in. Al, you think of governments, they don't want 80% of people getting into trading. When they hear these numbers and the regulators, that 80% of people fail and lose money, for everyone who loses money, that's not money going into their pension funds. They want you putting your money into your pension fund where it's a bit safer, and then they're not having to look after you because you get to 65 years old and you haven't got any money because you've been gambling it on the sports betting, and you've it's a bit of a pessimistic look, but you can start to see the little things that they're doing. So it wouldn't surprise me further into the future that it'll be more difficult for people in the future to get into trading in mature, highly regulated markets. So unless you want to go to a highly unregulated market, and then that's a gamble by itself.
I think you're right that the regulation just gets more and more over the breath. I think what it does is it pushes it offshore, and people find other ways to find that leverage and to get access to these things. And that's what I think is a little bit short.
You look at property right now. You look at your average landlord, property investor, and how they've been squeezed with the way that regulations have changed there. And so some of the regulations have come from the desire to look after and protect tenants from unscrupulous landlords, but there's a lot of normal landlords who've said, you know what, I'm out now. I did have that one property, maybe two. They were going to be my pension fund, but you've taken everything away from me now, and it's so difficult.
It went from being a passive investment to being a very hands-on headache for most people.
You just sort of see these things going. Oh, sorry, we're going in a bit pessimistic, but at the moment, I'm very optimistic for traders. I'm just talking further down the line in the future, as you said that. Yeah.
Well, Charlie, it's been great to spend some time with you again. I know it's been a while since we caught up. Always interesting to chat. Now, thank you for coming on and being our Trader of the Month.
Thanks for having me on.
We will get back in touch shortly. I'd like to catch up with you again, find out what you're doing. But in the meantime, take care. Have a nice Easter weekend. We'll move on. We've got one more speaker today, Jason Alan Jankowski from the US, who is always good to listen to. So we're going to be looking at trading psychology in this next session. Charlie Burton Trading, thank you so much for joining us.
Thanks, Simon.
Okay. Okay, fantastic. I'm looking for Jason is going to come on and join us. I'm going to send the invite now. Jason, I know you're in the room, which is great. Those of you just joining us, this is our final session of the day. We can have a little bit longer than normal. Jason's put a presentation today for us called the 5 Factors to Profitable Trading, and the thing that most losing traders never realize. Jason's coming into the room now. I'm not sure if we're doing cameras. We're not normally on cameras, but certainly we need the microphone. Jason, if you have the...
Do we have audio?
We do. Hello. Can you hear me?
Good afternoon to my English friends.
What? Excuse me, your Scottish friend.
Oh, my mistake.
Let's get... There's a little bit rivalry. Friendly, very much. We love the United Kingdom, but yeah, don't confuse. We're a little bit different. How do you want to share the screens, Jason? Do you want to bring up a slide?
Yeah, here's the thing. This is the first time that I remember using this particular software, so you might need to walk me through just getting.
Yeah.
I don't have a camera. I don't have a camera.
That's fine. Bring your mouse down to the bottom right, and where you see the controls for the settings and the microphone things. Share something.
Bottom right. Okay. All right.
And then you just choose share screen.
Share something. Okay. Screen. Got it.
Choose the screen, and then you choose from there the tab.
I think we need. Well, see, the problem is I want to share the screen. There we go. Okay, got it. Let me know when you can see this.
Fantastic. We can see that brilliantly.
Okay.
Thank you. Okay, fantastic. Jason, it's got to be about a year since we spoke, maybe longer. I'm not sure.
Sure.
How are you? Are things good? You're joining us from the US.
Right. Yeah, absolutely. For those of your listeners that may have never heard me speak before, I'm a US-based trader, currently in South Florida, the Sarasota, Bradenton, Tampa Bay area. Originally from Chicago, traded in the Chicago markets my entire life, almost 40 years now, and currently located to where the sun is because I can't stand a Chicago winter anymore.
Well, I'm joining you from Spain, and I can tell you, quite wintry here this Easter. We've got huge storms and snow in the mountains, which is quite unusual. So I'm glad weather seems to be much more normal where you are, which is fantastic. So the last time we spoke, you've written several books on trading. Mm-hmm.
Yeah, I'd be curious to know, if any of your listeners have read any of those or might recognize my name. I don't know if any of my work is known outside of the U.S. or has been. I've had customers from the UK and from the Union over the years, but I don't know how well known my products and content might be. So,
well, Tony certainly read your books as well. He's just commented on the chat. So,
good. Okay. Thanks. All right. Good.
So I mean, it's the psychology of trading that
that's what I focus on.
You've been focused on, which
right.
As we go through these sessions, and people talk about their time frames and their charts and their strategies. It is the big elephant in the room, isn't it? The psychology. It's what will separate two traders that both know exactly how to spot a trend or a breakout, turning point. But over the course of time, one will make money when one will lose. And I think the difference is the psychology, the mindset.
Right, absolutely. Well, you know, your last speaker, I only heard a portion of what he had to say because I was in the process of signing in and getting started.
Yeah.
But he touched on a few of the important issues. And one of those is that, and I'll talk about this in my presentation for some extent, but the problem is that most people who open a trading account and decide to do this and want to learn how to trade, most likely the probabilities are very high, 80 to 85%, that they're going to lose money. That doesn't mean they're going to blow out, ruin their lives. It means that they're going to open an account, and then when they finally say this isn't for me, or I can't do this anymore, or whatever it is that is defeating them, their account balance will be lower than when it started. And that's just the numbers.
Yeah.
So if you want to beat those odds, you've got to be thinking at a little bit different level. And that's what I'm going to share today, is some of the things that people tend to miss. And a lot of people are not aware at all that they even have these problems. You ever heard that expression, you don't know what you don't know?
You don't know, we don't know who. Was that General, your American... Oh, who was he in the Iraq War? Wasn't he? That was the things we don't know. Or
yeah, we don't know. How do you know if you don't know something? You know what I mean? That's a tough question to ask somebody. You know, you don't know. How do you know you don't know something?
Donald Rumsfeld. Thanks, Tony. There we go. That's the kind of thing. Where, oh, fantastic! Benjamin's read your book, Time Compression, Psychology of Trading and Trading Rules that Work, The Art of the Trade. He's read all your... Wow.
Well, actually, I've got... Benjamin, I'm going to just share this with you real quick. I've got another book that's been published. It's published on Amazon Kindle. It's really more of a sum total type of thing. It's basically the highlights and the thoughts and the material that I present to clients that take my Psychology of Trading course, my online 8-week deep immersion graduate level course on how to win. And that process is not what most people are prepared for. So I've written a book about it. It's called The Psychology of Trading. It's available on Amazon Kindle as an ebook. You can also get it on Apple iBooks as well if you look at their site and look for it. But as far as a trader is concerned, it really is a better work, I think, in a lot of ways than some of the other books I've written. And I'm just saying that as as an author that knows his material. I think that Psychology of Trading, how to create and maintain a winning edge, I think that it's a little bit better than some of the other books, because the other books talk about specific issues, whereas this book talks about the underlying concept of how you have to change, what needs to change. And I think that is a different move in the right direction. So if you want to round out your understanding of my point of view, you'd want to get a copy of The Psychology of Trading.
We'll drop these links later. You can tell us where to go and get them. Well, let's get started, shall we? The 5 factors to profitable trading that most losing traders don't actually realize. So, Jason,
right, absolutely. Whenever you're ready,
have you, and I'll switch the recorder on now so we can replay. And I will hand over to you, Jason Allen Jankowski. Thank you very much.
Okay. If we're rolling, then let me go ahead and say hello and welcome. My pleasure to be doing this broadcast for the Round the Clock Trading Group. I don't know who's listening or to what level their experience may extend in the markets. So I want to encourage you to remember this is an open door. Please consider me a friend in the business. I'm here to assist you in any way that I can. I'm going to have contact information available for you at the end of the broadcast, as well as a lot of free material you're welcome to follow up on. And, we have a chat window here. So feel free to put a comment or question in anytime. We're going to have some time at the end of the broadcast anyway for Q&A. So get ready. We're going to take this in a new direction, I think. You might be surprised at where I take some of my insights today. So don't let that bother you or intimidate you. Just look at it from an open door perspective. Maybe there's something I'm not seeing, is the attitude that you could bring to the table today that might really help you. So that being said, let's go ahead and get right to work on the 5 factors. So first thing, I want to remind you that we're trading in futures, options, cash, foreign currencies. These are all considered risk investments. People can and do lose money. In rare cases, people might lose more than they invest if they have made a few errors along the way. Everything we talk about in here is considered opinion. It's subject to change at any time. And you need to carefully consider if trading is right for you in light of your financial situation, circumstances, knowledge, etc. So that being said, now that the regulators are happy, I want to get right to work, and I want to introduce myself to you that might be a new listener, or even those that have heard me speak before. I think this is really important to share with you because, when we talk about people who have got something to offer you, something that's maybe heavily vetted, something that can really make a difference to you in your growth process and shorten your learning curve, there's got to be something about that person that resonates with you. There's a lot of people out there that claim to be experts that I would shake the dust off my shoes, from their office. I don't want anything to do with those people. They have no clue. I, on the other hand, I think can share with you some really important insights. So I want to tell you a little bit about my background. Not always a net winning trader, obviously. What happened? Well, I started as a customer, just like everybody listening, just like you. Started as a customer, got a broker, and went to work in this business. Did my very first trade in Chicago Board of Trade, big board corn, 1986, almost 40 years ago now. And I was absolutely stone cold hooked, man. I knew this is what I wanted to do. So I then passed my Series 3 here in the United States. The National Futures Association has a test you got to take, and then you can go to work. Pass it, became a broker. I wanted to make this as a career choice for me. And then I went and learned what you guys learn every day, day in and day out. I endured a very painful process of daily work, and it almost killed me. And when I say it almost killed me, I mean it almost killed me. I ran out of money to eat. I had money problems, living in just the most despicable places because it was all I could afford. It was horrible. I had to discover something about the markets, because how could I be so successful in everything else I've ever done up to that point in my life and then get my head kicked in trying to trade? What am I missing? What I really learned is there's no secret. It really is a very simple business. And the problem is we as traders tend to make it harder than it needs to be, because we personally choose to make it harder than it needs to be based on our illusions, our assumptions, our misconceptions. In my trading coursework, I call that particular portion of how our head is improperly aligned with the markets, I call that cultural myth and self-sabotage. How the way you think right now is why you're losing money, but you don't know that. So naturally, you're going to be spending a lot of time running in circles and not know why. Well, there's nothing very complicated to trading, is what I'm trying to tell you. What you have to do is got to fix the problem that we have. And right now, you have a lot of misconceptions that are creating your losses. You don't think that you do, but you do. And I learned some very powerful tools to create a winning environment through this process. In other words, what I went through that would kill most people, turn you into lawn furniture on a good day, I learned what that meant for me in order to flip the switch from lose to win. And that actually happened for me. And once you begin to apply these tools, your results will improve significantly in a very short period of time. And what we're going to talk about today is only scratching the surface of the things that you could do differently that would improve your rate of returns. Because you got to remember what you're up against here, guys. And this is not a joke, man. The odds are stacked against you. I'm not talking about the guy sitting next to you I'm not talking about somebody you think you know that also trades. I'm talking to you. 85% of traders lose. You're going to close your account at a net loss. That's statistically, that's the facts. Don't tell me how many courses you've taken and how many wonderful books you've read and how many things you've learned and how much experience you have. You're not going to beat these odds. And if you're being honest with me right now, you know that. You've been trading. I've talked to traders I had a guy who was a client of mine who'd been trading for 14 years, had never had a winning year. And I said, well, let's start with the basics. How much what do you think happened here? I mean, he says, I don't know. I said, well, let's start at the very beginning. How much can you tell me about zero-sum transactions? And he goes, what's that? This dude had been trading for 14 years, did not know that he was in a zero-sum transaction market, which means you can't get paid a profit unless there's another losing trader you take that from. That is a new concept to a lot of people. They don't understand that. If you want to win in this business, you have to be in the mindset that I'm looking for the losing trader. So if the losing trader is buying, I'm looking for a place to sell against that guy. If the losing trader is selling, I'm looking for a place to buy against that guy. Because if you don't get on the right side of the loser's liquidation move, you're not going to get paid. Because the only way you get paid a profit is if you take it from another trader who's out there trying to take your money. That's the environment you're in. So if you don't understand that, how are you going to do something different? How are you going to be in that 15% if you're doing the same thing everybody else does all the time? But you think it's different because you think it's different. It's not. So the price I paid for not having that knowledge was years of net losses. I talk about this in my second book, The Art of the Trade, what I learned and lost trading the futures markets. I had debits. I went debit during the Persian Gulf War, the first one. Many of you may remember that. It was in all the papers. The Persian Gulf War, where Saddam Hussein rolled his tanks into Kuwait and waited for the rest of the world to decide that was a bad move. Well, after it was all said and done, I went debit well over $250,000. How could that happen? What happened? Well, I tell the whole story in The Art of the Trade. And it's nothing new. It happens every day. For me, it almost killed me. Bankruptcy, loss of credit, no bank account. I couldn't get a bank account at one point in my life. One step from homelessness for years at a time. I owed back taxes constantly. I never had a social life. I never had any money. I had no vacations because I had no money. I lived in disgusting places. I mean, the list is just endless. Every dime I made, but see, I was so committed to learning how to do this. Every dime I made when I did have an income went into market knowledge, learning more and more about this business. And what I learned is I got lied to. I quit counting at around 60 grand, but I probably spent about 100 grand in everything that you can get for free now. Things like, seminars and online courses and free email courses and all kinds of stuff. Long weekends with professional traders and books and tapes and audio series. And I did all of that. Stuff that you can get for free now, I had to pay tens of thousands of dollars for. Never made another dime. Never helped me at all. And one day, boom. What am I doing? What is this really all about? I experienced what people call an epiphany or an epiphany. And I discovered something about the markets that made all the pain and suffering worth it. I discovered what was required to become a net winning trader. And once that change became permanent, I never looked back. Now, I have losing days, losing weeks, occasionally a losing month, rarely a losing quarter, but I haven't had a losing year, and I can't remember how long. And that's because there's a fundamental change and a shift in the way I approach what I do. And I can show you what that is. And I learned the essential difference between net winning traders and net losing traders. And what I'm going to do is I'm going to show you a brief part of the difference. I'm going to show you that difference today in broad strokes, really broad strokes, to make it more concise, specific, maybe even particular to you personally. That might require a little bit of work and a little bit of a relationship. So that's why I'm going to give you my details and show you what I offer as training and education. But I'm going to go ahead and throw this door open to start with. Does anybody recognize this? Because I want to introduce you to a couple of people. Look what's on the screen. Anybody see that? Do you guys know what that is? Anybody want to offer an input as to what that is? Not seeing anybody type anything in there. Okay, I guess we're all listening today, but that's no worries. This is a painting from, I want to say 1845, but I'm not sure. But it's a representation of the Osaka Rice Exchange in Tokyo in the 1700s. One guy says China? No, Japan, which is still in the Far East. And what's interesting is that what happened at the Osaka Rice Exchange in the 17th century, which is 1600s, what happened there is still reverberating through the globe today. And I want to ask you to just follow along with me on this. I'm going to share something with you that's not new. It is not new. It's just basically been forgotten and run over and buried by people who really don't know what they're doing. First question I have for you. Ever heard of this person? Monisha Homa? Alan's got it right. Japanese rice market. Alan, have you seen any of these broadcasts of mine before? Are you cheating? Richard has, he's a regular listener of mine, as a matter of fact. Hi, Rich. How you doing? Candlesticks is pretty close, right? Well, Monisha Homa is the individual, that's the name of the guy who's credited with inventing Japanese candlesticks. However, it's important to you know this. Homa traded the rice market in the 1700s, 1600s to 1700s, like 1685 to 1720, I think. He amassed a fortune that today would be somewhere north of about $10 billion. Took it all from the market. Would be considered one of the greatest traders that ever lived. And in fact, he is. He actually wrote the first book on trading psychology called The Fountain of Gold. And he's considered the inventor of Japanese candlestick charting. But that wasn't his intention. This is really critical. He didn't intend to invent some method of analyzing the market. Homa said this: you must be willing to go against the crowd. People ask him, how do you make money? Well, you got to go against the crowd. The crowd's buying, got to look for a place to sell. You must be willing to think differently. Now, he never really said what it means to think differently. He just said you have to think differently. So you have to decide what that means for you. What does it mean to think differently? You must not listen to common knowledge or the crowd. I'm going to go ahead and make a very bold statement right here, right now. This is what causes me to lose friends. I haven't lost any family yet, but that might happen. I've been asked to never come back to certain online forums, and I actually was asked to leave the New York Traders Expo after saying what I said to my group of people that paid to hear me speak. I'm going to tell you the same thing. You must not listen to common knowledge or the crowd. You know what that means? Take everything you've ever learned about technical analysis and throw it out, because it won't help you make a dime. Now, what does that mean? What does that leave you with? Does that mean you shouldn't use technical analysis? I'm going to tell you that it's probably going to surprise you to learn this, that there's a lot of people out there who do very well trading that do not even use price charts. How does that happen? Homa also said it's the thinking behind the tool and not the tool itself that is the key to profit. People said, oh, this is what's this chart pattern right here? Dark cloud cover or 3 marching soldiers? And they say that means this and that means the other thing. You know what that means? What's the thinking behind that? What is the psychology behind dark cloud cover that makes that an effective selling point usually? At what point is that not going to work? When is it a wiggle in the market that doesn't really matter? You see what I'm saying? Most people, they don't know how to do that. They say, oh, dark cloud cover, that's a sell. 3 marching soldiers, 3 white soldiers, that's a place to buy, right? Monisha Holman would be the first one to tell you, you're not using my knowledge the way you're supposed to be using it. So what happened since then? Well, major focus on technical analysis and math, because science is assumed to always be the best choice for getting answers to complicated and difficult questions. Isn't that correct? We live in a world where science has gone so far as to become a religion for people. Now, what do you think they call the Large Hadron Collider over in the UK, or not the UK, but in the EU over there, somewhere in I think it's in Switzerland, right? Still there? Is it still there? Why do they call that the God Finder? Because they're looking for the God particle. They're looking for the piece that puts it all together. You know what I mean? Think that through. Just think it through for a little bit. What am I saying there? People tend to believe that because science and math are so effective at finding concrete, observable, repeatable conditions, therefore, that can be related to the markets and we can use it to make money in the markets. Wrong. Because if that were true, you wouldn't have 85% of people losing all the time, every day, day in and day out, year after year after year. All the science that you can think of, all of the, what you would call indicators, oscillators, prognosticators, artificial intelligence, all this stuff, none of that's going to help you win. Because if it could help you win, then that relationship between 85% winners and 15% losers, that would have changed by now. I actually talked to a guy who was very, very, very proud of the fact, he's a hedge fund manager, very proud of the fact that his artificial intelligence software running on some crazy supercomputer that he got from the Air Force was able to think at a 7-year-old level. Really, very proud of that. And I said to him, well, let me ask you a question there. Why don't we give my 7-year-old nephew $100 million and see what he does in the stock market? Now, he got offended at that because I don't understand the importance of artificial intelligence and how significant it is. Right. And what's his rate of return? Nothing. You guys know who Bill Ackman is? He subscribes to all this crap, thinks it's wonderful. The Pershing Fund, since 2002 through 2023, has averaged 7.9% a year. I wouldn't get out of bed for 8% a month. But he's a billionaire because he's BSU all the way through. So you'll send him your $100 million. I don't mean you personally. I mean you, the investing public, as a group. The S&P, on the other hand, has returned on an average about 10% over the same time frame. I wouldn't get out of bed for 10% a month either. Point I'm getting at is that all of this, we're losing sight of something very important. Well-meaning people, well-meaning marketers, they're selling what they believe will answer the question of where to buy or sell for a profit. That's what they're selling you. So if you've been struggling up to this point, trying everything, and it's not working, it's not your fault. You just don't know any better. That's it. You're unaware of something else, which is what I want to talk about right now. What is the something else? Well, let's talk about it. Jesse Livermore, whose life story was written as a novel called Reminiscences of a Stock Operator. Any of you guys read it? I'm sure you have, right? Edwin Lefebvre. Here's a quote from Mr. Livermore. He said, "There's no bull or bear side to the market. There's only the right side." Think that through for a minute. Prices move along the line of least resistance. What is the line of least resistance? Livermore was also quoted as saying more than once that he considered chartists as freaks or pet monkeys employed by brokerage houses only because he never met anyone making money who used them. Only the opposite. The chartists were all losing all the time. And if you're one of those guys, I'm not trying to beat you up. I'm not trying to make you feel small. I'm just saying, look, you didn't know any better. Now you do. So maybe there's a better way for you. Livermore, like Homa, understood that trading is about people, not patterns, prices, numbers, or anything else, really. It's about people. So what's happened is this. Market mystification. Most people who attempt to educate traders have completely lost sight of what professional winning traders know and what they do. Traders today have fallen for a complete misconception of how and what is required to win. So this endless study, this charting, this analysis, calculation, projections, all that's based on some mathematical computation, and it will lead to losses. Not a single winning trader, I shouldn't say not a single, I'm sure there's a handful of people out there that employ some method of analysis, but it's the kind of analysis and the way they do it and how they look at it that's different. Most winning traders don't put their confidence in these methods. They don't. Because of these things, the typical trader has little to no potential to create gains. So that's why roughly 80 to 85% or more, depending on the market being traded, of all traders will close their account at a net loss. So I want to demystify that. So before I actually experienced my epiphany of understanding, I had a potentially life-changing experience, but I didn't make the connection at the time. In other words, what I'm going to share with you, I was told while I was still one of these chart heads, where I believed that I could figure out the markets and I could learn how to understand them and study them and project them. I was still in that frame of mind when I heard this. I met a wheat pit trader. This is back when the pits were still open. Some of you guys weren't even born until after that was gone, but that's another issue. I met a wheat pit trader who told me what the secret to trading really was. And this is a real guy. This was a guy who traded every day. I met him in the Ceres Cafe at the bar when he was down there counting up his cards and figuring out how much money he made today, while I was sitting there trying to put nickels together to buy my next cocktail. And he told me this. Here's what he told me. When everyone is buying, look for a place to sell. When everyone is selling, look for a place to buy. Yeah, okay, I got that. What does that really mean? What's the simple solution? So you just have to find the market's weak spot and put your position on. To find the weak spot, you just have to know what to look for. Next, if you know how to manage your trade, you can be profitable regularly. And I'm going to show you the simple steps we teach at netwinningtrader.com right now. Remember, you have to think differently and do things differently if you want to have different results. See, one of the ways people describe insanity is by saying you're always doing the same thing the same way, but you're expecting different results. You know what I'm saying? So we're just going to start at the foundation and show you what you need to know. Okay, first of all, losses create pain. The typical average trader is losing. This is painful. To avoid pain becomes the goal of this person, and therefore this trader will use everything and anything he can possibly think of to lessen the pain he feels from losing. So what does this person do? The pain avoidance process is the same for every losing trader. Therefore, they all do the same thing almost all the time, creating a weak spot in the markets regularly. What are they going to do? Well, they're going to chart their way endlessly. They're going to believe that they can make money right now. Well, what is right now? Right now is right now. So if they're on a 5-minute time frame, they expect to make money in the next 10 to 15 minutes. And if they don't, they're losing. That's painful. So rather than get in right away, they're going to wait for confirmation. And that means what? The market's got to move favorably before they even get in, which means they're giving up profit opportunity, and they don't know that because they think once it's confirmed inside their head, it's going to do the same thing in the market for them, which is, of course, an illusion. So actually, it's a logical fallacy, but we won't go into that right now. So by focusing on the weak spots in the market, we can create opportunity out of someone else's losses, meaning their pain avoidance mechanism. What is their pain avoidance mechanism? How do they use that in the market? What does it look like? How can we look at a price chart and say, there's the loser waiting to get rid of his pain? Well, I can help show you that. Let's talk about the profit paradox. Losing traders attempt to reduce their pain by increasing their number of winning trades. Their goal is to get, 55, 60, 65% or more winning trades. And this is not really likely under most circumstances. And the probability of maintaining these high win percentages is also statistically unlikely. Now, William Eckhart, for those of you who don't know who William Eckhart is, here's what he said. He said the desire to maximize the number of winning trades or minimize the number of losing trades, that's the same thing. It works against the trader. The success rate of trades is the least important performance statistic and may even inversely related to performance. In other words, if you want to win, it's not about having a whole lot of winning trades. It's about having the winning trades pay for or more than the losers. So you don't need to have a high percentage of winners to do that. You need to know how to hold your winners to do that. And that is really the important thing. William Eckhart, by the way, he was a turtle. For those of you who don't know who Turtle is, one of the great traders of recent memory was Richard Dennis, Chicago pit trader, amassed a fortune of, some people believe, close to $400 million. But at the same time, he lost a lot of money later in life, and nobody really knows why that is. He declined to be interviewed. But during the height of his career, he tried an experiment, and he hired 27 people and taught them everything he knows and then turned them loose in the markets. They were called the Turtles. And for those of you that are interested in learning more, you can find out more online. No problem. Just look it up. But William Eckhart was one of the Turtles. And he learned something very important. He learned exactly what it means to hold your winners, because Richard Dennis said this. He said, I could take my trading method and publish it on the front page of the Chicago Sun-Times newspaper, and people would still lose money trying to use it. Why would he say that? Let me show you something that'll astound you. This is a graph. If you look closely at the bottom, these are foreign currency pairs. This is Forex Gain Capital. For those of you that know who Gain Capital is. Oh, I'm sorry, no. This particular illustration from this group, this is not Gain Capital. Please forgive me. This is... Tony knows. Help me out here, Tony. What is that? That is, it always slips my mind. I always want to say Gain Capital, but it's not. It's another U.S.-based clearing firm. But it is real data from a U.S.-based clearing firm. And these are FX, that's right, FXCM. My fault. FXCM. All right, so green bars are the number or percentages of winning trades that happened in those pairs over the course of more than a year. This represents about 12 million trades. Some of these, look at this right here with my arrows circling, 70% winning trades in the Aussie to New Zealand dollar. The green bar winning trades, these are the losing trades. So for the most part, the entire corporate database, every trader trading these 15 currency pairs at FXCM, it's got a really high percentage of winners. But look at this. The green bars represent the average winning trade. The red bars represent the average losing trade. So even though some of these people have got 55, 60, 65% or even more winning trades to losing trades, they're not making any money. They're going broke. The average is about 50%. So you want to win at this, you got to make more money than you lose. But over a 1 year, 12 million trades, complete entire database of people trading at FXCM, even though they had guys that were laying it away percentage-wise, they couldn't make any money. The win-loss ratio is your problem. You have to take more money out from your winners than you lose on your losers. And the data I just showed you, what do these losing traders have? They have the other way around. They're losing twice as much money as they're on the losing trades, then they win back on the winning trades. So even though they're winning at a high percentage level, these traders can't pay for their losses. Add in slippage, commissions, and carrying charges, and you have no chance. Another quote by William Eckhart. One common adage that is completely wrong-headed: you can't go broke taking profits. That's precisely how many traders do go broke. While amateurs go broke by taking large losses, professionals go broke by taking smaller profits. So what do we teach at Net Winning Trader? How to hold your winners. You have to. You need to have a method for this simple thing. Hold your winning trades. Otherwise, you can't pay for your losing trades. Now, here's another quote from His Holiness, Mr. Livermore. After making and losing millions of dollars, I want to tell you this. It was never my trading that made the big money for me. It was my sitting tight. Got that? My sitting tight. In other words, Livermore would put a trade on and he'd go fishing for a month. Wouldn't even look at it. We teach methods for holding winners that are considered unconventional, such as turn off the screen and go for a walk. The point is, you have to develop and maintain this skill, or you can't benefit from your system's probabilities. You got to operate in a higher time frame. Net winning traders know that it takes a significant amount of time for all market participants to reach liquidating conclusions. I talk about this in my book, Time Compression, where I talk about how the 5-minute guy is going to be wanting to make a decision now, but the guy that's trading on an hourly or a 2-hour time frame, he's going to give it another couple hours. The guy that's on a daily or a weekly time frame, he's going to give it till Wednesday or Friday next week. So, but at some point, they're all going to decide to get out. And when they do, all of those orders on one side are going to pressure the market into a price direction that you, as a winning trader, know how to look for, right? So it takes time. So you have to operate on a higher time frame. You got to think further ahead. The average winning trader is working on a 60-minute time frame or higher. The average losing trader is 30 minutes or less, and most losing traders are operating on 7-minute, 10-minute, 3-minute, 5-minute time frames, and just getting their head kicked in every day. And it won't change because they think that's what they've been taught to do. So they think that must work. See, winning traders know they can't get paid unless the losing trader takes a loss. So it takes time for the loser to decide to take the loss. Therefore, the winning trader is waiting out the losing trader, and he knows the losing trader will make his market exit for reasons that have nothing to do with successful trading. In other words, emotions. He's going to panic. Why do you think the market whipsaws on a big news day, and at the end of the day, trades at the exact same price it did on Thursday at the end of the day? It's all panic. You got to know how to exploit that. Typical losing traders are operating in a time frame of less than 30 minutes. Typical winning traders are operating time frames of 60 minutes or more. Take that to the bank. You got to add to your winning trades. This is another thing we teach. Nothing will help you reach top-level performance than adding to winning trades. Now, I would say this number is probably not accurate anymore. A lot of, in fact, I've been told not to use the word 100%, even though I know that sometimes that's true. 100% of all net winning traders have a method. Well, let's say 80, 90%, maybe a little more, have a method by which they add to winning trades. I do. Everyone I know does. But I'm sure there's winning traders out there that don't. But if you have the propensity to add to winning trades, you can improve your profitability significantly. Jesse, again, His Holiness has this to say: when I'm bearish and I sell a stock, each sale must be at a lower level than the previous sale. When I'm buying, the reverse is true. I must buy on a high or rising scale. I don't buy long stock on a scale down. I buy on a scale up. Adding to winners increases the effectiveness of your system's probabilities. Record keeping. This is really important. Most losers don't really know how to do this properly. Winning traders take advantage of the data they create. Trading is a business. Treat it like a business. Keep good records of your participation. Problem is, most traders are not keeping the sort of records that can be used to improve their results. Most losing traders keep the wrong sort of records. They keep records like that makes them feel good about what they're doing. Things like percentage wins, largest gain, smallest loss, right? You need to keep the records that can help you improve two things. This is what your record keeping is all about. How do I improve holding my winners, right? You want to figure out how to improve holding your winners. So you need data about that. So you need to know how long you're in a trade, when you move stops, when you add to positions, when you're averaging, right? You want to improve your win-loss ratio. What that means is you got to pull out at least $2 for every dollar you lose. So on a winning trade, you got to make $2 or more for every dollar you lose on a losing trade. I go by percents. If my average winning trade has to be 2% gain on my equity because my average loss is 1%. You see what I'm saying? How do I improve that? All right, so in summary, winning at trading is really a very simple proposition in my opinion. All you really need to do is follow in the footsteps of this forgotten and timeless wisdom. Number 1, focus on win-loss ratio and not your win percentage. It doesn't matter what your percentage is. It matters how much money you're taking out on the winners compared to the losers. Try to put together a program where you're winning 2 or 3 times as much as you give back on the losses. Hold your winners. Find a way, a method that helps you hold winners. Operate on higher time frames. Don't play in the random noise like the losing traders do. Figure out a way to add to your winners. And last, properly document what you're doing so you can get data to help you win. Now, the program I offer at Net Winning Trader provides you with tools to create a winning method, as well as provide you with a whole lot more in trader development and, of course, regular coaching. I always say anyone for cake, because when I was a kid, I thought to myself, well, if I could learn how to bake a cake, I could eat cake every day. I have to wait for my mom, right? Well, my mom told me that if I could read, I could cook, because all you got to do is read the recipe and do what the recipe says. Well, that's not that hard. I can do that, right? Trading to win is like baking a cake, in my view. It's very similar. There is a recipe you have to follow. If you follow the recipe, you end up with cake. If you don't follow the recipe, you get something else. That's what trading's like. To win at trading, simply follow the recipe all winning traders follow. There's no mystery to it. There's no secret. So in conclusion, you know how net winning works now. So you're left with a choice. Thank you for attending. Floor is open for some Q&A. Here's my website. On the website, you can sign up for some free data. If you have questions you don't feel comfortable asking in a public forum, you can email me, contact me, and I'll be more than happy to send you back an answer if you like. I tell people this all the time. You can consider me your friend in the business. I'm not here to hurt you. If I can help you, I will. I promise. I'll do that. And I won't lie to you in the process. And I'll make sure and tell you what the real issues really are for you. Because if you don't hear that, how are you going to change? You really do need to make some changes. If you're not laying it away, and I can give you statistics that are really simple, but it would make a big difference to you. If you're not laying it away like you feel you can, that's only because you're not doing things differently in a manner that you could be. We can change that. Also, you can sign up, like I said, for some free content as well as some additional data if you want. I have a discount code this week. Tony gave this to me. Use that discount code. That's good till the end of Sunday if you want to sign up for the paid program. If you're skeptical and you don't know much yet about what we do and how we do it, follow this link and you get a free sample of my latest book, The Psychology of Trading. And after you've read that free sample, I hope you'll begin to become a little more enlightened as to what the real issue is. So, that being said, floor is open. We can take a few minutes. I wanted to make sure and give you enough time to have some questions answered.
Jason, thank you.
Yeah, we there?
It's Simon here. Yeah.
Thanks, Simon.
Fantastic. Thank you for that talk. It just makes it all appear so obvious. Why don't we think of this? But of course, when you're in the middle of it, you don't.
In the heat of battle, I know.
See the wood for the trees. Yeah.
Yeah, I know.
I think concentrating on the money. There's two different trains of thought in terms of how you assess your success by concentrating on the actual money that's made, the profit, or the pips. Some people just look for that percentage.
Sure.
you think focus on the actual return.
Well, okay. Let's put it this way. Here's the best way to say it. Okay, is that it doesn't matter if you focus on percentage return or pips made or pips lost or bushels, the size of the trade that you're trading, half a bushel a day, whatever it is. It doesn't matter what the thinking process is you bring to the table. It matters that you develop consistency on that so that you're earning 2 times to 3 times on the winners what you're losing on the losers. So I say, I teach people, take a consistent amount. This is something that you feel reasonable with as a loss. Now, you got to figure out how to hold those winners for 2 to 3 times that when you're on a winner. That's all it is. Doesn't matter if it's pips or bushels or ounces.
So, yeah.
Or it doesn't matter if it's percent of account balance. I go by percents because that's just more comfortable for me. I can lose 1% of my equity. I can't lose $1,000. That's too much. But I can lose 1%.
Yeah.
You know what I mean? See what I'm saying? So that's what I'm getting at, is that whatever it is that you and your thinking can handle, that's your risk. We're going to figure out a way to make that as small as possible as far as market price action is concerned. And then whatever the gain is, it's got to be 2 to 3 times that regularly. So when it's there, why did you get out early? When it's not there, why did you think it was there? Those are the issues that we have to confront and get past so that we focus clearly on probabilities, which is the issue of finding observational bias, not evaluational bias. What most people do is they evaluate the market, Simon. They try to figure out what the market's going to do and what all this means and why is the price higher or lower. That's evaluating. What I teach is just look at it, observe it. Where's support? Well, it's got to be right about here. Why is that? Because there's no trade down here. So this is where the market stopped going down. So it's got to be support right in there somewhere. Well, what if it's this price and not that price? Why does that make a difference? You want to be a buyer there. So run your stop out of range. It's very simple. If you're trying to buy a bottom, which is where the risk is the lowest and the opportunity is the highest, you're looking for the market to reject the price area by not going any lower. Well, how do I know it's not going to go any lower from there after I get in? You don't know. That's a probability. But if you are buying because the market has already demonstrated it can't find any sellers down here, then it's a better than risk proposition, better than average risk proposition that the market will bounce from here some amount. So if you have a lead on it, run a break-even stop and hold it. Now, there's nothing to do. There's no thinking. There's no analysis. There's nothing to do but wait. All you have to do, this could be a bottom. Okay, buy it. Put a stop out of range for 1% of your loss. That's it. If you're wrong, you're wrong. Now the market comes up, starts to make money. Great. Roll a stop to break even. Now it's not going to cost you anything to find out if you're right. Wow, the market really took off. I better get out. Why? If it's going your way, let it work. Roll a stop to protect some investment. Pull a little bit out now. You see, so what we're trying to educate people to do is not to come up with some new method or some esoteric change the world methodology. We want people to just use their common sense. Use your common sense, and play along with that.
So at Net Winning Trader, Jason, is this a community for people to trade with you?
Well, okay, that's a good question. What we're doing, if people are willing to go and have a look. The landing page is designed to cause you to think, is this a product I want? Nobody says you have to buy it. We have, like I said, a lot of free content you're welcome to sign up for. We send that to you regularly. And what we want you to do with the free content is ask yourself, is this resonating with me? Does this open my door to a new kind of thinking? Are these people trying to show something that's maybe a little bit more common sense oriented, better positioning for my thinking, less stress? If the door begins to open like that, then we'd love you to become a paid subscriber. When you do that, you're going to have access to everything in the members area, which will dwarf most people's understanding if they'll feel overwhelmed. Most people do. So what we do is we offer a regular, doesn't cost anything, it's included in the price, regular workshop like this, like what we're doing right here. And it's live. You can ask questions, you can participate. I'm there live. I do a presentation every one of those. And we do those as often as we can. Right now we do them weekly for the people that are our subscribers. And all we ask is that you provide feedback as to what's working and what's not working, and you follow the program. Now, again, there's always somebody that doesn't follow the program. So what do you do in a situation like that? If they're not doing what is suggested that you do, maybe you're not going to improve. But that's not who we're looking for. What we're looking for is the guy that says, you know what, I'm so tired of losing. I really am. I'm willing to spend a few more dollars to find out if this is for me. I can tell you, too, from personal experience, that if you're not really cut out to trade, I will be the first person to tell you that. Now, that doesn't mean that can't change at some point. But if you don't have the eye of the tiger, that's what I call it. If you don't have the eye of the tiger to win at this or learn how to win, I'll be the first person to tell you that, so you don't end up beating your head against a wall for another 10 years. It's okay to admit this isn't for me. It's okay to do that. But if it is for you, if you really got what it takes, you just haven't figured it out yet, I'm going to shorten your learning curve and give you everything I possibly can to help. And in most cases, people see improvement. In most cases, it starts as losing a lot less and eventually ends up becoming winning more and more. It's a process. It's not going to happen overnight. In my online psychology of trading course, the big one that I offer, this is the Net Winning Trader is a distilled, let's start making money right away thing. It's not a follow in the footsteps of Jesse Livermore thing, which takes more time and money.
Right.
But if you want to do that, in that coursework, I have success rates that are staggering. If I told you, you probably wouldn't believe me. But I've had people flip the switch from lose to win in a 4 or 5 week period of time, where they don't lose anymore. Now they're pulling money out consistently. In some cases, they're scaring themselves. They don't know how to handle it. Okay, well, that's a solvable problem too. And it's a constant state of growth. But you have to start at some place. You have to start somewhere. And what we provide at Net Winning Trader is really simple. It's a couple of edges that you don't have to invent. They're already given to you. All you have to do is follow them. You come to the courses and do the work, follow the edges. You'll start accumulating data that you can then begin to see why you're told, don't do this, do this. After 100 trades, it'll be abundantly clear to you where your problem is. Now you can fix that. It's only a process that takes time. That's all it is. It's not, everybody, I personally believe that everybody has the potential to become a winning trader. I think everybody has the ability to say, look, I want a better life. I know there's money out there. I can reach my full potential at something. There's a lot of people out there that would rather be full-time painters and artists than traders, but they're trading because they know that once they can start to pull in, 5,000 pounds a month by doing next to nothing, they can concentrate on their art or travel or put the kids through school or whatever it is. The marketplace can do that for you, but you can't get a penny of it. You can't get a dime one of it unless you're thinking in a new paradigm and you're disciplining your behavior in a new way. Once you make that change, now it becomes an open door. That's how I view it. And I think everyone can learn to do it. That's me, Simon.
Speaking of time, what time zones would these workshops take place? Is it for?
Well, typically I do. Typically, right now, what I'm doing is I'm doing them when the markets are closed. So that's usually Saturdays, and I'm doing them at noon Eastern on a Saturday. So that would be, roughly early evening for you guys in the UK or on the continent. It's going to be early morning for people in Asia, right? They're always recorded, so you don't even have to come live if you don't want to. I've had plenty of clients that just say, hey, these are the questions I've got from this week. Would you address these in the workshop? So I get a bunch of questions, and I address those in the workshop because that person can't come at noon Eastern U.S. time. We also mix that up. There are plenty of times when I do workshops early in the morning U.S. time, late at night U.S. time, so that other people on other time frames can participate when it's convenient for them in their day. But they're all recorded and posted, so nobody misses anything.
Fantastic. Well, Jason, thank you so much. It's always good to do this. Hopefully we won't leave it so long next time. My bad. Just got busy with other projects and so forth. Still haven't managed to persuade you across to London yet. We are doing the live show again.
All you got to do is keep me posted on that. Yeah. I would love to come over and do an in-person visit with you guys, spend a couple of days, and maybe meet with your customers and people that would like some one-on-one coaching. I'd be happy to do that, and we'll find a way to make it fit in both time and budget for everybody. Just keep me in the loop. That's all I ask.
Well, I mean, the IX show is going to be the 27th of September this year, a little bit earlier than the November date we've done the last couple of years. So I'll send you the details, and let's get our thinking caps on.
Absolutely.
Something around there.
Absolutely, I would love to do that.
Okay, Jason, thank you so much. I'll stop the recording there.
No worries. I'll go ahead and sign off, and you guys have a fabulous rest of the week.
Thank you.
I know this is Easter weekend, so hope you get a chance to relax and enjoy the weekend. And I'll see you guys next time. Just give me a call anytime.
Jason, thank you so much for spending time with us. Really appreciate the time.
You're welcome. See you next time. Bye.
And thank you to everybody here. That sort of concludes the presentations for today. Thank you for joining us for the we had a good time. I think we looked at some Forex, we looked at the stocks, we got a little bit input on even crypto, prop trading, psychology of trading, and we've enjoyed some of the questions as well, and I hope you've enjoyed it. If you do want to watch any of these presentations again, simply come back here to this platform, or you can access the replays through our YouTube channel, which is at IX Investor on YouTube. I'll just put that in there. So great to see you all. Take care, have a nice weekend, and we'll be in touch again soon for another one. Bye bye for now.